Okay, good morning, my dear future chartered accountants. It's actually very nice to hear a very strong voice and be ready for the very long day. Marathon sessions can't help, that's the nature of CA students and CA classes. Without further ado, let's go further. 3 days and financial reporting, paper one, and you are becoming going to become chartered accountants. So accounts is your core subject. Actually, only accounts is your core subject, no? You have financial management, which is actually not your area. It is MBA finance people area. You have costing, that is not your area. There is CMA people, CWA people for it. You have law, that is not your area. Lawyers are there for it. GST, income tax, also lawyers only can represent in High Court. You had one IT subject in intermediate, which is alien subject, again not yours. Only subject left is accounts and auditing. Anyway, let us move further. First thing first, I hope you have downloaded the material I have shared in the Telegram group at CHINMAYA HEGDE, and there I have shared the PDF material which has problems, solutions, theory, and charts. So basically, whatever was supposed to be there, it is there. So you can come to the classes empty handed, and of course you don't come without mobile. So if you have mobile, that is actually sufficient. But anyway, you can write as you require, but objective is to cover as much as possible. So I have shared the solution also. So make sure you download the PDF material from the Telegram channel, and I'll be using that. I mean, PPT you can watch it, but problem will be there, solution will be there. But if you have the material handy with you, it will be easy, convenient for you to follow it. Okay, and then before we start, let me ask you few things. Is there any particular area or problems or variety that you are not comfortable, or you are having some issues? It's not that I'm going to change the problem, I've already covered it, but if you have any specific areas, whatever little time possible, we can address those issues. Is there any specific problems, specific issues? Reverse acquisition. Okay, I have not included the problem, but I'll try to explain it. Okay, then financial instruments. Okay. Hedging, I don't see the questions in the new material. I don't know whether they've taken it from the syllabus, but we'll see. I'll try to I'll try to cover the concept part, if not the problems in detail, so that you'll get some sort of idea how to go about it. If not any specific problem, I'll try to cover it. Okay, fine. Then you're looking at me for options. No, that option is not there here. That is only there in your law and all MCQ, but that's here. You have to write the full answers. Okay, any other areas, concerns, issues, problems, varieties? One thing I can clearly from your faces is whole subject is a problem. But I'm still hopeful that if something can be identified, we can give some more importance in that sense. You're looking at your friend's face, your friend is already looking at your face. Common reactions in exams also. Okay, I'll just quickly tell the chapter name, see if you have anything. Ind AS 1, 34, 7, Ind AS on assets, Ind AS 116, 115, revenue, lease, property, inventory, business combination, financial instruments, share-based payments, Ind AS 113, fair value measurements, Ind AS 38, intangible assets, 36, impairments, 19, employee benefits, 37, liabilities, 12, 21, income tax, foreign exchange, rate party. Any particular areas? Okay, so if nothing is there, I'll just go it generally. It's all about your comfort and convenience. Okay, let us move further. The focus of our classes will be on the latest problems which are covered, to be specific, in RTP May 2022. That will be a focus. I mean, I'm not doing RTP wise, I'll be doing topic wise only, but the problem I'm focusing will be from the latest RTPs and the new study material questions whichever have been added. And can we skip the consolidation piece so that we can focus on other areas more? I just wanted your reaction, nothing else. We cannot skip consolidation, because if you skip consolidation, it's as good as skipping 60% of financial reporting. The chapter may be one, but its impact, its link are many, so we cannot afford to do it. So first day, our target will be to cover the basics, frameworks, Ind AS 134.7, and then we will be focusing on consolidation, business combinations, Ind AS 8, 10, 113. This is our target for day 1. Let us. Okay. Since again these are the basics, I mean these are some basics required. I will not be doing in depth. Straight I will go to the topic. Ind AS is what you have in your syllabus, and we don't use the word adoption, we use the word convergence, for a simple reason. We cannot take word by word. We want to move towards application over a period of time, making our life more problematic. Had it been like a GST thing, old tax taken out, new tax brought in, it is just like moving on with them. And you have a breakup with the old girlfriend, start new relationship, life is beautiful. But now we are having old also, new also, comparison also. We are getting stuck everywhere. And for companies, only one set of accounting standards apply, but for students, all standards will apply. So at least if you know the application part of it, it will be convenient in which cases, which companies should follow which standard. First of all, there are two sets of accounting standards, one by MCA, other by ICI. I'm not sure whether you are aware of it. Though it is a fast track class, I would like to spend 2-3 minutes on that point. Let me ask that basic question. Is accounting standards compulsory? A fundamental question. Is accounting standards compulsory? For whom? For students, yes, it's definitely the applicable. That's what you are reading. Yeah, that's it, applicable. For companies, it's applicable. For non-companies? Okay. In the year 1999, that is where the amendment came in. Companies has to follow accounting standards issued by MCA. Before that, there was accounting standards by ICAI. There are two sets of standard, only some 2-3% difference. You are not required to be aware of it, but you should know that there are two sets of accounting standards. But after the amendment 1999, the Companies Act took over the authority. ICAI has actually become irrelevant. But with respect to non-corporate entities, still we apply the accounting standards issued by ICAI. Means it's applicable for members, and members means when you sign a balance sheet, that will apply in case of tax audit cases. Ultimately, non-corporate entities accounting standard issued by ICAI, because the member, while signing the balance sheet in case of tax audit, has to comply with the ICAI standards. Keeping that aside, then we are having this Ind AS, which we are having our syllabus applicable from 1/4/2016. Companies net worth having 500 crores. All listed companies from 2017. As on date, for all listed companies, whether listed in India or listed outside India, but SME listed, they are not required, but listed in India or outside India or in the process of getting listed, for everybody, Ind AS is compulsory. For unlisted companies, if their net worth is more than 250 crores. 500 crores earlier, now it is 250 crores from 1/4/2017 till today. That is what is applicable. Once a company is under Ind AS, its whole family will be under Ind AS. Whole family in the sense, its holding company, its subsidiary company, its joint venture, its subsidiary. It is like Corona. One person gets in the family, everybody gets it. But for one set of people, it is not applicable, and that is the joint venture in the nature of joint operation. There are two types of joint venture. One is joint venture, other is joint operation. Joint venture means that the company has, the two companies have a common interest. Whereas joint operation means there is no separate entity being formed. They just share the income and expenses, or they might share the assets and liabilities. They have got the rights in the assets and liabilities. That's what is joint operation. And for that, Ind AS is not applicable. This chart again must be there in the PDF I've shared, or if you have my material, it will be there. This chart is what you need to keep it in mind as far as the basics is concerned. Okay, I'll talk about one more, then we look at some problems, that is on framework. So what is the meaning of framework for preparation presentation of financial statements? It's basically providing the guideline, the purpose for which a financial statement is prepared and for whom it is being applied. It is for the purpose of development of new reporting standards. Already we are tired of existing, but if any new standards are being developed, this will provide guidelines, and also existing standards, if there are issues, interpretations required, this framework provides clarification on those lines. And also assist auditors while making an opinion, and members to apply accounting while preparing financial statements. Who are the users of accounts? We have investors, employees, shareholders, governments, academicians, everybody. The scope of framework will talk about the objectives, qualitative characteristics, recognition, measurement elements, concept of capital and capital maintenance. The objective of financial statements, mainly we prepare a balance sheet, P&L account and cash flow statement. The purpose of balance sheet is to reflect the economic resource controlled by entity, which is assets, and economic resource owed by the entity, which are liabilities, and the equity, which is called as the residual interest. That is the balance sheet, statement of financial position. Then we have P&L account, statement of profit and loss, and that provides the framework, in the sense results for a particular period, that is profit or loss earned. Cash flow statement, between the two period, how the cash have taken place, changes have taken place, that is objective of financial statements. And recently in your study material, they have changed the structure of this chapter. And fortunately or unfortunately, many students don't even know it because you don't look at this chapter. So if there is a change also, how would you realize it? But again, don't have to worry about it because it's more of theory in nature, and the concept, whichever all is linked, is covered in various other standards. For example, when we talk about Ind AS 113 fair value measurements, we talk about different types of basis of measurements, present value, historical cost, replacement cost, and that is again repeated in the framework. So don't worry much about the framework chapter changes. Don't start reading study material on the day before exam, that too about this chapter. These are all basics which are assumed to be knowing. You don't have to read it in specific. Qualitative characteristics are there. The data has to be relevant, it has to have material effect. Those elements are there. Again, I don't want to go in too much in details into that. And they will provide the concept of recognition measurement, in the sense elements. There are basically 5 elements. One is assets, liabilities, income, expenses, and equity. Asset means resource controlled by entity. Liability means it's a present obligation having outflow of resources. Expense means decrease in the benefits. Income is increase in the benefits. Equity means residual interest. In that context, I'll quickly discuss one example. Let's see if we can connect this topic. In the problem also it will come. Just imagine a club or a bar and restaurant. I know CA students can't go there. At least let's imagine in our examples. Let's leave there at least. So customer goes there, sits, and supplier will come and give the beer or any liquor. Now the question is this: when a company is selling, the bar is selling, are they selling only the liquid or the liquid container as well? I mean, including the bottle as well. Are they selling only the only the liquid, or including the bottles? They're selling not selling the bottles. When they charge you, they're charging only for the liquid or for the bottle also? For the bottle also, no. Not only alcohol. Just because alcohol, you don't have to give a different answer. It's for any liquid aerated drinks you purchase, Pepsi, Coca-Cola, they'll charge you for bottle also. It is for the whole product, packaging as well. But obviously, once the client or the consumer, the customer consumes, he will not leave the bottle there. He will go home. Now the question is this: the bottles which are there after consumption, after leftover by the customer, who is the owner of those bottles? Is the customer the owner because he paid for it? Or is the company the owner because it is under their physical possession? Tomorrow can he come and say that yesterday I paid for this bottle, give it back to me? Legally he can, but forget about he remembering the bottles. He will not remember himself or his home or where he was. No question of asking him back. But the legal owner was him. But once he left over, it is not under the control. So looking at the word control, the company owns those assets. So they are the assets belonging to the company, and they should have accounting policy how to recognize it. What is the cost of acquiring those bottles? It is actually nil because you already sold it. Now whatever coming is like customer is giving you the gift. You enjoy it at free of cost. So that's how the questions will be framed regarding the basic elements. We are going to see question of that kind as well. Then you just need to know that the definition of an asset. Asset is a resource, to be specific, economic resource controlled by entity. Just having an asset is not an asset. It should be under your control the way you have to use it. Is a CA degree your asset? Is it a resource? Definitely controlled by you. After this you use whether sign, not to sign, be in practice, be in employment, as a result of past events. Yeah, many events are there for CA exam. So it's also asset, but whether recognition or not, then we have to look at the respective standard. AS in Ind AS 16 will tell you, Ind AS 38 will tell you regarding the recognition measurement principle. Some guidelines are given in the framework. One more important area which somehow students are not comfortable, that is the concept of capital and capital maintenance. So we have 3 varieties there broadly. Let me show you the charts. Financial capital is what we follow, simply recording whatever as it is. But if you move towards physical capital, or even there, financial capital, you have 2 kinds: at historical cost and general cost. How the capital employed to be reported. This comes from one basic idea. I'm not sure whether you have witnessed. I hope when you ask your parents, I want to go for a movie, give me 1,000 rupees. What is the first reaction from your parents? 1,000 rupees. In our days, 1,000 rupees 1 month I used to manage. One movie you are spending 1,000 rupees. The fact is yes, because its value is different. Its purchasing power, inflation, you call whatever the name. The ability of the 1,000 rupees 10 years back and 1,000 rupees today and 1,000 rupee after 10 years will be different. We want to report it in our books of accounts, and that is what is concept of capital and capital maintenance. Historical cost means we are following as it is. Current cost in general means, I think especially we have to be worried now at this point in time, because you know the inflation is being increasing. But our salaries are not increasing. General cost means in general inflation. Inflation means increase in prices. Any idea in the last month what is the inflation? CA students don't know inflation, because previous month also stipend was 2,000. This month also stipend is 2,000. After 10 years also stipend will be 2,000. So you don't know the concept of inflation. But if you by chance have looked at the news and you followed it, in US also inflation is burning at 7%, whereas US inflation is should be around 1%. India's tolerated inflation level is around 5-6%, the comfortable level of RBI. It's also increasing. So we are coming across increase in inflation rate soon, and to be specific, actually in tomorrow, Thursday, the US Fed is likely to come up with a meeting and they are likely to increase the interest rates. The basic fundamental point I'm telling you is because of inflation. So when that inflation should I reflect in my books of accounts, and we have one standard called as hyperinflationary accounting. Fortunately, it is not there in our syllabus yet. Before it becomes applicable, you please make sure you pass your examination. That is how CA exams are structured. When I was doing CA intermediate, I had 6 subjects. I think most of you had 7 subjects. Now they are having 8 subjects. Future, I don't know how many subjects they will have. In the balance sheet P&L account, if you have to report those inflationary changes, that is where this concept will come into picture. I'll just give an example. Don't write it down. Just take a look at this. Let's read the example quickly. On 1/4/2017, businessman has a capital of rupees 10,000 represented by 1,000 kg of product of 10 each. So this 10,000 is not 10,000. This 10,000 is ability to purchase 1,000 kgs. That's what we want to report in our balance sheet. During the year, he sold all the inventory at 13 rupees each and he withdrew rupees 2,500 during the year. Average price in the beginning is 100, at the year end 120. Price of the product A at the end of the year is 12.5 per kg. So if you look at the financial capital, beginning was 10,000, ending is 13 rupees into number of units, 1,000, that is 13,000 cash. And he withdrew 2,500, so 10,500 is what you say we have closing capital in financial terms. But coming to financial capital at current cost, what is the value of opening capital? As I told you, the value of opening capital, don't tell 10,000. It is actually 1,000 kgs. And look at the average price. What was the opening price? The opening price at the beginning was 100 and the year end it became 120, which means if you had 10,000 at the beginning, if it has to maintain its same purchasing power, at the end of the year, you should have not 10,000, you should have 10,000 multiplied by 120 by 100, which means you should have 12,000. But you're having 10,500, which means actually the value of the capital is lost, which is what we say because of inflation. If you don't do anything also, the value will come down. This is what is financial capital, I mean at current cost using general inflation, general cost. Whereas if I take it specific cost, that is product related data, it was costing 10 rupees, at the year end it is costing 12.5. So if you have to have the ability to purchase 1,000 kgs, at the year end it is 1,000 kgs multiplied by 12.5, you need to have 12,500, but you have 10,500, which means again 2,000 is the erosion in capital. Ultimate summary of this point is, even if you don't do anything, the capital will get reduced because of inflation. But the advantage or limitation is this has not brought into our any of accounting standards. All our reporting will still happen at historical basis, not at inflation adjusted numbers. As I told you, in the future it may come before that you pass the exams, but for you in CA exam this question can be asked. So what point to be kept in mind as far as steps is concerned? You calculate the financial capital, closing capital, opening capital, you take it as it is, that is financial capital. You take the opening capital multiplied by the increase, that is numerator, just like the way you do in income tax, no, in capital gain indexation, like that you apply 120 by 100, that is financial capital at current cost. You take the opening capital, divide by the opening price multiplied by the closing price, the physical value of that, that is what is physical capital. The difference is the retained earnings. Again, don't worry about writing it too much, but if it makes you effective while making note here and there, you make note of it. I'm not dictating it, because sometimes when you use your hands, your eyes will be more powerful. Hope you understand. I can't explain in detail. This most probably will be uploaded in the YouTube also, so later also you can watch it. But my doubt is, or I would say, there are better ways of wasting time. You are already coming here and then watching, then understanding, again going and watching. So multiple attempts to attend the class itself. Then why to write the exam? So I recommend not. You can refer other friends who not come if you think it's useful, or if you think they should also follow the same torture, tell them to watch as well. But my recommendation is, don't focus on writing, but if something makes more useful, then you write it at your convenience. Okay, so this is about the basic framework application, and this one point I spend more time because this is one area I thought usually people give less importance, but institute asked the question, so I spent couple of minutes extra on this. Okay, let's move further. This is an RTP question, latest RTP May 2022. I'm not sure whether you can read. Again, as I told you, if you have downloaded the PDF material, please watch it, or if you have taken a printout, it will be comfortable. I'll read it anyways. You can listen. Defense Innovators Limited is a public sector undertaking. I'll do one thing. I'll just increase the font slightly. Okay, this is one thing you should be comfortable in exam. It might be out of context, it might be old joke, but I want to tell it. Normal questions, 1 over how many balls? It is 6. You get full marks, but in CA exams you get 0 marks. In CA exam, what is the full answer? It is 1 ball delivered 6 times. Then also you get only 1 out of 10 marks. Then what is the full answer then? It is 1 ball delivered 6 times. In a situation where team batting first gets all out, in that case, in that last over, it will be less than 6 deliveries. In a situation where the team batting second hits the target or it's all out, then also in the last over, it will be less than 6 deliveries. In wide and no ball, where there are extras, there will be more than 6 deliveries. In the situation where a ball is hit out of the ground and due to practical circumstances, the ball cannot be taken back and the umpire decides to substitute with a new ball, in that case, in an over, there will be more than 2 balls being used. This is the answer. Of course, you will get to know only when the institute releases the suggested answers. Till then, we will not know this one, but point is, the length of the question or length of the answer should not frighten you. Just be prepared. The length of the question will be very, very big, especially in the CA question paper. FR is the paper number 1, because after a long time, some of you might be writing the paper, you're not used to your regular speed yet, and suddenly one big question will come. You don't know which topic it is, which area it is, and that is the purpose of institute preparing the question paper. First, to give you the shock treatment that I cannot do it. That's how they frame the questions. They don't frame the question, let's test them conceptually, all those things they tell, but the reality is this: can we shock the students, can we surprise the students in exams? It's like first ball bouncers. If you are down with that first paper, the rest of the papers, rest of the examination is gone. It's all about confidence play. The confidence is not about knowing all the answers. The confidence is being prepared to face any questions. There are a lot of differences. So when you see the question like this, first tell it to yourself: this is within my control. You have to have that confidence, and you have to tell it to yourself, and that confidence you have to give it yourself. No inspirational quotes, nobody else, no videos, nothing else can help yourself but yourself, because the only person who comes with your examination is yourself. Nobody else will come. No girlfriend, boyfriend, no parents, no teachers. Only person who can help yourself is yourself. The only thing which I can request is, when you look at the lengthy questions, especially in FR, don't lose your heart. I've seen so many students in examination, they say, I don't know what is happening, my mind went blank, but once I'm out of the exam hall, I see the question paper, I can easily recollect the answers. The reason is because of the time pressure and the examination pressure. So only thing is, have confidence in yourself. And one more small point, If you're not able to solve 100 marks, that's okay. You attempt for 80 marks. Go with the mindset, I'll attempt for 80 marks. I know people will tell, no, no, be optimistic. These inspirational people will tell, no, you can do everything good in life. No, we are accountants. We follow prudence principle. And I'm a financial management person. I look at neither pessimism not optimism. I'll want to be realistic. When you go to the exam hall, accept I will write only for 80 marks. Once you reduce your expectation, the way you read the question, the way you manage your time becomes different. Does not mean whole 3 hours you write your consolidation paper, consolidation problem. That's not the purpose. But when you read the question paper, read the question slowly, comfortably. You are having that ability. One small point I'll tell, then I'll go further. The difference between classroom and this examination is this. Classroom is like film theater. You see, projector is also there, and somebody else is performing. And what you're doing, you just sit, you watch, you enjoy. Nobody will ask you anything. But examination is not film theater, it is operation theater. Anesthesia called as question paper will be there. You don't realize any pain because anesthesia is on. Once you start exam hall, the two friends will be discussing how much balance sheet total you got. One student will tell 1,20,000, another friend will tell no, 1,25,000, and you would have got 13,40,000. Where there is no connection. Of course, after 2-3 months, results comes, operation success, patient died. Passed in all the subjects, but still failed. Okay, let's read. Let's not spend any much time. Defense Innovator Limited is a public sector undertaking and is engaged. I thought only people are engaged. Companies also engaged in the construction of warship and submarines. You see how they build up. It is not at all required for the question, but they give it to you. But if you write that like that in exam, this is not to the point. Scratch his answer mark. Don't give him marks. XYZ Private Limited approached the Defense Innovators Limited for construction of specially designed ships for it. Okay, they are producing warships. What a timing. There is war going on and they're giving the question on warships. XYZ Private Limited, some customer approached your company for construction of specially designed ships for it, which will be used by XYZ Private Limited for transportation of specific goods. The offer was accepted by Defense Innovators Limited, and both the companies entered into agreement for the construction and delivery of 3 specially designed ships, fixed price basis, with variable component in respect of certain items. At this point in time, tell me which standard it is. Construction, transportation, fixed price, revenue recognition. Okay, let's read. Base and depot B&D. Who these are people coming from? Okay, spares for all the 3 ships are all procured by Defense Innovators Limited and will be paid on the cost of an item with certain percentage. Okay, they are giving some spares. Fine. The contract states certain equipment out of variable cost items will be supplied by XYZ Private Limited free of cost for installation on board of the ship. It is therefore to be noted as under. The contract states XYZ Private Limited, who is the customer, will provide free of cost for installation on board of the ship. So you are constructing ship for them and they are providing some equipment which will be used for installation, and they are not charging anything for you. Why will they charge for you? It is their asset, no? I don't know whether you understand the irony of this. You are giving something to them and they are bringing, and they are not charging for us. It's like telling you are coming to class, you are bringing your book and you are telling, sir, I will not charge you anything. Why will you charge you? Why will you ask me to charge anything for your book? It's your book. Same thing here. Unfortunately, you don't think like that in exam. Some equipments are procured by the Defense Innovators Limited in the presence of XYZ Limited's representatives for technical survey as well as negotiating prices. Okay, it is under their supervision. The vendors of this company are paid by Defense Innovator Limited. The cost of the equipment along with the cost of installation and profit thereon is claimed and reimbursed by XYZ Private Limited to Defense Innovators Limited. Okay, some cost is incurred and then it will be reimbursed. There are certain other equipment for which the orders are directly placed and also paid by the XYZ Private Limited. Okay, there are something under supervision and there are some which are direct purchases. These equipments are known as buyer furnished equipments and are delivered to the company free of cost for installing in the ship. The labor cost of the installation of these are already included in the price component of the contract. BFE. What is this? BFE. Okay. Buyer. They are creating their own short forms there. Buyer furnished equipments are returned to the buyer after completion of the ship. Okay. The labor is already included and are returned to the buyer after completion of the ship. The period required for the construction of one ship approximately 4 years. Whether the cost of the buyer furnished equipment supplied by XYZ Private Limited to defense innovators, whether the cost of the buyer furnished equipment supplied by XYZ Private Limited to defense innovators for installing the same in the ships can be considered as inventory by defense innovators, and then delivery of the ship will be recognized as revenue in the books of accounts. Elaborate. This question is like this. Let's say you have given the contract to somebody else to construct a house, and they were supposed to give you the delivery of the house, and in your house you wanted some special equipment, and that you went yourself and installed it, or you purchased yourself and gave it to them and they have installed it. Now what they're asking, that equipment in the construction, does it belong to the construction company? Should they show it as their inventory? The clear answer is no. So this problem is not AS2 inventory. This problem is not revenue. This problem is not fixed asset. This problem is on framework about definition of assets. So what gives you marks in exam is, were you able to write the definition of an asset clearly? You say that asset definition is a economic resource controlled by entity having future economic benefits as a result of past events. 3 tenses are there. And looking into this point, in the given situation, these are returned to the buyer, which basically means you are not owning it and you have not spent any money. It is not under your control, and therefore it is not your asset. And if it is not your asset, the question of showing as inventory do not arise, and even the cost cannot be considered because you are not paid anything for it. So definition of an asset is ultimately is what being applied here. The reason why I include this question is just to tell you how your confidence will be shaken in the exam with the length of the question and complexity of the data, complexity of the information involved, not the concepts. Stick to your basic concepts. See which concept you can connect you are through in examination, and you are not required to state the paragraph number as it is from the standards. You are just required to state the relevant areas, and you should use the technical words. You may not know the definition of an asset as it is. Here and there it can change, but are you able to establish the word resource and, more important, the word controls? Those are the technical words. And you see, what do we do it in consolidation? One company can control another. As per Ind AS 115, when the goods are to be transferred, when it is moving from under the one control to another, when the control is transferred, the word control is having the relevance in so many standards. So these are the technical words they expect. You use those technical words, apply the concepts. That's all what is required in exam. And how to present the theoretical answer like this? Simple 3-para approach. For accounting standard, you can also apply that for law and for any case study based questions. 3-paragraph approach means, first paragraph you talk about the facts of the case. It's like rereading the question paper again. You are rewriting the same thing in active voice, passive voice. Second paragraph is about the content of the standard and compare with the given situation. And last, you write the conclusion. The only sincere request I have is, please make sure you write the conclusion at the end. Don't start with the conclusion. That's a very bad, not a professional approach. Many times, even if your answer is right, the evaluator may not give you marks because your approach is not right. You're starting with the conclusion. That is what the politicians do, having biased mindset. We cannot have it. We should always have the conclusion at the end, and even if your conclusion is wrong, you might get marks. Analysis is more important. Anyway, this is one example towards that. Let's go further. This is also RTP May 2022. Let's read quickly. Again, you look at the length of the questions. That is where all your confidence will be wiped off in a fraction of a second. Fresh Vegetables Limited was incorporated on 2nd April 2001 under the provisions of Companies Act. Of course, under the provisions of Companies Act, to carry the wholesale trading business in vegetables. Name of the company is Vegetables. What will they do? Trading vegetables. As per the audited accounts for the financial year ended March 2007, approved in the AGM on 31st August 2007, its net worth, first time since its incorporation, exceeded 250 crore. Okay, this is the point. Net worth exceeded 250 crore. So when you write the solution, how do you start? In the given situation, company's net worth exceeds 250 crores. That's what you write when you're rewriting the facts of the case. The financial statements since inception till financial year ended 31st March 2006 were prepared in accordance with company's accounting standard rules 2006, which means as per accounting standards. It has been advised henceforth it should prepare the financial statements in accordance with the company's Indian accounting standard rules 2015 because their net worth is exceeding 250 crores. The following additional information is provided by the company. FPL has in the financial year 2002-03 entered into a 60-40 partnership with Logistic Limited, incorporated a partnership firm, Vegetable Logistic Associates, to carry on the logistic business of vegetables from the farm to market. FEL also has an associate company, Social Welfare Limited, that was incorporated in July 2005 as a charitable organization registered under Section 8 of the Companies Act 2013. Social Welfare Limited has been an associate company of FIL since inception. Examine the applicability of Ind AS on VLA, SWL. Basic question is, does Ind AS apply? Definitely for FEL, Ind AS will apply because their net worth exceeded 250 crores. The question is regarding their joint ventures and associate. Associate company definitely applies. There is no second thought. But regarding this joint venture, 60-40 partnership, there exists the nature of joint venture. Is it in the nature of joint operation, or is it in the nature of joint venture means joint operation where the rights are defined regarding assets and liabilities? If it is not defined, if it is in general entity as a whole, it becomes joint venture. For a joint venture, this Ind AS applies. If it is joint operation, Ind AS don't apply. That's what they say. Okay, this is the content of the standard. They're repeating it. The word would be used here on VLA. If it were a joint operation, if it is a joint operation, then Ind AS would not be applicable. And if it is joint venture, then Ind AS would be applicable. So you have to write a conditional answer. They will give you the choice in company law and all. You give them the choice in accounting standard, meaning you write both the possibilities when you are not sure. Or if you want to give one answer, you know what you should write in the exam. It may appear or it seems that it is joint venture because there is a separate entity being formed. Because partnership firm was formed, right? They formed a partnership firm. You can say it's a separate legal entity, and hence it seems in the nature of joint venture, and hence Ind AS applies. Don't give conclusive answer. Seems appropriate, maybe. Use those soft, sugar-coated words. Okay, so that's all regarding this problem. Okay, Ind AS 1, quick overview. It provides the formats basically for financial statements. See, we have Schedule 3 format, which gives the format of balance sheet, P&L, notes to account, cash flow statement, and those things are provided by Ind AS 1. Ind AS 1 says that it is applicable to both consolidated as well as separate financial statements. It includes balance sheet, P&L, OCI, cash flow statement, changes in equity, notes to accounts. The main purpose is fair presentation and compliance with Ind AS. This is one specific point you should keep it in mind. The companies should specifically state a unreserved and explicit statement that the above financial statements are prepared in accordance with Ind AS. The statement should be specific, explicit. it cannot be implied. The compliance with Ind AS. If they have not used the word Ind AS, that means it is not following Ind AS. They have to use specifically. And main other points, hope you are aware of it. I don't want to repeat it. Going concern, that means there is no intention nor necessity to liquidate the business in the foreseeable future. You have to use the word foreseeable. That is the technical word. Everybody knows that you are going to die one day or the another. You still come to the class. Because your foreseeable future, you think that it has to be better. Nobody lives here forever. Accrual basis, account it as and when happens, not waiting till its actual payment or settlement. Consistency, apply the accounting principles from year to year without being mentioned. These 2 points, be careful: materiality and offsetting. Materiality means what is relevant, what is significant, which will influence economic decisions of the users. That is what is material. Offsetting, if the company has the right to set off, then the liability and assets can be set off. And comparative information, we usually provide 2 years, but in situation where there is change in accounting policy or wherever there is a requirement of restatement, in the sense retrospective effect, we provide 3 financial statements: current year, previous year, beginning of previous year. 3 years comparative whenever there is a change in accounting policy or whenever there are restatements and reclassifications. Okay, so that is the main application of Ind AS 1. Again, this actually is like AS1 plus Schedule 3. Entire Schedule 3 is applied with Ind AS. One small point of clarification: if there is a conflict between Schedule 3 format and Ind AS format, which will prevail? Our regular understanding, the Ind AS is a subset of Companies Act, so Companies Act will prevail. But you read the Companies Act Schedule 3, it starts with the word notwithstanding, or they say subject to. Why? You should understand a little bit. Any idea what was the format of our balance sheet before Schedule 3 came into picture? It was called as Schedule 6, revised Schedule 6. Before revised Schedule 6, it was Schedule 6. And we had a horizontal format, not a vertical format like this. And there we made a change to Schedule 3 as a part of a step towards convergence. So the Schedule 3 is introduced mainly for the purpose of IFRS. And if there is a conflict with Ind AS will prevail, not the previous Schedule 3. All other understanding is true. If Schedule 3 and Ind AS, if there is a conflict, Ind AS prevails. Keep that in mind. And regular format of balance sheet, P&L, you should be aware of it. Yes, in this context, you should know. I hope you know the definition of current assets, current liabilities and all. Anything within realizable within 12 months is current, realizable beyond 12 months is non-current, and 12 months is an indicative number. We use the word operating cycle. Operating cycle means the raw material holding period, WIP period, finished goods period, debtor collection period minus creditors. Yes or no? No. Creditors we don't subtract. It is gross operating cycle, not net. Your financial management principle is current asset minus current liability, working capital. Here only current assets. So when they are asking you to compute operating cycle, do not subtract liabilities. It is gross operating cycle. Few small points in DS1 we should discuss. That is, operating cycle is fine. This one section you have to understand, that is OCI, other comprehensive income section. So in addition to a regular P&L account, we are introducing this section called as OCI, which reflects basically what we used to call extraordinary items, not in normal course of business, profit on sale of fixed asset, like, which is not in normal course of business, which are not recurring in nature. They will be part of OCI. In this context, there are 2 types. You should be remembering it. Just 1 second. I should have that list. Okay, I'll take it from material and put it here. Okay, this was supposed to be discussed earlier. Anyway, I'll discuss it now. There are two types. One is called as with recycling, and another is called as without recycling. This chart again should be there in the material, in my material, or even in the PDF I've shared. This will be there. You should remember this list. What will be part of with recycling, what will be part of without recycling, or what will not be part of P&L, what will be part of OCI. Because one or two exam they've asked that question. Classify the following items which will fall into P&L and which will fall into OCI. This table will, or this chart will help you. With recycling, without recycling means, with recycling initially it will go to OCI. Without recycling also initially it will go to OCI. Initial recognition is same. But subsequent, what will happen is, with recycling, once it goes to OCI, it will come back to P&L and then it goes to reserves and surplus. Examples are, in the financial instrument we are going to discuss, like instruments in the case of FET OCI, classified as debt financial assets as FET OCI. Any amount accumulated in FET OCI, first we transfer back to P&L and then we transfer it to regular as a part of it general reserve. Exchange difference in case of FCTR, that is foreign currency translation reserve, in case of the foreign operations. When you accumulate in FCTR, then also it will be transferred to P&L account as a recycling process. And in case of hedge accounting, cash flow hedge reserve, in case of forward contracts, then also it will be with recycling. Without recycling means it will not be coming to P&L, directly it goes to balance sheet under reserves and surplus, general reserve. FET OCI classified as financial assets, revaluation reserve on fixed assets, remeasurement difference applicable in actuarial valuation in employee benefits, gain on bargain purchase, Ind AS 103. These elements are without recycling. What I would recommend is, don't remember both. Remember one of them and leave remaining them is without recycling. So what you do is, with recycling you remember, which are FET OCI, then FCTR transfer and hedge accounting. Rest are all are without recycling. Just remember these elements, which are easy to remember than by hearting everything. With or without, you're asking? These are the exhaustive list. Only one more will come, that is share-based payments. That will be when we have that will go to general reserve. I would say 90% at least this will be covered. From exam point of view, this much is sufficient. I cannot say 100% because the standard don't cover this point. It will cover in different standards. Whether it will go to OCI or not, I try to accumulate in one place. For exam purpose, it's sufficient. And remember these items to the extent possible, both also, it will come in FET OCI. Okay, so this is the table. Keep it in mind, required. Sorry, one more point I should discuss. Maybe 2 points before we go further. That is, this is refinancing or rollover from current to non-current. It is current liability, but entity has postponed. They have converted into long term, or they can convert into long term. That's called as refinance or rollover, transferring. If entity has the discretion, of course, if entity don't have a discretion, then straight away it is current. If entity has discretion, then you check whether when was it agreed. Just a discretion is not sufficient. Have they exercised? If it was agreed after before the end of financial year, then we'll check further. If it is after the end of financial year, means that it is not discussed in current year, it is going to be in the next year. This year it will be non-adjusting, means current. Entity has a discretion, agreed before the end of financial year, and a facility from the same bank. Basically 3 points. all the 3 points should be satisfied. Entity should have the choice. The choice has been exercised or used within financial year, and it is given from the same bank. It is not from substitution from some other bank. Agreed with the absolutely legally the same bank, then you can change from the what you're showing now current, you can change it to non-current. If any of these points are not satisfied, it will be under current itself. This is one area which has not been asked in the exam frequently. They can still be asked. And there is one more problem, which is one more area which is reverse. In the sense, it is long term, but it can be converted into short term. That's called as the breach of covenants or breach of provisions of a long term arrangement. That kind of questions have been asked in the exam already. So this is the area which is untested in the exam so far. Just remember 3 points. All the 3 points satisfied, you are continue to be non-current. Even when you are going to be non-current, even if one condition not fulfilled, you'll be continuing to be current. Anyway, breach of covenant, what they say is, this is very typical in Indian context actually. In the loan agreement, there will be some conditions that a promoter should fulfill. Promoter fails. And what will happen if he fails? As per the rules, the non-current becomes current. But what do? We go to the branch manager house. We take care of him. We fulfill all his demands. And we will reverse whatever happened. Or we'll ask him some more time. So we look for, if there is a breach, look for the grace period. And if the grace period is within 12 months, it will be current. If the grace period is beyond 12 months, it is non-current. And if the breach is happening in the next financial year, again, don't check it in the current year. It will happen, it will be given effect only in the next financial year. Yes, that is regarding the breach. No grace period means it will be again current. And actual breach is only to be considered. Anticipation of breach is not considered in this case, which means it is likely to be breached, like an anticipation bail. You go to manager house and you fulfill his demands and you ask extension. He say, I'll give you only 2 months. That is not grace period. Grace period comes when there is breach and then you ask for extension. Before extension, if you take anticipatory bail, you are saved. In the sense, these things don't apply when there is anticipation of breach. Only for the actual breach, this point will apply, means you can continue to show it as non-current. Okay, so this point you have to remember. Let's go further. Okay, so this is November 2021 MTP question. A holding company, being entity under consideration, gives loan or deposit to a subsidiary that is recoverable on demand at the rate of 10%. Such loan be disclosed as current or non-current in the books of holding company. How relevant would the commercial reality of the transaction be compared in legal terms of the transaction? How this loan, intercorporate deposit, is repayable on demand would be classified in the books of the subsidiary. Okay. Now, first point is, should this be classified as current or non-current? Asset, of course, it's an asset because they have given loans. Okay. This is on demand. So if you purely apply, it is recoverable on demand. It is classified as current. We write that sentence. That is, we write, if the transaction is purely on the terms recoverable on demand, it is classified as current asset because it is within 12 months. Anytime it can be payable. It can be recoverable. But one more sentence. This is one sentence you should write. But one more point is there. How relevant would the commercial reality of the transaction be in comparison to legal terms of transaction? Commercial reality. What is this commercial reality? It is repayable on demand, but is it realistic? On the legal terms, it is repayable on demand. In the real terms, I don't know. You can't say yes or no. They are just told recoverable on demand. The practical circumstances you don't know. Just asking, any of you are in your parents' house? I mean, not in your name. It's not in your name. I hope at least at this point in time. So if I ask you this situation, at any point in time, your parents can kick you out of the house. You have not even thought about it, no? It can happen. That's what I mean by, is it commercial real? It is not. It is likely to happen. It is not. But legally, yes, they have every right. It is in their name. That's what they're asking here. Recoverable on demand, yes, that is a legal terms. But commercial reality, they have not told whether yes or no. But what we should write in the examination is commercial reality to be considered. That is, in the sense, if it is realistic, or if the probability is high that it is recoverable on demand based on the past experience, then it may be considered as current. Or if the commercial reality is, it is not regularly asked, it is given with the subsidiary itself, then it will be as non-current. See, that's what they would have given. To determine the expectation of the entity, the commercial reality of the transaction should also be considered if the loan have been given in the understanding that the loan would not be recalled in an understanding. That's the understanding you have with your parents, that you will not be kicked out so easily. For repayments, even though a clause may have been added that these are recoverable on demand, it should be classified as non-current. A clause is there, that's only legal terms, like a substance over form we apply. But while determining current non-current, you should be aware of the fact of the commercial reality. So technical words that you can write in exam is commercial reality. Now use these technical words. No, see, you have Tirupati laddu. However tasty the laddu may be, small cashew nut over there, no, they always enrich the taste. Examination also, however beautiful your answer may be, these small technical words when you use, it gives a pleasure for the validator, not the pressure for the validator. So use this word. So wherever possible, try to use here. Don't use only of them. The only cashews means again the taste of the laddu will not be there. It has to be 1 in 100, 1 in 10. In sentence it should come. It should feel good and not just the cashew itself. So commercial reality is a technical word. Try to make use of it. How this loan intercorporate deposit is repayable on demand would be classified in the books of subsidiary. Vice versa, it's a liability. But should the current, should that commercial reality be considered from their point of view? There we apply more of prudence principle, because you are taking loan. So there, I know they may not ask, but you should be ready. You should be ready to pay any time, and therefore here we will be classifying it as current liability, because you don't have the unconditional right to defer. That is a technical word you can remember. Unconditional right to defer the settlement. So commercial reality we don't apply, because here it's about from the borrower point of view. For borrower, we apply prudence principle. Repayable on demand, anytime they might change their mind, we should be ready for it. So anytime your parents might change their mind, be ready for it. Okay, next. One more problem. Charm Limited, I think it is July 2021 exam question. See, look at the size. I have reduced the font, so looks in one slide, but let's read. Or I'll increase the font slightly. Charm Limited is a manufacturing company which is into manufacturing. This is what irritates me, but can't help. Manufacturing company which is into manufacturing. Wires and cables, and assets its operating cycle to be 15 months. The company has some trade receivable which are receivable within trade receivable within a period of 12 months from the reporting date. With respect to the following transaction which took place during the year 2020-21, give your opinion based on relevant Ind AS. The company has received a contract of 10 crores. The terms of the contract require company to make a security deposit of 20% of the contract value. 10 crore, 20% means 2 crores. The company made a security deposit of 2 crores. They could have told just 2 crores. They tell 10 crores. They tell 20%. They tell 2 crores. They use 3 sentence, means half of page may be in examination. This contract will be completed in 14 months. 70% of the deposit will be refunded immediately, and the balance 30% of the deposit will be refunded after 3 months from the completion of contract. The company wants to present the security deposit as 2 crore as non-current. Is the management decisions correct? So basically the question is, what is current, non-current? The 12 months criteria is not relevant here. We should look at the operating cycle of 15 months. The contract will be completed in 14 months. So if I look at only this, it is within operating cycle, it is current. But there is one small catch to that. 70% of the deposit will be refunded immediately, which means after 14 months, immediately. So within 15 months, it is current. The balance 30% will be refunded after 3 months. From 14 months, 3 months means it is 17 months, crossing 15, and therefore the 30% portion will be classified as non-current. So that's what they say. 70% is within the operating cycle. This 30% after 3 months, so it will be classified as non-current. That's the answer. The company has some trade receivables that are due after 14 months. Okay. From the date of balance sheet, the management of the company expects to receive the amount within the period of operating cycle. Despite the fact that these are receivable within 14 months, the management would like to present as current. Is the management decision correct? Again, we should look at operating cycle. Operating cycle is 15 months. It is 14 months. It is current. In the normal course of business, the company has given 2 contracts and received a total security deposit of 4 crores. 3 crore is received from X Limited. 1 crore is received from Y Limited. So 3 plus 1 is 4. These are repayable on completion of a contract. However, if the contract is cancelled within the contract term of 18 months, the deposit becomes payable immediately. The company is in positive about the contract with the XY Limited, but is in doubt whether contract received from Y Limited or XA confident, Y Limited not confident. The company wants to present the amount of 3 crore as non-current, 1 crore as current in the balance sheet. Is the management decision correct? Okay, so what is the technical word we have used regarding liability when you accept a deposit? Unconditional right to defer the settlement. Again, same word we use here. Is the company having the unconditional right? It is positive. Yes, you think positive, no problem. But the standards we use the word unconditional right, which is not there here, which may be payable. We don't know when they change their mind. So when you are a borrower, you don't worry about the positive negative thing. You simply show it as current liability. If you are an investor, depositor, of course, I hope you understand, right? This is the liability. You have received a deposit. So for you, it is a liability, not an asset. Just keep that in mind. So it's going to be current liability. The company is planning to replace machinery. Okay, they're planning to replace. It has given in advance of 1 crore for purchase of new machinery, which will be delivered in 6 months from the date of balance sheet. It has sold old machinery for 0.5 crores, payment of which is due in 10 months from the date of balance sheet. The company wants to present both this amount as current since they will be settled within 12 months from the end of reporting period. Is the management correct? Yes, it is straight away. When it is within operating cycle, it will be classified as current. So statement is correct. But regarding this point, I have to explain. Advance given for machinery, no, advance will be not shown under current, because as per schedule 3, as per the format of schedule, you can say Ind AS 1 also, advances is shown under non-current assets, a specific line item. We have PPE, we have intangible assets, capital work in progress, intangible assets under development. So that advance portion alone, we don't show it in current item, we just show it under PPE, under non-current assets. That's one we have to show it. The advances only portion will be shown under non-current assets because of that specific format which is given under Ind AS as well, not as per schedule 3 per se, but more as per Ind AS, because of the format given. Advances given, no, all the three, all the four. First is PPE, second is intangible assets. These are completed. When fixtures is in progress, or when you give an advance, that is called as capital work in progress. If intangible assets is in progress, that's called as intangible assets under development. But if you have paid any money in advance, separate line item will come as long-term loans or non-current loans and advances. So basically it will be shown under loans and advances. That's what this point is saying. Again, para number and all, you don't have to worry about it. Okay, so these are some of the samples on Ind AS 1. The last point is actually slightly controversial because Institute says it is non-current, but I am of the opinion, you can have both opinion, because purely advances recoverable within 14 months within that period, it can be under short-term loans and advances. Because loans and advance, I'm not denying it, it can be under short-term, but their argument is it's towards fixed assets. So ultimately that fixtures will become non-current, so more appropriate to show under non-current assets. So both are fine, whichever is more appropriate, right? But be stick to the Institute solution, more safer. Institute solution, they said non-current, we'll show it under non-current, and we'll use the technical word capital advance, advance towards fixed asset. The word is capital advance. Okay, next standard, Ind AS 34. I think this is one more problem we have. At least in accounts, the number were consecutive, 1, 2, 3, 4. Now Ind AS ruined that life there also. Some random numbers will come here and there. 34. Suddenly we were doing Ind AS 1, now suddenly Ind AS 34. I'll try my level best to make you remember. I hope remember the numbers, but if not. So how to remember interim financial reporting? Normally, to which company do you think this standard would be applicable? Listed company who have to prepare quarterly financial statements. So quarterly means there are 4 quarters, and to have 4 quarters, if you write in a box, how many cut you need? If you have a box, you need 3 cuts, no? You get 4 boxes. So 3 cuts, 4 box, 3, 4. Interim financial report. You're not imagining, no, what I'm telling, where is coming from. Okay, so what is 3 plus 4 then? That is going to be our next standard, which is cash flow statement. We have something called as borrowing cost. In English, if I say A, B, C, borrowing cost, so A for 1, B for 2, C for 3, B borrowing cost, C, B2, C3, 23 borrowing cost. In income tax, which standard we talk, or which section in income tax talks about general expenses and liabilities? Section 37, Ind AS 37 is liabilities. When you want to do, for example, let's say agriculture, where do you do agriculture? You do in land only, So first of all, property as a land, Ind AS 40. And once you take a property, first as a human you started is agriculture, Ind AS 41 is agriculture. So 40 is investment property, 41 is agriculture. Age 19, it's actually proper age to get wages, salaries and all. After age 18, you cross it. So Ind AS 19 is employee benefits. And income tax, you write I and then write tax T. I looks like 1 and the tax T means 2. So Ind AS 12 is income tax. And if I reverse it, 21, that becomes foreign exchange rates. The reason is, as per AS 11, we have one home currency, one foreign currency. But in Ind AS, there are two things. One is a functional currency, other is reporting currency, and then foreign currency. 2 and 1, so 21. Effects of changes in foreign exchange rates. Then we have intangible assets. Now, intangible asset, the sounding asset, it looks like 8. So, intangible Ind AS 38, asset 8. You can imagine like that, any standards you'll be able to come up with. In revenue from contract with customer, there are 5 steps. Essentially construction contract, so construction looks like 11. Then 5 steps, Ind AS 5. And accounting standards, do you know what we had for fixed assets? Not in Ind AS, but in your intermediate, AS 10, and you had depreciation under AS 6. Now both of them put together is Ind AS. Ind AS 16 is property, plant and equipment. See, when you read the standard, the concept should also come in. You should always be able to connect it. And we have accounting policies. Policy means we write like this. If I write it together, it looks like A, then P. So if you keep writing like this, it looks like 8. No? So accounting policy is 8. And then we have event occurring after balance sheet date. We'll discuss that, but quickly I'll tell you the concept. What is event occurring after balance sheet date? As on balance sheet date, there has to be a condition existing, and after balance sheet date, there has to be a condition which is connected with that condition. Right? So looks like 10. So condition existing is 1, and then some event should happen later connected with this condition. So 10 is Ind AS 10. And in English, usually we say 13 is something unfair or unlucky. We make it as fair. So Ind AS 113 is a fair value measure. Okay, so let's go further on interim financial reporting. So basically, this point, the standard talks about does not tell when you should prepare interim financial reporting, but whenever you prepare interim, if you choose to prepare interim financial reporting, then you should follow this standard rules. Contents are all condensed balance sheet, condensed P&L account, and so on. You have to make a specific disclosures. Yes, please. Significant events. Are you final FR or some other class? Yeah, just find a place and try to manage. Significant events from the last financial thing we have to disclose. You have to state a specific statement that accounting policies are followed, same as annual. Disclose dividend paid. Balance sheet, we prepare 3 balance sheets. One is the current period and preceding financial year. Whereas P&L account, we provide current period, and also we provide the cumulative year to date. That is one extra thing. The question of cumulative for balance sheet does not come, because balance sheet itself is cumulative. So we don't provide any separately for balance sheet, but for P&L, one for interim period, one for preceding period, and one for cumulative, and comparable also we provide. Regarding measurement, you have to apply same accounting policies. If you change accounting policies, you have to restate. Okay, this is what you remember. Which can be deferred, which cannot be deferred. Or while explaining, I use the word integral approach and discrete approach. AS used to use the term, Ind AS don't use it, but concept is same. Discrete approach means we treat this expense or income as an independent item. Integral means you are part of the annual and we do it proportionately. Example I'll give you quickly. I'm sure you must have done it in your articleship. What is the difference between section 192 TDS and 194J TDS? 194J professional, which means any payment we deduct percentage, whether next previous payment does not matter for us. But salary TDS, we estimate the annual income, we calculate the estimate tax, then we take the average rate. So we don't take the month as an independent month. We treat the month as a part of the full year. That's called as the integral approach. So when you pay rent for the full year one time, I cannot recognize in that period only. I have to apportion it. So there I'm treating it as an integral approach, which what they say, which can be deferred. Regular outflow like rent, salaries, income tax expense, we calculate average rates, which can't be deferred like bad debts, which occur at a specific point in time. We call it as the discrete approach. Same thing applicable for income. Royalty, dividends, which can't be deferred. Subscription fees, interest income can be deferred. Remember the words the integral and discrete will be easy for you to remember, but don't use that word in exam. That's only for your memory purpose. Few specific items also they can ask. I'll quickly run through it faster. Like annual payroll taxes, we apply average tax rate. Any major planned periodical maintenance is there, you incur as and when it incurred. In the sense, if you're planning to purchase fixed assets after 2 months, you don't record it now. You purchase only, you record only after actual purchases have taken place. Short-term compensated absence, that is depending on accumulating, non-accumulating, we discuss separately. Bonus, yes, we provide for expenses. Provisions, we provide depreciation on the assets owned, not to be owned. And foreign currency translation, we simply account as per Ind AS 21. Reversal of impairment loss not allowed on goodwill. We discuss under impairment. You will get this point better. So not a complicated standard, but typical questions you can expect in exams are two kinds. One or maybe three kinds. One is on the average tax rate. They'll tell you like up to 1 lakh some tax rate, beyond 1 lakh some tax rate, like a tax slab. You calculate the tax expense, you calculate the income, you take the average rate. One variety of question. The second variety of question will be on the absorption of overheads. How many units expected, what is the annual fixed cost, you get the rate per hour. Then you calculate the absorbed overheads, under absorbed overheads. Second variety, we'll take a problem on that. And third variety would be which items are deferred, which items are not deferred. You have to prepare the corrected financial statement, corrected P&L account. So these are the three variety problem you can expect in Ind AS 34. Beyond that, don't worry about this standard much. Let's do this problem. Then we'll go to next problem. Heavy Limited has a planned capacity July 2021 problem. With a normal capacity to produce 90,000 units of a product per annum, expected fixed production overhead for the year 18 lakh, there are no quarterly or seasonal variations. Hence, the normal production for each quarter is uniform. The actual production of the year is 87,000. The production details of each quarter are as under: quarter 1, 2, 3, 4. Quarter, don't think some other. This is number of months. Calculate the allocation of fixed overhead for all the 4 quarters. So 4 quarter is equal to 1 full year. Again, so when you're doing this problem outside home, outside the class and all, just be careful. Others may have a different full forms for these things. You'll take quarter 1 so much, quarter 2 so much. Others may not feel good about yourself, especially when you are doing this at home. Sometimes happens, you might be doing some full-fledged balance sheet or cash flow statement, and you will tell like BP increased from 50,000 to 60,000. If there is a medical student sitting next to you, they will get heart attack, BP 50,000 and all. So at your energy, don't tell outside, control yourself. Will the quarterly result affect the annual result? Give your answer as per Ind AS 34, read with Ind AS 2. Okay, we have to read Ind AS 2 and all. Fine. So what we have to understand is, first we have to calculate absorption rates. What is the total number of units? Capacity to produce 90,000. The actual production is 87,000. So which one we are going to use? Normal production or actual production? Whichever is higher. Not the maximum. Maximum capacity is different. Normal capacity or actual capacity. So whichever is higher. So 18 lakh divided by 90,000. Which is I think 20 rupees per unit produced. And every quarter, how much you are going to incur, because they said no seasonal variation. So directly I can divide actually 18 lakh divided by 4. So how much you get? 4,50,000. I'll say 4.5 lakh. So first quarter, how much units you have produced? 20,000 units multiplied by 20 rupees, which means 4 lakh. But you are supposed to recognize 4,50,000. So 50,000 becomes under absorbed overheads. Second time 24,000. So 20 rupees into 24,000 means you get 4,80,000, and against standard absorption of 4,50,000, against 4,50,000 you have absorbed 4,80,000. So 30,000 will be over absorption, which is not prevailing in accounts. The concept of over absorption is not there because our blood is full of prudence principle. Costing you show under absorption, over absorption, whatever absorption. But for us, that's why I use the word actual or normal, whichever is higher. For the reason we cannot go with over absorption of overhead. So what we should do, I will set off with previous under absorption of overheads. Previous under absorption overheads was the 50,000. Now here 30,000, effectively 20,000 is I'm going to reduce it. Or what the institute does, they actually show a better approach. They show the calculation on cumulative basis. So they show like this. I'll show their answer. See if you're able to understand. Don't worry about the sentences. Just look at the table. I'll increase the size. Okay. Look at that. Actual fixed production overheads on a year-to-date basis. Year-to-date means cumulative approach, and keep this approach in mind. It will be helpful a lot even in Ind AS 115. When we recognize this cumulative catch-up basis is being applied. So we discussed that 18 lakh divided by 4. So first will be 4,50,000, then plus 4,50,000 9 lakh, plus 4,50,000 13 lakh 50, plus 4,50,000 18 lakh, cumulative basis. You keep adding up. Actual production, this is given 20, 24, 23, 19,500. Then actual production year to date on cumulative basis. So this is 20,000. Then 20 plus 24 is 44. Then 20, 24 and 23,500, 67,500, and add all 4 of them, you get 87,000. Then fixed overheads to be absorbed on a year-to-date basis. So what you're going to do? 4,50,000 divided by either 20 or 20. Oh, both are same. Huh? Actual production or normal production, whichever is higher. Actual production is 20,000. Normal production, again, normal production is anyway lesser. We already done it. No, normal production is 22,500. That you don't worry. So 20,000. So 4,50,000 by 20,000, you will get 4 lakh. Second column, be careful. 9 lakh is the actual fixed production cost divided by number of units is 24,000. 20 plus 24. This is actual production. What would be normal production? They are not showing the calculation there. We should discuss. Up to second quarter, what is the normal production? It will be 45,000 because 90,000 is full quarterly. If 2 quarters are over means divide by 4, 22,500 into 2, 45,000. 45, no, 90,000 by 4 into 2. Yeah, 45,000 is the normal production, but actual production is 44, whichever is less. Therefore, 9 lakh divided by whatever the rate. Your rate 20 rupees. No, we calculated 20 rupees multiplied by 44,000. You get 8,80,000. 9 lakh is what actual production. 9 lakh minus 8,80,000. Therefore, under recovery is 20,000. Or if you remember other way around, 50,000 under absorption, 30 was over set off, the remaining 20,000. 50,000 minus 30,000. If you understand in that sense. Or we'll do one thing. This table is there. I'll quickly write it so that you can understand in a more easier formats. You can present either way you want, but I will present like this. So we'll say quarters 1, 2, 3, 4. What is the expected overheads, which is 4,50,000 per quarter, because that is 18 lakh divided by 4, 4,50,000 per quarter. Then divided by recovery rate. Recovery rate will be same, which is 20 per units. Then we'll divide by and multiplied by actual units. Actual units are 20, 24, 20,000, 24, 23,500, 19,500. So absorbed overheads, which we multiply. 20 into 20,000, 4 lakh. This is 4,80,000. This is how much? 20 to 23,500. 4,70,000. And 20 into 19,500. 3,90,000. So what is under absorbed overheads? First case, that is expected minus actual, that is 50,000. And here you get minus 30,000. 4,50,000 was 4,80,000, so minus 30,000. So we will set off against the previous under absorption of overheads. And here 4,50,000 by 4,70,000 means minus 20,000. And last quarter 60,000 under absorbed overheads plus 60,000. So basically we are trying to tell this will be a debit to P&L, positive. This will be credit to P&L. It's not because of over absorption. It's a reversal of under absorption. I know it's same, but accounting we have to use different names. This also reversal, credit to P&L, and the last one is debit to P&L. Anyway, so you can present like this in exam, which is more convenient. You don't have to report on the cumulative basis. If that is comfortable, you can follow. I would follow this simple, straightforward format. Okay, so that's it with respect to this problem. ABC Limited manufactures automobile parts. ABC Limited has shown a net profit of 20 lakh for the third quarter. Following adjustments are made while computing the profit. Let's do one thing. As and when we read, let's discuss what kind of adjustments we should make. Bad debts of 1 lakh incurred during the quarter. 50% of the bad debts have been deferred to the next quarter. The bad debts should be recognized immediately. No question of deferral. Wrongly deferred means we should subtract. They have deferred 50%. Should not have been done. Recognized now itself. So we should subtract from whatever number adjustments minus 50,000. Additional depreciation of 4,50,000 resulting from the change in method of depreciation. Change in method of depreciation is a change in estimate, not a policy. So no question of any retrospective change. So you made a change, additional depreciation you recognize in that period. No retrospective effect. We don't say how much is relevant for current quarter, for previous quarter. We are not going for that. Basically here there is no adjustment. Exceptional loss of 28,000 incurred during the third quarter. 50% of exceptional loss have been deferred to next quarter. Again, wrongly deferred. Recognize now itself. So you should subtract minus 14,000. 50% of 28,000. 5 lakh expenditure on account of administrative expenses pertaining to the third quarter is referred on argument that fourth quarter will have more sales, therefore fourth quarter should be debited by higher expenditure. The expenditure are uniform throughout all quarter. You cannot link these expenses with sales. There is no question of deferral because you have to treat the interim fast reporting as if it's an independent standalone financial statement. So no question of deferring it because we would not have done it if it was annual statement. I can't do it for quarterly also. So it cannot be deferred. Is it fully deferred? So you should subtract minus 5 lakh full amount. So from the 20 lakh, these are the adjustments you have to do and ascertain the correct profit. After adjusting this, you get the correct profit. You can prepare in the table or institute has given a sentence like this. You can follow it both ways. It's fine. They can also give you the average tax rate related problem. I'm not doing it here, but I hope you're able to, or do you want me to give an example of that kind, average tax rate? Hope you can do it, manage. Okay. So we can focus on other areas. Okay, so Ind AS 7 cash flow statement, which is part of your previous life. You know, it is there in your IPCC. Long time back it was there, previous life only, because you had different girlfriend earlier, now different girlfriend or boyfriend as the case may be. So previous life. But just to recollect your memories, they keep asking this also in examination. After they asking examination questions, students now start preparing. Now what they ask, direct method of cash flow statement in examination, because you are prepared for indirect methods. Now certainly there's direct method. We'll discuss all those things quickly. The formats. Cash flow statement is about classification into 3 varieties: operating, investing, financing. Operating is normal course of business activities like collection from customer, payment to salaries, rent. Investing is related to the acquisition of assets or sale of assets, relating to the asset side of balance sheet. Financing means relating to the liability side of balance sheet, loan, capital, interest paid, and so on. I'll tell you a few activities. You tell me which activity does it belong to. Cash collected from customers. Operating, that also you don't have confidence. No? See, I know you have prudence principle, but our mindset is, I think somewhere something should be different. We don't go in normal course. Okay. Salary paid. Operating. Okay. Furniture purchased. Investing. Preference shares redeemed. Financing. Interest. I have not told expense or income. Okay, you assumed interest expense. Okay, good. It is financing. Interest income will be under investing activities. Cash deposited into bank. Contra entry, that is journal entry. No, I am asking in cash flow statement, where do we write contra entry? C and all. It is part of cash and cash equivalents. So when there is a change within cash and cash equivalent, cash flow statement is not affected. It's a very important point. Cash deposited, cash withdrawn will not have any effect on cash flow statement. 2 non-cash item also will not have effect on cash flow statement, like a machinery purchase, the shares issued. 2 non-cash items will not have effect on cash flow statement. Cash equivalent means anything convertible into cash within 3 months, 90 days without changing the value. That is insignificant risk of change, like investment in bonds, not in shares, not in preference shares also. Bonds, commercial papers we say specifically. So if you purchase commercial papers having maturity less than 90 days, which activity it will be? It will be cash equivalents, meaning it will not be part of investing activities. Commercial paper having maturity less than 90 days. USD converted into Indian rupees. Cash and cash equivalent. But there will be a change in the value of USD rates. which is the point which they'll ask in exam. That's the thing, no? We know 99 things. Institute don't ask this. The only one thing I left out, that only foreign currency left out, that comes in examination. We'll discuss that point as well. That is the important point as far as final is concerned. But still, format, I hope you're aware of it. Operating activities, investing activities, financing, net change you get, add the opening balance, you get the closing balance, and this should match with your balance sheet, cash and bank, cash equivalent. More often than not, it will not. So we have one small way out. In these three activities, where do you think you are likely to do more mistakes? Operating activities. So what do we do in exam? Anyway, you will know the ending cash balance. You write it from the balance sheet. Opening cash balance, you will know from the balance sheet. You write it. Closing minus opening, you write the net change. Financing activities you write, investing activities you write, balancing figure you write, operating activities. Reverse process, no? That is, if this is minus minus, while going back you do plus and plus, you write operating activities, you got the answer. But please don't write one line cash flow from operating activities. That means the evaluator think that you copied somewhere. So what we should do is, you should write the profit as per P&L account, add some tax, dividends, change in working capital, that is increase in current assets, decrease in cash, increase in current liability, increase in cash. Write all those things, but don't do the total. The total you calculate like this. What is an examination after all? It is a process of convincing the evaluator that you know the answer. So two things should happen. Correct answer should come and make it look like you got the answer. You write only one line answer, they will not understand the process you got it. So you should show the calculation. And evaluator will not have the time, patience, energy, interest to take the calculator and see whether the total will match this number or not. They have better ways of wasting time. And the two, to understand your handwriting, 7 looks 6, 6 looks like 10, 4, everything looks similar. He will not have the patience to calculate the number. So you write the reverse, you write the top, make it look like you got the answer. You know the rules, no? I hope it was taught in your articleship. What is 2 plus 2? A mathematician says 4, a statistician says there is 95% probability it is 4, a chart accountant says what do you want it to be. So that's what we want, that number will commit. All the shortcuts are subject to conceptual risk, so please understand the shortcuts before applying concepts in exam. If something goes wrong, I'm not responsible. Because the shortcut works, provided you write your investing activities, financing activities correctly. If there you go wrong, this will not add up. All the things will go for a toss. So just be careful. The format of these operating activities specifically we will cover when we do the cash flow statement of consolidation. There it will be a revision, and there will be even most new items will come, because you know, when holding company acquires subsidiary company, you issue shares or you might issue cash. If you issue shares, then assets comes in, like inventory comes in, shares goes out, it is non-cash. But cash coming in, to that extent it will be a part of cash flow statement. So small complications will be there. We'll discuss when we go to the consolidation. One more point, as I told you, what will be considered is the foreign currency reporting. Example, USD on hand. It will come in two places. One, it is part of cash and cash equivalents, obviously, and it will part of reconciliation. I'll give an example. Yes. Let's say this is the format. Don't worry about the line items. Just imagine the format. Cash flow from operating activities, investing activities, finance activities. Under that, some line items. Net cash flow, add opening, you get closing balance. Now we'll talk about the foreign currency exchange rates. It will be in two places. It will come in operating activities, and it will come as a part of reconciliation after opening, before closing. Two places. For example, if there was a loss, in the sense opening balance was 62, closing balance is 61. I think now we should talk about 70s, no? It is now 77, I think 76 and 75. I'm still in that 60 age. That's where I cleared the exam. Maybe soon we'll get 80 or 100. Let's see. 76 becoming 75, 1 rupee loss. That loss I would have taken to P&L account. I would have subtracted already. I want to remove it, nullify. It was subtracted earlier, therefore now I'm going to add it. So it will come as loss on foreign currency in hand, unrealized loss will be added. And it was a loss, like in this case, I'm going to add back. So loss would be, if nothing else was there, there would be loss of -1 on this exchange difference. I'm going to do +1. Effectively, this becomes now 0. But this loss should be reported still, and therefore I'm writing it here as a reconciliation. I'll write it here. Should go a little bit above. Loss on foreign currency in hand -1. It should be 75. It should be between that, is what I'm just trying to focus. You know, it is below opening quotient cash equivalent, above closing. You know, it used to be called as like Trishanku Swarga. I don't know whether you heard of it. Like, it is neither in air, nor there, nor here, in between, like you are now. You are neither employees nor students. In a way, you are student, because whenever you go to your boss or manager or your principal and say, can I have reimbursement? Can we expect increase in stipend? They say, you are students. Is that exam over? When is your exam? Did you revision class over? You become student. And whenever you ask for study leave, you become employee. Is that audit format done? Is this work done? Have you handed over? You are in between. You don't know whether you are an employee or you are a student. Like that, here we have a place for loss in exchange, that is below opening, above closing. I'm going to do +1 here. We are going to do -1 here. That reconciliation is what this cash flow statement all about. If it was profit, I'll add and then I will subtract. If it was the foreign exchange difference on other items like debtors exchange, loan exchange, I'm not going to touch it. This is only exchange difference, that too unrealized, relating to opening balance as well as closing balance. So this is one point. Somehow they keep asking in exam, so I wanted to discuss it. Okay, so okay, fine, good. Okay, so let's start. Consolidation. Okay, good, welcome. Things will drop in my class, not a problem. Sometimes unintentionally, sometimes intentionally, no issues. So first thing first, consolidation. What is the real confusion? What is the real problem? I know consolidation itself is a problem, but it's like asking what's the problem in marriage? Marriage itself is a problem, but elements wise, at least let's try to address it. Basically, consolidation means combining, mixing, adding, aggregating is consolidation. But in consolidation, the one theoretical points you must be aware is regarding control. We look at the definition, we look at the steps also, but let's spend few minutes at least on the basics of the word control. Then we look at what standard says. If you have to have a control over another person, how is it assessed? Or let's think from a politics point of view. Recently election also held. I don't know whether you followed it or not. You are too busy people, but still. If you want to win an state, or if a party has to win a state, how many constituency it has to win? Is it the all constituency? It is just the majority. Same thing applicable for now companies as well. If you want to control other companies' operation, you just need to have a majority of the stake. Okay, now the question is this. Without having majority, can you control? Yes, you can. And especially, I don't know how much politics you follow. Our own past Prime Minister, ex-Prime Minister Deve Gowda, G or he was, how many seats he had when he became Prime Minister? In India, I'm talking about, not about Chief Minister here. Prime Minister, sorry. Prime Minister, how many seats he had? Around 12 or 13. With 12, 13 seats, where India had 540 plus, and he became Prime Minister. For what method? Let's not discuss about it. But he ruled the country for 12 months, 1 year. Good, bad, that's a different things to discuss. And we have so many examples to give. A party which has 1/3 of the seats, or party with 1 seat also, person can become Chief Minister. For honestly, that example have not taken place. It can become, who knows, if that person is the decider thing. Same thing here also we apply. Without having majority also, you can control, but you need not own. The one basic thing you please try to understand. If you prepare a balance sheet, we will have a holding company balance sheet, we will have a subsidiary company balance sheet, and then we are going to prepare consolidated financial statements. From holding company, if you have 100 rupee asset, from consolidation 100 rupee will come. Subsidiary, if you have 100 rupees, but if holding company controls just 80%, how much it will come in balance sheet? Entire hundreds. Why? Because you control 100, you may not own it, but you own only 80%. So balance 20%, what you don't own, here we call it as non-controlling interest. Look at the word, we don't use the word minority interest, because minorities also can control. So we are using the word controlling and non-controlling. What is not controlled by us, we are controlling but not owned by us, they are called as the non-controlling interest. A reporting part of it will come to it. Let's come back and look at some of the basic definition. And before that, standard objectives. To which situation, which standard will apply? If you have a control, then you are applying consolidation under Ind AS 110. If you don't have control, then do you have a joint control? If you have a joint control, then there are two types of joint controls. Either it will be a joint venture or it's a joint operation. Joint operation, accounting under Ind AS 111. If it is joint venture, equity method under Ind AS 28. You don't have joint control as well, then check whether you have significant influence. Usually we say 20% or more, though it's not a hard rule to apply. If you have significant influence, then we follow again Ind AS 28, basically same equity method applicable for joint venture. If not, you don't have significant influence, you still have some sort of investments, then you account regularly as per Ind AS 109 financial instruments, where we apply investments. So basic standard is this. And one more confusion what student will have is when to apply Ind AS 103, when to apply Ind AS 110. Simple answer is wherever they ask you apply. But practically, when do you apply Ind AS 103 and when do you apply Ind AS 110? When do we apply Ind AS 103? At the time of acquisition, at the time of gaining control. That is where Ind AS 103 applies. Then anything you apply subsequently, you are going for Ind AS 110. Of course, if intention is not to have a business, if intention is to sell, then discontinued operations Ind AS 105 will come. And one more thing you have to understand is regarding this separate financial statements and consolidated financial statements. If you don't have a subsidiary associate, you prepare only one financial statements, we just call it as financial statements. You can say individual financial statements. But you want to differentiate between with consolidation, without consolidation, you need to differentiate it, and therefore I use the word separate financial statements, where consolidation is not done. With consolidation, it's called as consolidated financial statements. Okay, so companies having subsidiary, in separate financial statements, you will show investments: investment in joint venture, investment in subsidiary, investment in associate. And as per Ind AS 27, you have two choices: either you can show it at cost, or you can show as per fair value. Usually, financial instruments or investments cannot show at fair value. This is an exception. In the separate financial statements, under investments, you can show it at cost. No investments can be shown at cost. This is the only investments can be shown at cost. The logic is, we are preparing one more financial statement which will substitute these investments by assets and liabilities of the subsidiary company. So for that reason, this cost is given like a relaxation. Questions will be asked based on this. Is this a choice compulsory, or is this a choice to what extent the entity can use? The standard says you have to use category wise. Now the question comes, what do you mean by category wise? That standard will not tell, because Ind AS is a principle based standard, not a rule based standard. It only provides principle. Now what do you mean by the categories? Category, we can say caste also, religion also, that category also, but in the context of balance sheet, category means categories. There is no definition. Category, some people may say subsidiary is a category, joint venture is a category, associate is a category. Or some people might say local subsidiary is one category, foreign subsidiary is another category. Or some people say category related to food business is one category, subsidiaries related to clothes business one more category. That's no hard and fast rules. But once you define a category, for that category you have to use consistent selection, either at cost or fair value. The exact same principle, very similar what we use in Ind AS 16 on PPE, cost model, revaluation model. Here we say cost and fair value. There also it is applicable on class of assets. We don't use the word category there. Okay, so consolidation, basically what happens is these investments will be replaced by assets and liabilities is the process of consolidation, which we will have full-fledged problem. Investment is taken out, assets and liabilities replaced. Basically investment is going out, net assets is coming in. What are the other theory points you have to keep it in mind is the assessment of control. What do you mean by the word control? If you want to have the word control, there has to be three elements: power, right to variable returns, ability to use the power. Power, basically we say for exam purpose, derives from shareholding. Shareholding gives you the power. Board of directors also might give you the power. Any situation prevailing gives the power. And right to variable returns, that is, when you make a decision, your profit should change. It has to be variable in nature. If the income is fixed, then you are not a shareholder, you are a debenture holder maybe. And third, ability to use the power, which means the power and variable return should be linked. When you make a decision, the variable return, the profit will change, your dividend will change, your share of profit will change. These are the three elements you should write when you talk about the control. Various steps are there. I will not go towards that. Institute has spent enough things on this thing, on assessment of control. We are not going being a summary discussion. Exam also, if you know these three elements, should be sufficient. These 2 points, keep it in mind. While assessing the power, should we take into consideration potential rights? For example, holding company has 40% and they have convertible debentures. They will become shares, or they have some ESOP, or they have some convertible preference shares, options, which will become shares in the future, potential shares. Should it be considered for assessing control? The answer is not straightforward, yes or no. If it is substantive in nature, we consider. If it is protective in nature, we don't consider it. Substantive means if I add it, I get 60%. If I consider, if I am likely to exercise, I'm getting control. Without that, no control. With that, there is control. Without, remember like that. When that is the situation, it's called a substantive that should be assessed for getting control. Protective in nature, that is just as a safety mechanism, you have a ability to convert to shares. Those things are not considered. In some situations, you need not prepare consolidation. When you don't know consolidation, you need not prepare, I think. But this also you should be aware of situations called as when parent is a intermediary parent. Parent also intermediary parent. If you imagine your ultimate parent is your grandfather and then your father and you, your father is called as the immediate parent. If you think of a HUF, Hindu undivided family, your father will not have the power. Ultimate power will be with the grandfather. I mean, that's what is parent intermediary. If the parent is in between that, above your parent, one more holding company is there, then the intermediary parents in between holding companies who don't have much powers, they don't have to prepare. Of course, provided other owners don't object, meaning minorities, non-controlling interest, they should not object. Equity instruments not traded in public, in the sense if it is not a listed company, as per Ind AS need not be prepared. As per Companies Act, still to be prepared. That's a different issue. But as per Ind AS, if company is unlisted, consolidation is not mandatory. Or you're not filing with any authority, not required. Ultimate or any intermediate parent, they should prepare consolidation. So other people who are in the group need not prepare. One person do it sufficient. Exception 2, if the parent is a investment entity, means basically venture capitalist company, whose objective, for example, you say Rakesh Jhunjhunwala has a company called as Rare Enterprises. Name is Rare, comes from his 2 letters and his wife's 2 letters, Rakesh and Rekha. That's how Rare came in. His objective or that company is purely to investment. That company does not do any other trading activities, service activities. They do only investment. That is called as investment entity. So Rakesh Jhunjhunwala through Rare Enterprises can have 60% some other company. That consolidation not required, because the purpose is not to control. The purpose is just to make profits. That's called as capital appreciation. So what is an investing entity? Of course, it has to be measured at fair value as well. Investment entity means 3 elements, 3 fundamentals, 4 characteristics. Fundamentals are compulsory. Characteristics differs from case to case basis. 3 fundamental elements are: the funds should be from various persons. The purpose of investment should be capital investment and should be measured on fair value basis. Some characteristics are there. You should make multiple investments. Multiple investors should be there. Investors should not be connected, not related parties. And the issues, ownership interests which are redeemable, in the sense they can exit anytime. Venture capitalists, that's what their intention. Their intention is not to run the business. We make an investment, we take risk, and we exit. Various cases you can see happening now in Paytm case, Zomato case. They invested, they lost the money, they listed the shares, they got all the money back. Now they have exited it. That's what I mean. That's in a negative way. Positive way, like they invested in company like Facebook, then the Facebook got listed, all the venture capitalists have exited. That is redeemable also. Not a compulsory thing, one of the characteristics in general to be kept in mind. So investment entity, remember, venture capitalist or even mutual funds for that example. So they are not required to be prepared. The reason is they can invest in 100 companies. 100 companies consolidation means what will happen? Imagine, for one consolidation only, you look from top to bottom in examination. If 100 companies consolidation, then consolidation means equal to mental hospital. Then it will be a difficult life. So they are exempted. Of course, they should measure at fair value basis. Indirectly, all the changes will be considered. Okay, this is the basics. Let's go to the main area now, that is consolidation. I don't know what different people do. I follow this working note approach. Let me give the formats. I'm not going too much theory, but format. Ultimately, consolidation means holding company balance sheet plus subsidiary company balance sheet. Holding company balance sheet is not a problem. Everything will come as it is. Only one confusing element may be investments. Apart from that, all holding companies item comes in balance sheet. That's not an area of concern. Subsidiary company balance sheet is where we have to discuss where it is going to be reflected, reported. Subsidiary companies assets, fixed assets, inventory, debtors, cash, directly as it is comes in consolidated balance sheet. Liabilities, creditors, bills payable, loan, debentures comes directly in balance sheet. The issue will come relating to the equity items like share capital. Subsidiary company share capital ownership, if you look at it, it is by two sets of people. One, outsiders, we call them as non-controlling interest, and one related to the holding company share, and that will influence goodwill. For the reason, share capital and reserves are called as net assets, net worth, net assets, whatever name you say it. On the date of acquisition by the holding company, when you got the power as per Ind AS 103, you would have paid more than what is there in the books of accounts. The reason being, goodwill will not be reflected in the books of accounts. So you would have paid more, therefore it will come in, the excess amount what you pay is called as goodwill. Goodwill is coming in whose books? In subsidiary company or holding company? It is in consolidated books, because in holding company as a separate entity we show it under investment, that's all, not goodwill. The goodwill will come as a group when we prepare, that is in consolidated books. So you have to remember there are three parallel books to be prepared: holding, subsidiary, and in consolidated books. And this goodwill is being arising on the date of acquisition. But in the examination question, they will not give you the date on date of acquisition. They'll give you the date on balance sheet date. So we have to derive backwards. What could be the date on acquisition date? So we don't know the asset minus liability on that date. As on date, what we have is only share capital plus reserve surplus. So we are going a equity route. We are not going a asset minus liability route. So share capital to the extent of shares held by holding company goes to goodwill calculation. Profits or reserves and surplus or other equity is divided into two kinds: the profits that was there before or at the time of acquisition as a part of net assets, and after date of acquisition we call as pre-acquisition profits. Profits which was there on the date of acquisition, holding company share will go to goodwill calculation because it's part of net assets on the date of acquisition, whereas outsider shares goes to non-controlling interest. Post acquisition, subsequent profits made, it will be going to non-controlling interest, outsider shares, but holding company share goes to CONPL, which I call it as under other equity. In summary, I prepare this working note format. If you have taken my classes, you would know it, but even if you're not taken, you're doing it fresh also, this is such a easy format that everybody can follow it at a basic transaction level. But as the more complication comes, you need practice. So what we do is I dividing these three into three parts. So essentially, if you see this chart, consolidated balance sheet we prepare separately, non-controlling interest, goodwill, and CONPL. These are the three elements which we require to be calculated. Normally, what happens when you follow step 1, step 2, step 3 process is step 1 date of acquisition, step 2 percentage of acquisition, step 3 goodwill, pre-acquisition, post-acquisition, minority interest, step 7 balance sheet, step 8 no, go to next problem. We usually take the last step because you know what happens. You go to institute, step 4, they'll be showing within brackets working note number 5. You go to working note number 5, they will tell you go to step 3. You go to step 3, they tell you go to step 4. You're really not able to connect the dots over there. I'm not telling that approach is not right, but from a student perspective, it is not concept oriented, in the sense it's not connecting the dots. It's like going to government office departments. Ultimately, you come to the place where you started. You'll be roaming around throughout the day, and that too where institute solutions are so many pages runs together, you really lose the track. Is this problem solution or previous problem or new problem I've started? That confusion will happen, and then people say that it's difficult to understand movies like Inception. So come to consolidation. For a working note, we'll have a working note. For that, we will have a working note. A dream inside the dream inside the dream. sometime also had 2 days back, I think. I had a dream that I lost all the money in stock market. I really had the dream about a dream. Okay. Anyway, let's come to consolidation. This working note is all what you need to prepare full-fledged problem. We'll start with subsidiary company share capital, amounts, holding company share goes to goodwill calculation, outsider shares goes to NCI calculation. Pre-acquisition profits, that means profit as on the date of acquisition. Holding company share goes to goodwill calculation, outsider shares goes to NCI. These two put together I can call net assets on the date of acquisition, because this share capital plus reserves as on that date. Then comes post acquisition profit, which will be holding company share goes to con PL column, outsider shares they get everything NCI, non-controlling interest. Then you will have investments in subsidiary which need to be set off. That comes from holding company balance sheet, because from asset side I'll show inside the brackets negative number. Here nothing called as holding company share, NCI share, that is stopped at subsidiary company. The moment you come to holding company, no sharing business. You take it to respective column, you take it to goodwill column. Minus number, these amounts are added to be set off, so minus number. And holding company also, they will have their own P&L account, their own reserves, entire thing will go to con PL, that is other equity. Then total, when negative comes, that means investment is high. When investment is high, it means goodwill. If investment is less, you get positive number, which means we call it as capital reserve earlier. Here we call it as gain on bargain purchase, GBP, gain on bargain purchase. Con PL goes to other equity. In fact, everything is called as other equity only here. If GBP comes, then that also I will add. Together, I take it to balance sheet, and NCI, I will take it to the balance sheet as NCI. This is the primary format. Then we have some adjustments to discuss, we'll discuss. But any doubts on this primary format of balance sheet? So no multiple working notes. We are going to discuss like revaluation, depreciation, unrealized profit, everything will fit into this format itself, including any dividend adjustment. Okay. One question I've asked, I'll ask once more. Tell me this. Subsidiary company has furniture 1 lakh. How much of that will come in consolidated balance sheet? Entire 1 lakh will come, or let's say 80% which is owned by holding company, only 80% will come. Entire 1 lakh will come, balancing figure, I mean the whatever not owned, we call it as NCI on the liability side. Effectively we own 80%. This goodwill, you tell me what we calculate. Is this goodwill related to the entire subsidiary company goodwill, or a goodwill related to holding company share only? This goodwill what you're calculating now. This goodwill is only related to holding company share, because you see we are taking proportionate net assets and I'm taking proportionate of your investment, so it is related to goodwill related to the shares held by holding company only. That is the question I wanted to ask now. All other assets we are showing it at full value. Why only goodwill at less value? Goodwill also you show it at full value. So we have two methods of goodwill. One is proportionate method, other is fair value method. There is a choice. You can choose in the exam, of course, if the question does not say the method. Standards may give you the choice, exam will not give you the choice. So you should know both the methods. Let me tell about that as well. Then I'll come back to this format. Okay. So goodwill under proportionate method, fair value method, we take the cost of investments, and for that I'm going to add the percentage of net assets. And I will subtract net assets on the date of acquisition. That is what will give me goodwill. Effectively, if you consider, think mathematically, this is a percentage. Let's say NCI is having 20% on net assets. So I'm subtracting 100 rupees I'm adding 20 rupees because it's a percentage on net assets. Effectively, I'm subtracting 80 rupees. That is why it is called as proportionate net assets, proportionate method. Essentially, proportionate method means goodwill relates to holding company share only. And that's what happens when we prepare under a working note format. But when we do fair value methods, we have to inflate, we have to increase goodwill. Why should we increase goodwill? Because we should also recognize goodwill related to the non-controlling interest. They also have a share in the company's goodwill. They are also shareholders. To that extent of NCI also, we should have goodwill, in the sense goodwill should be increased, NCI also should be increased. If I tell in a journal entry format, I'm not sure whether you get it. Journal entry is goodwill account debit to NCI account. We don't pass like that, but effectively impact is this. And what is that goodwill is difference between the NCI valuation. Here NCI we have taken as a percentage of net assets, and here we take NCI as a fair value, market value method. The difference between those two is the culprit. The difference between the book value and fair value, if I can use that. That in my working note, I will call it as NCI adjustment. So NCI adjustment, what will I do? I'm going to do plus and I'm going to do minus. In the sense, NCI I'm adding, goodwill I'm subtracting. In effect, both will increase. NCI increasing, it's fine. But here I'm subtracting, then how can it increase? Because goodwill is in negative number in my working note format. So 1 plus 1 minus. It's an examination, you don't have to apply any of this logic. You just have to compare two things. What is that? Compare fair value of NCI and book value of NCI. If fair value is more, you add here, you subtract here. If fair value is less, do reverse. You do minus in NCI, you do plus in goodwill column. And how do you calculate that book value? Book value is nothing but this number. The share capital, pre-acquisition profit, which means the net assets on the date of acquisition. That is what is book value of NCI. Compare with fair value of NCI. The difference is what I'm calling it as NCI adjustment. Adjustments will come like revaluation profit on the date of acquisition. In whose books? In consolidated books. And therefore it is pre-acquisition nature. Holding company share will come. NCI share will come here. When I said book value of NCI, this also to be considered apart from this share capital and pre-acquisition profit, because this revaluation reserve will be there on the date of acquisition. For that reason, whenever revaluation comes, depreciation comes. Depreciation relevant to revaluation. In the sense, when the value of the asset increases, for the incremental value alone, I have to provide higher depreciation. And this is for a period after acquisition. Therefore, it is post acquisition. It will come in con-PL column and NCI column. Then we have unrealized profits. Unrealized profits means stock out of inter-company purchases but not sold, part of closing stock. Depends on who is selling it to whom. If it is a holding company selling it to subsidiary, it's called as downstream. And whose profit is affected? If holding company sells to subsidiary, holding company's profit is what is worried. So I show it under holding company downstream. If a subsidiary company sells it to holding company, it's called as upstream. URP means unrealized profit. And that I will subtract in con-PL column as well as NCI column, for the reason the subsidiary company's profit is shared by both of the people. That is in case of outsiders as well as holding company. So both people should have a hit. That's why I take it in two columns. Whereas unrealized profit by holding company, I will take directly to con-PL. One more adjustment can come. Goodwill impairment. Goodwill impairment, can you think which column I should write? In con-PL column I should write and NCI column, or I should write only in con-PL? Goodwill impairments. Goodwill column, yes, definitely, that's obviously. Goodwill, one entry will be there. One effect, two goodwill is for sure. I'm asking about the other effect, double entry effect. Should I take it to P&L or should I take it to NCI? That depends on the method of goodwill. Had you followed proportionate goodwill, which means only related to holding company, it will come only in CONPL. But if the goodwill was related to fair value method, then we should allocate proportionately to CONPL as well as to NCI. Journal entry wise, it is CONPL account debit, NCI account debit to goodwill. Or if it is proportionate method, CONPL account debit to goodwill account. Of course, it is minus in CONPL NCI and it is plus in goodwill, because goodwill was already a minus, and plus means goodwill will reduce. So that depends on the method we follow. This is the full-fledged format. Even if it is a problem like we have like triangular holding or chain holding, we can have the same format. We write one below the another company. We just have to compute the effective capital percentage of percentage. The format will be just below that. We write subsidiary 1, subsidiary 2, then holding company. The format will be exactly same. Even in consolidation, or business combination on the date of acquisition, I don't recommend this method because pre-post law will not come, but conceptually at least you should be aware of it. Some extra things can come. Chain holding problem is a separate problem. They can ask like maybe multiple acquisition or maybe a sale, maybe dividend adjustment they might ask. First of all, dividend proposed or dividend declared will not show any adjustment, because as per Ind AS 10 it's a non-adjusting event. So proposed dividend yet to be paid, we simply ignore it. Dividend paid, that will be having an impact regarding our pre and post calculation. The dividend will have an impact. Apart from that, dividend will not have any other impact. You don't have to worry about the pre-acquisition dividend, post-acquisition dividend. That will also not to be worried. Okay, so basic format is this. If you have any questions, you can ask, or else we'll take a problem based on this. I'm not doing any basic small problems. I'm going for straight away full-fledged problem. Multiple acquisition and derecognition, I don't think you can expect a full-fledged problem, because I think institute and students are not yet matured, because they're still in this area of asking basic question. That only the institute is successful in making students not to pass. So they don't have to work hard to go to multiple acquisition and all. Maybe in future it might come. Yes, please. It should be sufficient. If you have time, you can go and show extra calculation, but this much is sufficient, because you see it's not complicated that others cannot understand. But I should remind you, usually I get a message that yes, consolidation I got tallied and I got the marks, and many students have told me that I could pass the FR paper because of consolidation, because of this format. I've got that feedback 99, but if there's one student who still messaged, it's my duty to tell you that he got the answer correct, but marks was not given. That 1 out of 100 it can happen. That depends on the validator hands, that I can't really argue. But as I told you, so many students have got the answer papers also. This format is accepted, so you don't have to worry about it. You really worry about in the exam about the format if your answer is correct. You got my point. You go to the exam, you write the answer, you're confident your answer is correct, then you imagine which format shall I present this answer again. If that happens, you think about it, but more or less it's fine. One extra thing, if you want to show, what you can show is only goodwill you show a calculation. That is, the share capital, pre-acquisition profits, plus this revaluation profit, this element, these amounts, when you add these three amounts, you get net assets on the date of acquisition. Only that calculation you can show, so that they are also understood it is in their lines. But I really don't recommend, because we have to take some chances in exam. We can't go with 100% probability. Life is not in that sense. It's like asking, are you guarantee you'll go home today? Are you guarantee 100% probability no accident will happen? Who knows? No, nothing, anything can happen. While sitting in the class also, we can have heart attack. It can happen to you, it can happen to me. Yeah, if the class is not good, I can be killed also. Who knows? Like, life is always at risk, but we should take that risk. Especially faculties will take that risk and come to class. You also take that risk indirectly, so 100% probability we cannot assure, so let's go with that. But I told you, there is a case. Actually, there is only one case. Only one student have messaged me that they got the marks, tallied to the institution answers, still not got the marks, unfortunately. But of course, the person passed in the next attempt. I think next attempt the person did not contact me, but I hope no, person contact me telling he passed, but not commented about the working note format. But I don't know whether he got the marks or not. So anyway, just a reminder that sometimes things can go wrong. That is okay. 1 out of 100 case it can happen. Okay, now what kind of problem you want to do? There is one problem out of institute exam I can take it, or one problem I can do which containing many adjustments, which I have created, not the institute question. Both we don't have time. So multiple adjustments in one problem we can do, or we can have like one full-fledged institute question. Okay, we'll do multiple adjustments like dividends, inventory, bonus issue also there, because institute not even touched the bonus issue in the any of the institute publications. Questions I have not seen bonus issue. I have not seen it. Including preference share capital. Again, you are looking at me like, sir, do you want us to go home or not? First of all, consolidation. Then you told preference share. Then you are telling unrealized profit. Then you are having bonus shares. Okay, we'll take the complicated one only. Okay, I'll take it including preference share. Might be worth doing it. Okay, question number I have not put it, but anyway, does not matter. Let's do this. So let's do this problem. I think in my book this problem may not have solution. Anyway, does not matter. Let's do it together. From the balance sheet given below, prepare consolidated balance sheet. Share capital mean equity share capital, preference shares, general reserve, P&L, debentures, trade payable, fixed assets, investments, 56,826 shares in S Limited, shares in debentures, shares in investment in debenture, investment in preference shares, inventories, trade receivables, cash and bank. This is like all possible adjustments in one place. This is where like you had a breakup with your girlfriend, then you went to bar to have alcohol, then on the way back the traffic police had caught you drinking. All the possible things in one day can happen. This is what is problem. H Limited purchased 56,826 shares on 1/4/2016, and on 1/4/2016 the following balance sheet stood after paying preference share dividend, general reserve, P&L. Dividend at 10% was paid by S Limited for the year 15-16 on 1/8/2016 out of its P&L account balance, and H Limited credited the share of dividend to P&L account. Both companies have declared the dividend for the year ended March 17 but not been provided in the books of accounts. We will also not provide it. S Limited inventory includes stock of 44,000 purchased from S Limited. S Limited sells goods at markup at 10% on cost. S Limited issued bonus shares in the ratio of 3:7 during acquisition for the purpose of fixing the share. Fixtures are revalued 2,60,000 having book value of 3 lakh. This has not been provided in the books of account. Depreciation to be taken 20%. At the end of the year, X Limited has to pay 90,000 to S Limited. Preference share dividend for the year 16-17 has not been provided yet. We can add one more line. Is there anything else to be done? Okay, so let's start with first thing. What is the percentage of acquisition? They give a number of shares, but what is the percentage of acquisition? Calculate. What is the percentage of acquisition? Uh, 56,826 divided by 99,000 should not be done because there is a bonus issue 3:7 on 1/1/2017. Acquisition happened on 1/4/2016. Balance sheet on 31st March 2017. So in between the date of acquisition, date of consolidation, there is a bonus issue. This is what I told you. Examination is operation theater. You realize this one small adjustments after the exam hall. Anyway, I mean, I don't expect this much level of complication in the exam, but let us discuss what is there. Okay, let's get the percentage of acquisition correct, then we'll go further. Percentage of acquisition. Let's do the ratio parts. This before bonus, bonus, after bonus. So ratio is 3:7, which means if you have 7 shares, you get 3 shares. So after bonus, you get 10. In terms of share capital, let's say this is ratio. What is share capital rupees? 99,000 in the subsidiary companies. 99,000 is what? After bonus or before bonus? It is after bonus and the balance sheet date. So what is the before bonus amount? Cross multiply 99,000 into 7 divided by 10, cross multiplication, into 7 divided by 10. What do you get? 69,300. This is before bonus. So bonus you can say into 3/7 or you can cross multiply. 99,000 into 3/10. 29,700. Okay, number of shares. Face value 10, so 6930 2970. Anyway, So what is the percentage of acquisition? 6930 shares. I mean, number of shares held 5826, 5926, 58 56 56826. Okay. Oh, 9,90,000. That's the share capital. Sorry. So it is 6,93,000. So this is 69,300. 2,97,000 is bonus. 29,700. Okay, I missed it 1 0 there. So it is 6,956,826 divided by 69,300. So what percentage you get? Percentage of holding company? 82%. So obviously NCI remaining to 18%. Okay. Before we go further onto the working note, that pre-acquisition, post-acquisition, only that portion we'll discuss, and then we can prepare the format. Look at the subsidiary company balance sheets. And what is there? Let's say general reserve. As on balance sheet, they have 4,400,000. And I assume this bonus shares is out of this only. Have they given that? I mean, they have not given, but I assume, because usually the bonus is out of reserves. Usually, you can take P&L also. So the bonus issue is out of this. What I'm going to do is I'm going to add this amount to the balance what we have. Basically, I'm nullifying the effect. When you issue bonus shares, the reserves will come down. Now I'm adding it back. What will happen to P&L account when you pay dividends? P&L will come down. You add back. So whether bonus issued or dividend paid, the date pre-post acquisition, don't worry. Treatment is very simple. Whatever subtracted, you add. We want to nullify the effect. Why should we do it? Because I want to give date from the date of acquisition. I want to know from that date what and all happened. For that reason, whatever happened in case of bonus, dividend, I will add back. So if I say, I'll say like analysis, maybe analysis of profits. Let's take general reserve. These are all only subsidiary companies. Holding company, don't worry about it. General reserve balance in the balance sheets 4,400,000. Add back bonus. Assuming, of course, assumed out of reserves. We calculated the amount just now. 29,700. So 4,400,000. What is the amount? 2,97,000. 2,97,000. So what is the reserves before bonus cumulatively? 6 lakh, no, 5 lakh, 1,400. 6,97,400. 97, no? Okay, 97. Okay, so what was the reserves on the date of acquisition? On the date of acquisition, reserves is standing at 2,97,400. So opening reserve, you can say like this. This is the only two things comes. One is bonus and dividend. Nothing else will come here as a analysis element. So on 1/4/2016, that is date of acquisition, opening balance 2,97,400. And balancing figure current year 2016-17, 4 lakh. Okay, now this 2,97,400 is on the date of acquisition, so this will be pre-acquisition profits. 4 lakh is in the current year, so this will be post. Just a caution, this acquisition took place on 1st of April. Had that took place on 1st of July, this 4 lakh should be divided on the base of number of months, 3 months, 9 months, 3/12, 9/12. 3/12 will be pre, 9/12 will be post. In case of acquisition during the year, middle of the year. Similarly, we'll talk about P&L. Yeah. P&L from the balance sheets, 8 lakh, sorry, this is 6,600,000. Add dividends paid. Okay, dividend paid. How much dividend paid? 10%. 10% of what? 10% of share capital, but not 9,90,000. 10% of the share capital, which is 6,93,000. $69,300. So you get 6,69,900. Okay, and what was opening on 1/4/2016? On the date of acquisition, it was 5 lakh. Opening is 5 lakh. And balancing figure current year, which is 1,69,900. 1,69,900. Okay, so this is pre again, post same discussion what we had. But there's one small element which will come here, that is because of the preference share capital. When you have preference share capital, you have to pay preference share dividends. And when you pay preference share dividend, the reserves will come down. And that depends on whether your preference share, again in the nature of equity or in the nature of debt. It can be both ways, but usually preference share we take it as nature of debt. It's always redeemable in general. So from this post acquisition, whatever we had, subtracts current year preference shares less preference share dividends. Because they also said the preference share dividend for the year 1670 not provided. We have to provide. Equity dividend we don't provide, because proposed dividend anyway non-adjusting, ignore it. 4,40,000 into 9%. How much you get? 39,600. Therefore, net amounts what we get here, 1,30,600, 300. Okay. One more small point we can discuss later. We can discuss now also. Just tell me this. This dividend paid, now we are adding it back. Means we are nullifying the effects. But we have to give the effect later as well. When you pay the dividend, the bank balance will come down, which is already coming down, so that we don't have to touch it, because the balance sheet bank balance is after paying dividend. But when you make the payment, there is one more impact which need to be given effect, is regarding CONPL and NCI. Or just try to imagine in consolidated books what journal entry should be passed for dividend payment in consolidated books. When you make a dividend payment, it will be to bank. That is easy. Debit will go to which line items? It will be paid out of reserves, meaning we will debit CONPL. And it is paid out of NCI. NCI will come down, because when you pay dividend, you are paying to the outsider as well. So you debit NCI, you debit CONPL to bank. The journal entry for a dividend payment is CONPL account debit, NCA account debit to bank. To bank effect we already given, but CONPL we have to reduce, so that CONPL column will go, and NCI will have to be reduced. We take it in the NCI column. Don't worry about the pre-acquisition profit, post-acquisition profit. That dividend, date of acquisition, they credit to P&L account, that you don't worry at all. It will have an impact. When we subtract, impact will be shown. And when we prepare the working note format, I will prepare that. Okay, so let's have the working note format. Okay, so particulars, amounts, goodwill, CONPL. CONPL means other equity. I'm using the word CONPL, but it's effectively other equity. Keep it in mind. Then what is the percentage? Some 78%. What is the percentage? 82%. 82. This also will be 82, and this will be 18%. Subsidiary heading. And then I'll go for a holding company. Start with equity share capital. Okay. Equity share capital account amount, which amount should we take? We should take as on the date of acquisition, because this is relevant for goodwill calculation. and goodwill stands at the date of acquisition. As on date of acquisition, 1/4/2016, which share capital we had? Should I take 9 lakh 90 or 6 lakh 93? It is 6 lakh 93. As on date of acquisition. So without bonus, essentially at the time of acquisition. 82%, 5 lakh 68,260. 18%, 1 lakh 24,740. Should I take preference share capital here? Preference share capital, we will usually take it as in the nature of debt, mean they will come under borrowings, not under share capital, not part of net assets as well. So preference share capital, I don't write it here. Then we write general reserves, and under that we had pre, post we calculated. Pre is 2,97,400 or 4 lakh. Reserves 2,97,400. Okay. And post is 4 lakh. Divide 82%, 18%. 2,43,868. 53,532. Post acquisition will come in con PL column. 3,28,072,000. Similarly, P and L, pre, post, pre acquisition 5 lakh, post acquisition 1,69,900. Sorry, 1,30,300. 82%, 4 lakh 10,000, 90,000. Post acquisition in con PL 106,846. NCI 23,454. This is the adjustment which will come in almost every problem, reserves and P&L account. Then we look at adjustments, revaluation, depreciation, unrealized profit, dividend paid, impairment of goodwill. All those things will have a next line items. What is that adjustments we have? One by one, we'll take it. Okay, that's just now we'll discuss dividend paid. Now itself will give the effects. So dividend paid, don't worry, pre-acquisition, post-acquisition, dividend paid, subtract. Dividend paid. So 69,300. Con PL column 56,826. 12,474. Then there is one more income which will come. Preference share dividend income. We have subtracted that we have to pay, but holding company has some preference shares as well. I mean, in the investments, that income will come. That will not go to NCI, but you will take some portion to the con PL. That will go to the P&L account of holding company of the group. So preference share dividend income. How much was the amount? 39,600. How much comes in con PL? Not 82%, to the extent of face value held. Face value held is 16,500. I think face value what, 10 rupees? Yes. So 16,500 into 10 into 9%. Just show the calculation: 16,500 into 10 into 9%. So how much amount is there? 14,850. Balance amount, please don't write on NCI. Balance amount will be shown as liabilities. It's payable to outsiders. Preference share dividend payable will come in other current liabilities. Okay, then we look at other adjustments. Bonus shares, don't worry, dividend given effect. During acquisition, book value of 3 lakh, revalued at 2 lakh 60,000. 40,000 revaluation loss. Revaluation loss. 40,000. Within brackets, 40,000. You can take it to goodwill column because revaluation takes place on the date of acquisition. Therefore, how 40,000 on that 82%. 32,800 and NCI 7,200. This is loss or profit? Loss. Goodwill column, yeah, goodwill column. On the data question, I think I told also, but forgot, right? This is one problem with this format also. Ultimately, balance sheet is tallied. After all, you're taking to different columns. So some people will be happy, oh, balance sheet tallied, my answer is correct. That is not true. In this format, any mistake you do, it will be tallied. So just be careful. At least that will be there. Your balance sheet will tally for sure with this format. Revaluation loss. And whenever evaluation comes, we have to be worried about the depreciation impact. And when revaluation loss is there, depreciation will be a positive number. It's a write back, because when you revalue, the value of the asset comes down. You would have charged a higher depreciation to P&L. You have to take it back. The rate of depreciation 20%. Depreciation on above 20%, 8,000. That will come in post. So con PL 6560. And 1440. Okay, then unrealized profits 44,000 and 10% on cost. So from on cost, you have to make it on sales. 10 by 110. Sometime to confuse you, what they tell, it is at the cost to the purchaser. They'll mention at cost, but still it is at selling price, because you have to think from the seller point of view. The elimination is from seller point of view. H limited inventory includes means sold by S limited. Under subsidiary only we will take it. Sold by S limited upstream, we will take it under S limited. URP on stock. So 44,000 into 10 by 110, 4,000. You subtract in con PL 3280 and in NCI 720. If they have given NCI to be valued on fair value basis, if goodwill has to be valued on fair value basis, then we read one more line item for NCI adjustment. And what and all things I will compare? book value of NCI and fair value of NCI. Fair value they will give, but book value will be considering 1,24,740 share capital, 53,532 pre-acquisition general reserve, 90,000 P&L, and the revaluation loss 7,200, because these items would be there at the time of acquisition. All other items are post-acquisition elements. So these things I take it as book value of NCI. Just tell me how much it comes to, these amounts. $2,61,72. This is the book value. And suppose if they tell you 2,70,000 is fair value of NCI, then you see 8,000 something you get as the adjustment. That 8,000 I'm going to add here because NCI should increase. 2,61,000 should become 2,70,000, and once you do plus here, opposite in goodwill column I'm going to do minus. So when fair value is plus, when fair value is high, this I'm going to add, and opposite in goodwill. If fair value of NCI is less, this I'll subtract. I'm going to do opposite in goodwill column. Just be aware of that adjustment as well. In this problem it is not there. Okay, dividend paid is done, depreciation done, retained earning is done. Okay, so let's come to holding company. Holding companies, general reserve, P&L accounts, investments. First investment will take it. Investment is 18,34,140. Investments 18,34,140, and entire amount I will subtract in goodwill calculation. Then general reserve, P&L. Okay, general reserve 16,01,600, 8,800. Directly to CONPL other equity. 16,01,600, 8,800. Anything else? Do you think it will come? Intercompany holdings. In terms of equity share, we have taken care, but in terms of debentures as well as preference shares. So debentures, let's look at the face value. The cost of investment is 1,76,000, but the face value will be, debentures 1,37,500. Face value 1,250 of 100 each. Face value is 100. So 1,25,000. 1,25,000 is the face value, but the cost is 1,37,500. More cost means loss, and that will be transferred to CONPL. I'll just say debenture adjustment. $1,25,000 and 1,37,500. 1,37,500 minus 1,25,000. 12,500. That I'll show as a negative number because my cost is more. Or you can say it's face value minus investment. So debenture face value versus cost. Cost is more, taken to P&L. Set off basically, like a cancellation. Then similarly, preference share adjustments. Face value minus cost. Face value 16,500 into 10. 1,65,000 and 1,76,000. 1,76,000 minus 1,60,000. So 10,000 or 16,000. 11. Oh. 1,65,000. $11,000. Okay, so that's it. Okay, so do the total. Goodwill 6,44,812. 27,75,050. And minority interest 3,44,772. See if the amounts are correct. This is the amount final answer I had, so I just wrote it, but see if the amount comes to that. Any differences coming? No? Okay. Okay, let's prepare balance sheets. Yes, please. P&L, which one? Previous slide. Okay. It is just to nullify the effect because I need to know the reserves or P&L at the time of acquisition. So whatever the P&L account in the balance sheet is after all dividend payment. I want to go backwards. 5 lakh that? That is P&L account is as on 1/4/2016. But I want to know the post acquisition profits after this date. Now if I take it as there will be like this is the balance as on this date 5 lakh, and what is the P&L account in balance sheet date 6 lakh. So can I say 1 lakh is my post acquisition profits? We have to adjust dividend also there. So that then we have to consider out of which account the dividend was paid. Out of opening balance paid, out of current year balance paid, because they paid out of P&L account 5 lakh. In the balance sheet 5 lakh did not continue, actually it was subtracted. So to instead of having all these items, the simplest approach what I did is whether dividend or bonus, simplest thing, you nullify the effect first. So you stand as if there is no dividend paid, stand as if no bonus issued. Then you provide adjustment for dividend paid. That's what we did here. In the working note, you can see we have subtracted the dividend paid. So basically, I've added there and subtracted here indirectly. That will take care of all this pre-acquisition, post-acquisition element will be taken care. Why it will not match? If you look at the P&L account of subsidiary company, as on date, it is showing a balance of 6,600,000. It's a closing balance. So when I had, as per our calculation also, we had a P&L of 5 lakh on the date of acquisition, and I paid dividend of 69,300. So you can do from 5 lakh subtract 69,300. Then I made a profit of 169,900. So calculate 5 lakh minus 69,300 plus 1 lakh 69,900. You will get the same balance, 6 lakh 600. Now that is only current year profits. We are breaking it down. Okay, if you calculate in that manner, then you add both this 5 lakh and this 1 lakh 36,600. Of course, this is after preference share dividend. So if you take it before 5 lakh plus 1 lakh 69,900, you take that number, you add 5 lakh plus 1 lakh 69, then we subtracted here, right? 69,300 we subtracted here. So when you consider that element, it will come to the same balance. Essentially, it's nullified, right? We are adding here in one place and we are subtracting in another place. So when you match that way, the balance of P&L account or subsidiary will tally. I don't know whether if you are matching in any other when you say matching in other sense, I don't know. Why we did not add? We should add. Why we did not add? Because 1/4/2016, the following balances stood in the books of S Limited after paying preference share dividend. It was already subtracted before even you have that 5 lakh. No, from that 5 lakh only dividend was already paid, preference share dividends. The balance what we have 5 lakh here, this was after paying preference share dividends, but before paying equity share dividend. So out of this 5 lakh, dividend was in paid. So I had to subtract and then add adjustments. But preference dividend is already paid, so no need for me to add back because it was not subtracted. If I want to add back, where will I add? I'll add back for this 5 lakh. Then I'll subtract from 5 lakh. So both of these things I should do. So what transaction you should do, I'll tell you. The dividend which have been paid after acquisition, those things only you add it. Anything was dividend prior to that, like 1 year back, 2 year back, 3 year back, that we are not going to add back. Date of acquisition 1/4/2016. From that date, whatever dividend has been paid, that I will add back. Which in this case, only equity dividend because preference share dividend was already subtracted. In the exam point of view, what journal entry you have to remember is this: CONPL account debit, NCI account debits to bank. NCI will reduce when you declare dividend, when you pay dividend. Again, different ways of showing is there, but according to me, this was the best method to reflect the actual transaction in the consolidated books. That's why. Okay, let's come to the balance sheets. Yes, please. Debenture interest should have been already taken to P&L account. That we don't have to provide fresh. It would have been already taken. And if you prepare CONPL account separately, then you know we are going to prepare one holding column, subsidiary column, mutual interest will be there, one company interest expense, other company interest income. So we'll have to set it off. But when I'm preparing total, the set off will happen automatically. In the sense, when I say this P&L account, right, in the P&L accounts, this amount would be after considering the debenture interest. And similarly, this P&L account would be after considering the debenture interest. So for one company, for holding company, it would be income. For the subsidiary, it would be expenditure. So that will set off. So we don't have to worry about how much is the amount of interest. That will be taken care. If you prepare P&L account separately, yes, then we should show it separately. Last two adjustments in the sense, at the end of the year, H Limited has to pay 90,000. This mutual owings will reduce liabilities, will reduce assets in the balance sheet. Preference share dividend is not yet provided, yes, and that is why we have subtracted preference share dividend here. From the current year P&L account, preference share dividend is subtracted. It's an expense to be provided. And this will come as liability to the extent of outsiders, not to be payable to the holding company, because holding company we already taken preference share dividend income in this case. The outsiders portion liability will come under other current liabilities. Okay, balance sheet format you can write. You don't have to wait for me that. I can just do copy paste, already done. In the exam also we should have that facility, right? Copy paste somewhere. Practically we do all copy paste, not in exams. Who knows, in future those things also may come, where you upload your answer in PDF format or XML format, XBRL format. Your results will be automatically posted to your Facebook wall. And ICA president will come live, Facebook live, and announce this time results, rank holders from this place. This is what we're expecting. And Facebook also will detect all the things automatically. The result will be posted and you get 3 kinds of reactions. One is like, that is from your parents. That's all they know. Whatever you tell, they will like. Then comment, that will be from your friends. You told you get 61, you got 16 marks. What happens? Comment. Then we'll have share, and that will be by your relatives. So that's why they are there to share. And that's why I said please don't update your status and all on Facebook, especially towards exams. Your results is automatic, and Facebook will post a memory 6 months back. You wrote the exam, not clear. Do you want to write again? Pre-filled exam form. And automatically tagged with others. Everything would be automatic. If it's so automatic in future, I don't know. So at least what I expect this in exam, no? This format balance sheet, they can give you pre-printed, no? See, like graph sheet they provide. Why not balance sheet format also? Reasonable, right? It's format and all, who would care about it? They, asset, liabilities, a regular format. We should not have too much demand with ICI, because whatever existing also they can take out. At least now they provide 15 minutes earlier question paper, so that after reading the question paper you can be alive, and if it is fine you can continue. Okay, asset side, PP might require some calculation because revaluation loss and all is there. I'll just show inner column calculations from the balance sheet. Fixed assets 30 lakh 3,000, 24 lakh 20,000. 30 lakh 3,000, 24 lakh 20,000, and then plus, minus revaluation loss plus depreciation, that you have to consider. Revaluation loss was 80,000 something, 40,000. So minus 40,000 plus 8,000. So PP comes to 53 lakh 91,000. Intangible assets means goodwill as per working notes. 6,44,812. Inventories from the balance sheets. And hope you know the format, you have to write that only. What format? That is inventories, trade receivables, cash and cash equivalent, ITC. Hope you know it. And some people's favorite product, ITC, no? It's very equivalent to meditation, yoga. Correct. No, what does people meditate? People will to take a deep breath and slowly release your breath. That's what even people who smoke also will do it. And that's why I keep saying people who don't smoke will never get aged. You don't know that. You don't get aged when you smoke because you die young only. No? Where's the question of getting aged? Okay. Fine. Sometimes you laugh for my joke, sometimes you laugh at my joke. This also joke. Okay. So inventory is 9860, 2,20,000. 9860, 2,20,000. The unrealized profit should be subtracted. That was 10,000, I think, or 11,000. 4,000. Okay. So that is 3,06,860. Okay, trade receivables 2,77,200, 4,05,900. At least these numbers also, no, like this also they will give it to you. At least had they given like 5 lakh, 4 lakh, no, we can remember this 2,77,200. By the time you come to answer paper, you would have forgotten that number. We are, at least in exam, it will be in one slide, okay, in one page only. 2,77,200. Plus 4,05,900. And there is one adjustment regarding the mutual owings. At the end of the year, H Limited has to pay 90,000. So if you imagine H Limited has to pay 90,000 means for H Limited it's a liability and for S Limited it's a receivable. And when you do amalgamation or when you do a consolidation, you will have a trade receivable and you will have a trade payables, both in the same balance sheet. So we are going to set it off. It's basically payable to myself, receivable for myself. That's the effect. I think that will be Nityananda balance sheet, no? Me sitting in me, talking to me, sitting in you, like that, like payable to me, receivable from me, sold to me, purchased from me, profit made by me by transaction with me. So the H Limited has to pay to S Limited. That is who has to pay to whom does not matter. It's a mutual owing. You reduce in receivable, you reduce in payable. Both will reduce. Minus 90,000. So that trade receivable will come to 593,100. Cash and cash equivalents 2,200,000, 1,100,000. Okay, that is 3,300,000. Okay, that at least without writing we can write. Okay, share capital only we take the equity share capital of holding company, which is 20,02,000. Other equity as per working notes 27,75,50. 27,75,50. NCI as per working notes 3,44,772. Non-current liabilities, we have long-term borrowings, which is debenture we have and preference share capital, both of them. Okay, preference share 4,40,000. This also 4,40,000. Okay, at least those two are same numbers. We don't forget. We can write it. 4,40,000 plus 4,40,000. But what is held by the holding company should be subtracted, and that you can see it in our notes. See, we subtracted this number 1,25,000 and 1,65,000. This number we subtracted. Those you can subtract there also. 1,25,000, 1,65,000. So how much long-term borrowings coming to? 5,90,000. Okay, trade payables, two companies and minus 90,000. 13 lakh 14,500, 2 lakh 75,000. 13 lakh 14,500 plus 2 lakh 75 minus 90,000. 1499 500. Other liabilities, only one thing will come, that preference share dividend held by outsiders. So again, take a look at the working notes. Preference share income, you see 39,600 was there, out of which 14,850 had taken balance. 39,600 minus 14,850. 24,750. See if the balance sheet is tallied by any chance. Because when balance sheet don't tally, you don't worry. Balance sheet tallies, you'll be wondering where mistake I've done. Tallied. Which sides? Okay. Which one? Question? Okay. Yes. 2 different years. This preference share dividend is 1,416. That preference share dividend is for 1516. This is the at the end of the year preference share dividend for 1617. So that was the previous year dividend, earlier year, and this is for the current year, the date on which we are preparing. 2 different years. Okay, so a few small questions. Let's clarify it before we go further. Yes, please. That we can add it. I mean, that is where, that's the word declared, they've used it, no? So declared means we have to provide, so we will subtract in P&L account. That's one treatment you can give, because if you technically look at the word declared, when will you declare it? Will you declare in the AGM or will you declare in board meeting? You'll propose in board meeting, you'll declare it AGM, which means we are preparing the balance sheet before declaration. But look at the question what they said. Both the companies have declared. How can you use the word declared? So we have interpreted it as proposed and we solve the problem. And if you treat it as declared, what would you do? You have to provide for this impact, means just like preferential dividend you subtracted, you also subtract equity dividend from this as well as holding company's P&L account. How can you declare in board of directors meeting? Maybe you can take it like an interim dividend or something. That's too much of extraction, but we can. Looking at the words, if you want to provide impact, you can subtract here, and corresponding amount will come in the other liabilities to the extent payable to outsiders. If you want to provide, I don't recommend that. In the books I would have given so that that level is also covered. But for exam, this much is sufficient. You can write it. You can say the problem. The problem use the word dividend declared, and it is interpreted as dividend proposed and accordingly ignored, since it is a non-adjusting event. You can write a notes to accounts, because even in the notes, especially dividend proposed should be reported even as per schedule 3. Okay, for a few small questions before we go further. Should we write notes to accounts? Does it carry marks in the exam? I will answer, see if you are able to understand it. if you don't write notes to accounts, they will deduct marks. If you write notes to accounts, they may not give you marks. Understand that English correctly. I understand lunch break, but still. If your answer is right, you don't write the notes to accounts, they will deduct marks. If your answer is wrong, you write notes to accounts, they will not. Papa has written so much, let him give marks. No sympathy of that sort. So what you should do in exam is, first complete the working note, complete the balance sheet, see if your confident answer is right. But what I recommend is, okay, if your answer is right, even then leave one page, go to next problem, complete the paper. The time you are spending writing the notes, one PP, intangible as inventory, reducible cash equivalent, each and one line item, 10 notes you write, it might use 10 minutes. In that 10 minutes, you might solve some ESOP problems, stock appreciation rate problem. Here you might lose 3 marks. There you might gain 8 marks. Impact 5 marks is there for you to get it. That plus 5, only those who are fell short of it know the pain. 35 to 40 or 55 to 60, that plus 5, plus 2, plus 3, whatever makes the difference. That is what is called as opportunity cost. You lose out 3, but you get 8, you have to make it. But let me also tell you, the question of opportunity cost comes only if there is opportunity. So if this 8 marks you get, if you know 8 marks, yes, you lose 3, you get 8, all those things will work. That's why I told you, complete the paper. If you know that 8 marks question, write it. Utilize for less time. If that time is not available, if that is not there, come back and write the notes. That 3 marks at least come. 3 marks also important. That's why you have to manage the time. You have to give preference like that. Leave one page, complete the paper. More often than not, you will not have time, especially looking at the FR paper. Reading the paper only will take 35 minutes. Forget about understanding and writing it. If you have time, come back and fill the notes to accounts. The same thing holds good for things like, should I write particulars, note, working note, amount, rupees? None of these things you don't. You don't even write it. Leave space. If time permits, come back and do those cosmetic changes. Draw the line, put the heading, underline, any beautification you have to do only if you have the time at the end. Last 5 minutes, 2 minutes, you can beautify your answer paper. But till then, your priority should be to what is most important things. So notes to accounts from exam point of view, leave it. Even if you want to write, what I would recommend is write for PP. Usually that will have some adjustments because many line items will come. So usually you write for that. Maybe share capital, other equity, you write note to note 3 so that you write notes to accounts, they'll understand you know it. But I give least preference, hardly matters. Do it only if time permits. Leave the space, later you can come and fill it. One more small point. If balance sheet does not tally, which amount will you write? The asset side amount or liability side amount? I mean, ideally I should not even speak like this, but we are thinking from examination lines. And only request is, don't show your sincerity here. Balance sheet, whatever total I've got, I've written there. No, don't show sincerity there. Write same amount on both sides. I think if you don't write, I will consider that as a professional misconduct. You write the balance sheet total being different. So write the asset side because more likely asset will be more closer to the answer. Not confident, but more likely because liabilities had too many items, including the other equity, NCI. But where assets had only one item, which is intangible assets. So I think the closer answer is assets. Write the amount on both sides. Find out the difference. Look for that adjustment. That amount. For example, if 4,000 is the difference, maybe you would have forgotten to adjust unrealized profit. Look for the adjustment. First thing. Second thing, whatever the difference you have got, divided by 9, divided by 4. Sorry, divided by 2. 9, I'll do it later. Divided by 2 means you would have done the opposite adjustment. See, revaluation loss, you're supposed to subtract. Depreciation, you're supposed to add 8,000. But what is your mindset? Intuition says depreciation means minus. You would have done minus 8,000. So the difference between the balance sheet would be 16,000. When you divide by 2, you will find out that, okay, that adjustment is missing. So find out the difference. Difference divide by 2. And next difference divide by 9. When you divide the difference by 9, see if the number is without any decimal points. If yes, there is likelihood you have interchanged the numbers. Means while working note you have written 6,44,812. Coming to next page, you have written 6,44,821. You don't realize the number has been interchanged. When you do that, the mathematical properties, the difference is always divisible by 9. So divide by 9. If there is no decimals, there is likelihood you have interchanged the number. Look at those possibilities, like 5,93,000 you would have taken 5,39,000, 53,91,000 you would have taken 53,19,000. That possibility is there. When you divide by 9, you can find out. Beyond this, you are capable of doing your own extraordinary, superhuman mistake, which I cannot identify. You have to identify yourself by doing as many problems as possible. Okay, so this is the full-fledged problem with as many adjustments as possible. Yes, please. If question does not specify, we go with proportionate method. But if information on fair value is available, I'll go with fair value methods. You can write it telling that in the absence of information on fair value of NCI, proportionate method has been followed. You can write it. But when the question does not specify, sometimes it is understood also. So you can write it towards the end, again, if you have time. But yeah, if they have NCI, you should know that the adjustment should be done. And if you have done it, you don't have to specify it. Fair value has been followed it. But in this method, what you follow, you'll automatically get the proportionate method. It's good, safer if you write the information assumption clear. Okay, any other adjustments in consolidation? No, I would follow the same process. It is after payment, after date of acquisition, dividend you add and later you subtract. Ultimately no impact. So even if you ignore it, no impact. But you should think pre-acquisition means consider, post means not consider, leave all those things. Simple treatment, dividend paid after acquisition, we are going to add here while analyzing P&L account. For whatever balance in P&L account you add, and later in this statement you subtract less dividend paid. So interim dividend, previous year amount paid in current year, pre-acquisition dividend, all will be taken care with the adjustment. Simple process, add dividend, later you subtract. If you sell revalued assets, then you have to give it back to P&L. Basically, for example, you have that is applicable for revaluation loss also, that is applicable for unrealized profit also. If the stock has been sold during the year, this is assuming that stock is unsold at the end of the year. So if you have sold, or even with respect to revaluation loss, you have to adjust in the con PL to the extent of whatever we have already recognized. See, for example, I'll tell you. Let's say revaluation profits. Let's take simple numbers. Suppose the book value was 1 lakh. Revalued amount is 1,20,000. For the time being, ignore depreciation. So we would have calculated revaluation profit of 20,000. Next year, it is sold for 1,31,000. How much profit should we show it in subsidiary company books? Book value is 1 lakh, revalued at 1,20,000, and next year it is sold for 1,31,000. You should not look at 1,20,000. 1,20,000 revaluation is taking place in consolidated books. As far as subsidiary books is concerned, book value 1 lakh, sales 1,31,000. They will show 31,000. But as per holding company, as per consolidated books, it should be 1,20,000 to 1,31,000, which means 11,000. So we are supposed to show 11,000. We are showing the 31,000 excess 20,000, which is what is revaluation profit. So basically means next year, if you have sold the goods, like in this case, revaluation loss, whatever is there, that amount you take it to the con PL accounts. It will be adjusted again in the property, plant, equipment, as the case may be. So con PL, you need to adjust whatever amount we had taken to the goodwill column earlier, that will be taken back to con PL. With respect to stock also, earlier also you were taken to con PL, now also you take it. So any excess amount will be adjusted there. That is regarding if you sell items subsequently. We adjust the pre-acquisition. We don't adjust the post-acquisition. Post-acquisition element, we'll do it based on the latest percentages. So that's not a problem. But the adjustment should be with respect to the pre-acquisition. That is basically the net worth as on the date of acquisition. So share capital, this pre-acquisition reserve, this P&L account, whatever the changes have taken place, we have to adjust it. So we take out from NCI or we put it to goodwill depending on the changes. Like for one person maybe plus, other may be minus. Bonus calculation, yes, but bonus is, you see, we are not given any other effect here. But if any if any interest is changed, that means share of NCI will change. Like this, in this case, 1,24,750 is on the date of acquisition. If percentage changes subsequently, and if this has to be subtracted and this may have to be added, so you have to adjust in the goodwill and NCI. The amount, whatever the change will come, differential amount, so that to reflect the latest holdings percentage. Or actually, if you follow my format and you take the percentage as on date, that will take care automatically. But only when you take the old percentage, then you apply the new percentage, then confusion will come. But entry will be affected between goodwill and NCI. That will be the treatments if any interest is changed. We take the latest one. The format will take care, but as a concept you should be aware, because they can ask the journal entry specifically for that, or extract only of that. This format will not be applicable then. So if you follow this format, it will take care, because we take the percentage on the latest percentage. That's why, as if it was there from beginning. So I think one problem like this, a day before exam, it's sufficient for you to revise entirely. Of course, we will do consolidated cash flow also, multiple acquisition also there, that also will have it. And one more is there that I'll see if time permits, that is regarding that when you sell a subsidiary or when you have a, I think associate, I'll discuss. There is a change from P&L, OCI to P&L, that adjustments. Multiple acquisition, not chain holding, separate. You mean multiple acquisition or the chain holding? Chain holding will cover it, we'll discuss. Step acquisition is multiple acquisition. That we'll discuss about a small problem, the concept of it. Chain holding, I'll try my level best to do a full-fledged problem. I want to do it because that is, again, somehow repeatedly they're asking the same variety. Some 2-3 times I think they already asked, but still they'll ask. Lot of flaws are there, but still included here. I thought I included a problem. No, is it? Okay, maybe I'll try to cover some previous year question paper or something. I'll discuss at least the concept wise. Okay, anything else? Okay. Okay, so let us do the next problem. This will be on multiple acquisitions. So let's take a look at it. Entity D has a 40% interest in entity E. The carrying value of the equity interest which has been accounted for associate in accordance with Ind AS 28 is 40 lakhs. Entity D purchased remaining 60% in entity E for 600 lakhs in cash. The fair value of 40% previously held equity interest is determined at 400 lakhs. Net aggregate value of identifiable net assets and liabilities are measured in accordance with Ind AS 103, determined to be identifiable 880 lakhs. Tax consequences have been ignored. How does entity D account for the business combination? So earlier you are having 40%. Now you are acquiring additional 60%. A situation of multiple acquisition, because when you had 40%, you did not had any control. Now you acquired 60%, you have control. Essentially it means associate becoming subsidiary. Okay, so in this case what we should do is the existing investment should be de-recognized, or I'll discuss as a journal entry kind of thing. Normally what entry you would have passed on the date of acquisition, of course in the books of consolidated books you would have passed all the assets or net assets account, net assets acquired to bank or to investment, the amount paid to NCI, NCI recognized, and a debit would have gone to balancing figure goodwill. This would be our regular entry on the date of acquisition, which now also I'm going to pass. Only one extra element is I will not write to bank, that is I will write to bank to the extent of, in this case I'm acquiring additional 60%, but 40% I'm already having. I'm going to write it as to investments and will be valued on fair value basis. Or if I do a calculation format, it would be whatever amount paid plus fair value of non-controlling interest and fair value of already held equity. Consideration paid is towards 60%. Already held equity is towards 40%. Non-controlling interest, nothing is there because you're acquiring 100%. But if something was there, that would be under non-controlling interest. So this total represents the fair value of the assets acquired or the amount paid minus fair value of identifiable asset 880 lakhs. So balancing figure will become goodwill, and your book value of investments is showing at 40 lakhs. You will be recording at 400 lakhs. 400 lakhs because 60% 600, 40% means 400 proportionately. So your investment existing value is 40 lakhs, but now you're revaluing at 400. Therefore, you're going to recognize a gain transferred to P&L to the extent of 360 lakhs. So this is a situation of existing acquisition or associate and then becoming subsidiary. Or entry wise, if we discuss, the journal entry will be fair value of assets acquired account debit 880, goodwill account debit 120, to cash 600, to investments 40, to P&L 360, or directly to investment 400. So that's how you account for multiple acquisitions. So this solution must be there, no need to write. Okay. In journal entry also there, very good. Identifiable assets, goodwill, to cash, to associate, to gain. Okay, see if you have any doubts, or else we will move forward. Okay, next. Consolidated cash flow statement formats. Entity A acquired subsidiary entity B during the year. Summarized information from the consolidated statement of profit and loss is provided together with some supplementary information. We have statement of profit and loss, then we have consolidated balance sheet and other information. All the shares were acquired for 7,40,000 in shares. The fair value of the assets acquired were inventories, trade receivables, cash, property, plant, equipment, trade payable, long-term debt, goodwill, consideration paid. Prepare consolidated cash flow statement for the year 2002. So essentially cash flow statement is, we will start with, at the end we write, but we will start with the cash balance of 50,000 and we should end up with 8,20,000, and what and all have the transaction that have taken place, which we start with profit as per P&L account. If you can see, you can start with profit after taxation 5,50,000, and that should be the difference between reserves as well. Shareholders equity of 3,50,000 became 16,50,000. Yeah, this difference what should ideally match, but you have acquired also some shares, so the equity value would have increased. But anyway, do we have information of breakup? That's all. Shareholders equity is there. 3,50,000 has become 16,40,000. Okay, so we'll start with profit as per P&L account. That will be the first line in operating activities. We will add back tax so that we get profit before tax, or actually you can start with profit before tax only, 7 lakh. That is also permitted. I have to add back interest because in operating activities finance cost should be added back. Actually directly I can start from this, and then gross profit, even depreciation I should add back because it is non-cash in nature. So ideally it's I think gross profit minus operating expenses is a faster method, but anyway we go with reverse manner. We start with profit after tax, add back taxation, add back interest, add back depreciation, and that is your initial adjustments. So provision for tax added, depreciation added, interest expense is added. Then we should adjust for working capital changes. Normally what we do, trade receivables on the asset sides 5 lakh and has become 5,40,000. So we say there is increase in trade receivable 40,000, and increase in current assets means decrease in cash. But it is subject to one adjustment, that is acquisition. That is a special point relating to consolidated cash flow. So what we should do is, from this balance, I've done it here. Normally we do closing minus opening, but the closing, what you do is whatever we acquired that you subtract. The reason is this increase should not be considered because the purchase consideration is acquired in shares. So this is non-cash for non-cash. For that reason, when we take the trade receivables, opening balance 5 lakh is fine. Closing balance I will not take 5,40,000. 5,40,000 minus 80,000, which means 4,60,000. And 5 lakh has become 4,60,000. So 40,000 is a reduction in receivables, which will be added. That is applicable for trade receivables, inventories, applicable for trade payables, and what else? Long-term debt. Okay, long-term debt will come to it later. So take a look at this. From trade receivables, closing, I'm going to subtract part of acquisition minus opening. The difference is what is going to be my working capital impact. Inventories also closing 3 lakh. Take out what is acquisition. That is what we are going to take it, increase or decrease. That's what you see. How much we got? Trade receivable inventories 40,000 decrease, 90,000 decrease, and trade payable 2,40,000. You can see 40,000, 90,000, 2,40,000. So this is the adjustment towards working capital. We'll discuss other adjustment also. We'll keep quickly. Look at the balance sheet. The opening balance was 0. It became 1,80,000 because goodwill acquired is 1,80,000, and this goodwill acquired will not become investing activities. For the reason, the purchase consideration is by issue of shares. Non-cash for non-cash. This goodwill increase also will not come. Long-term debt, take a look at this. It was 6,40,000. It became 10 lakh. So increase only because of 3,60,000, I think. Yeah, so this 3,60,000 also will not come in cash flow statement. Income tax payable will come to it later. PP, let's take a look at it. 8 lakh became 16 lakh. How much we acquired? 11 lakh. So 8 lakh plus 11, which is 19, and depreciation 3, that is 16 lakh. So no other purchase also, it perfectly added up, no purchases, no sales. So this 11 lakh also will not come as part of investing activities, because this asset acquired but issue of shares, non-cash for non-cash. So long-term debt also no change. Shareholders impact, anyway, shareholders equity 3 lakh 50 became 16 lakh 40, that 7 lakh 40,000 is what is issue of shares. That issue of shares also will not come. So this is our working notes. Trade receivable you subtract, inventory you subtract, PP you subtract, goodwill you subtract, trade payable, basically whatever you acquired you subtract, income tax payable will come to it, long-term debt, shareholders equity. Income tax payable, you can prepare a ledger or you can do it in a horizontal format calculation. Take a look at the income tax payable. Opening was 1,10,000, current year taxation is 1,50,000, so 1,10,000 plus 1,50,000, it was supposed to be 2,65,000, but it is only 1,20,000, which means we should have paid the balancing figure as 1,40,000 as paid during the year, which will come in the operating activities as the last line item. And one more interesting point is, yes, you issued shares 7,40,000, which is non-cash for non-cash, but there is one cash element, which is this 20,000. So to this extent, you will take it in issue of shares, meaning you will take it in the part of the 20,000 cash acquired. It is like shares issued and cash acquired, you can take it as part of investing activities. Only this 20,000, not investing activities, financing, yeah, it's like issue of shares. Issue of shares for cash of 20,000. Shares are issued, cash received 20,000, so that will be part of financing activities. So this typing error, financing activities. Okay, I'll show the cash flow statements. Then, if you have any doubts, we will discuss. So profit as per P&L account, add provision for tax, add depreciation, add interest. Trade receivable decrease. So we are trade receivable decreasing, we are adding. Inventory decreasing, we are adding. Trade payable also decreasing, we are subtracting. Income tax payable, we calculate here 1,40,000. There is no investing activity. Financing activity, interest paid, that is what we subtracted here, 40,000, and issue of shares towards cash, this 20,000 will be financing activities. Opening cash, you add the net cash, you get closing cash and cash equivalent. So take a look at this statement as well as this working notes. Get your doubts clarified if you have any question. So no need to take it down, just look at the solution and ask. Because when you acquire subsidiary, what and all came to you? Inventory came in, trade receivable came in, PP came in, cash also came in, against which you issued shares. Share is non-cash, trade receivable is non-cash, will not come in cash flow statement. Shares is non-cash, PP is non-cash, will not come in cash flow statement. But cash is coming in, shares are issued, that will come in cash flow statement. Cash acquired as part of subsidiary. No, you are getting cash for issuing shares. You are getting trade receivables, issuing shares. The activity is issue of shares, and what we are getting is cash. So that will be part of financing activities. Partly paid in cash, then to that extent it will come. Two places. When you make a payment of cash, it will come in you're paying cash and getting cash. Cash to cash will not come. But to the extent of, let's say, assets, like for example PP, you are paying cash and getting PP, it will come in investing activities. If it is paid in cash as well as in shares, yes, we should take proportionately. If it is paid in cash and shares, it has to be taken proportionately. Like 50-50 means 50% of the PP will come, 50% of the PP will not come. Yes. To the extent of paid in cash, it will be part of investing activities. Yes. To that extent, in the sense, when the consideration is in paid in cash, it will come in investing activities. Now we are not taking, for example, PPE, 8 lakh became 16 lakh after depreciation of 3 lakh. So we have acquired 11 lakh. Out of 11 lakh, nothing came in cash flow statement. So if you're paying 50% in cash, that will come in investing activities to the extent of, yes, it will be reduced in investing activities. Correct. PPE purchased as a part of acquisition. If information is there, we'll go for it. There is no specific first in first out rule kind of thing, because that's like a slump sales, right? So it's not a specific one-to-one thing. So the standard also can't put restriction there. So this should cover your cash flow statement concept as well as the consolidation related concept. Show both even. Correct. Yeah, because if it is investing activities, something should come in. So it's not a proper reporting. How much marks will be deducted? I don't know. If the valuator is very stringent, he might deduct like 3-4 marks, or if it's just lenient, maybe 1 mark. That I don't know. But yes, that is not a proper reporting. Yeah, ultimately it is in valuator's hand. So when you're praying to the god, don't pray to the god that question paper be easier. At least pray to the god that when the valuator is correcting my paper, let him be in good moods. Try to pray those things so that he will be more lenient. Okay, right. Next. Okay, so regarding this chain holding, usually the problem format will be like this. Company A will acquire some shares in B, and B will acquire some shares in C. For example, A acquires 80% in B, B acquires 60% in C. Our format will not change. That is, we will start with C, then we'll write as B, and then we'll write as A. We will have the regular process. Only extra point to be considered is, especially while doing this C, I don't take 60%. We will have to take 60% of 80%. So when I'm writing company C, the analysis or the column will look like this. Holding company share, I will write 80% of 60%, which is 48%. So I'll write like 48, 48, 52. With respect to company B, there is no change. We will write it as 80, 80, 20. That will continue straightforward. Only the percentage what you have to have is A in B in C, which is 80% of 60%, 48% you have to allocate. Then regular format we follow, like here we write share capital of C, share capital of B, then we write pre-acquisition, post-acquisition. In the percentage only we are going to allocate. That point only you should consider. One extra thing what will come is we should write investments. This B in C investment is there. This investment will come under B. B's investment will come under B, and that we are going to subtract in goodwill column as well as we are going to subtract in NCI column. The goodwill, the investment by SCNS, subsidiary in another subsidiary, that B in C, only that portion we should allocate to two columns, because share capital is allocated like that indirectly. Investment also should be allocated to match the effect. Apart from that, the other process are all same. The format is same. You can write one below the another. It would be same. So in this context, see if you have any doubts. So afternoon sessions, just be extra careful, because you know the 2 to 5, whether AM or PM, is ideal for sound sleep. Sleep with sound. And you know, your examination time is also 2 to 5, just for your information. Maybe that's why institute tagline is that, right? Yesha Supteshu Jagrati. Those who are awake while others are sleeping. So you have to be awake while others are sleeping, and you have to be awake while others are awake also. So you have to be awake every time. Okay, so this is what is chain holding. Main concept is the percentage allocation and investment allocation. Only 2 points. We have certain things I told you, like associates, that recognition of OC and all. I'll discuss it later when you go to associates. But regarding consolidation, this is it. Any other doubts conceptually, you can ask. So predominantly the variety of consolidation problem you can expect is with dividend adjustment, unrealized profit, or revaluation profits. That one full-fledged problem. Then this chain holding problem, and problems on like multiple acquisition, consolidated cash flow statement. This is all the variety which have been asked in the exam so far. Multiple acquisition and all, they have not asked any full-fledged problem. Just asked only the adjustment entry, which is what I think subsequent exam also you can expect. Okay, let's go further then. Ind AS 110 is done. Ind AS 111, joint operations. And we have the concept of joint control. So what is the meaning of joint control? It's nothing but a concept of collective control, or you two put together can stop, can abstain others from taking a decision. But what is most important is, when you want to talk about a joint control, there has to be a contracts. A is having 30%, B is having 30%, C is having 30%, D is having 10%. Is it a joint venture, or is it a joint operation, or is there a joint control here? You don't imagine, yes, 30 and 30 is there, so A and B together can make a joint control. No, just A and B together will not make a joint control. Then every company will have a joint control. No, you can mix anybody. It will have up to 60% plus. Does A and B have a contractual arrangement? If yes, then there exists joint control. If there is no agreement between A and B, or any clause in the Companies Act or in articles in memorandum, some agreement, shareholders agreement, that A and B should agree. If there are no clause like that, there exists no joint control. There has to be a contractual arrangement regarding the decision to be taken. Types of joint arrangements, we have two varieties mainly. One is joint operations, other is joint ventures. Joint venture means you will have a separate vehicle. In the sense, for example, you and your friend want to travel between office and home, or office and classes, so you purchase one vehicle and you share the cost. That is separate vehicle is there. Other way what you can do is you just share the cost. We'll go in auto and we'll share our cost, or we'll go in bus, we'll share our cost. No, bus will be separate cost only. But just an example, wanted to tell you that you incur something and you share the income or expenses without having any separate artificial entity, and that becomes joint operations. Even in joint venture, even when there is separate vehicle, we look at some more elements, substance over form. But definitely, if there is no joint venture, if there is no separate entity, straight away it is joint operation, no doubt about it. Now, when there is separate entity being formed, you should look at the purpose, the reason why such entity is being formed. If the terms are like this, there is a separate entity being formed, but in this company, furniture belongs to me and vehicle belongs to you, building belongs to me. If you share like this, it is not joint venture. It is joint operation, substance over form. Because in the substance, it is still division of assets and liabilities having specifications. If there is a general thing, then only it becomes a joint venture. Or sometimes what happens, the joint venture is formed only for the purpose of fulfilling the product or the needs of the co-venturers. In such case also, it will be substance over form. If it is also supplied to outsiders and also to this joint venture, then it's okay. But it is only for the purpose of fulfilling the requirement of raw materials of these co-venturers, and it is according to the design made by the co-venturers, then also we apply the concept of substance over form. Even though it is separate entity, we deem it to be joint operations. Joint operation is we are going to apply as per respective Ind AS. For example, joint ownership. Typical situation exists in case of petroleum extraction companies like crude oil extraction. They laid down a pipeline to extract, and they'll share the asset cost, they'll share the expenses. That is joint operation, and you show to the extent of your ownership in the balance sheet as part of your assets and expense as the case may be. Joint venture is where you are going to apply equity method. That is what even we apply for associates. So when we go into Ind AS 28, we will apply that concepts. These charts are there, you can go through it. This is RTP May 2022 question. Identify the types of arrangements in each of the following scenarios. So each scenario is a separate question. X and Y Limited manufacturing similar type of mobile phones form a joint arrangement to manufacture and sell mobile phones. Maybe Samsung and Nokia, or Samsung and OnePlus coming together. Under the terms of, I see, they can do joint arrangement, but we can't write exam like that, no? How beautiful life would have been. I will read consolidation, you read business combination, we'll go and write the examination together. Of course, marks also will be divided, but it's a nice concept. But many times, yeah, put together also we don't score 100, so it's okay to share. Under the terms of arrangements, both X and Y are to use their own assets to manufacture the mobile phones, and both are responsible for the liabilities related to respective manufacture. Arrangement also lays down the distribution revenues from the sale of mobile phones and expenses thereof. X Limited, however, has exclusive control over the marketing and distribution and does not require consent of Y in this aspect. No separate entity is being created for arrangement. First of all, is it joint control? We have to discuss that fact. First of all, is Ind AS 110 applicable or not? Then we'll take a decision what type of joint operation, whether joint venture or what type of entity it is. So for you to call it as one of the varieties, there has to be a joint control. Now, is there thing regarding joint control regarding, let's say, manufacture? Do they manufacture together? They manufacture using their own assets, so it is independent. Okay, let's talk about sales at least. Now, selling regarding, is there any guidelines? Let's read that. Arrangement lays down distribution revenue from sale of mobile phones and expense incurred thereof. So, okay, how much share is going to be there? But if you read next sentence, the distribution revenue will be shared. X Limited, however, has exclusive control over the marketing and distribution function. First of all, we are discussing about marketing only because manufacturing is separate. There is no common thing. And regarding, we use the word relevant activities. That is a technical word. Relevant activities in this case is marketing distribution, which is under X Limited control and does not require the consent of Y Limited, which basically means there is no joint control. Expenses you share it. That is the account you do it separately, but not under this standard. As far as point 1 is concerned, there is no joint control. So no JC, no joint control. Continuing with one above, okay, some changes are happening. What would be the classification joint arrangement if XY Limited both jointly control relevant activities of the joint arrangement, including marketing and distribution functions? Okay. In this case, it is a joint operation. Joint operation. What would be the classification of joint arrangement if under terms of arrangement a separate entity is created to manufacture mobile phones? Separate entity means we are going for joint venture, but of course we should make sure that the entity separate means the assets and liabilities are not specifically defined. It has to be collective ownership. That's joint control. Okay, this is third. Next, continuing in the facts 3 above, joint arrangement is a means of manufacturing mobile phones on a common platform, but the output of the joint arrangement is purchased by X and Y in the ratio 50:50. The joint arrangement cannot sell output to third parties. The price of the output sold to X and Y is set by both the parties to cover the production cost and administrative cost of the joint arrangement entity. So here there is a separate entity, but you can see that it does not have any independence to sell to the outsiders. So the purpose is only towards their operation. It is still in the nature of joint operation in spite of the fact that there is a separate vehicle. Would your answer be different if X and Y Limited sold their respective share of outputs to third parties? The answer is no, there is no difference. Still joint operation because they are selling it to their parties, but still the joint vehicle don't have the power. They don't have the independence. You collect from them and you sell it, but X and Y Limited, that is the joint venture, should have the independence. That is not there. Joint operation. Assume that in 4 above 4, okay, the contractual terms of arrangement were modified so that arrangement is not obliged to sell to X and Y, but was able to sell to third parties. There you have the independence. It is joint venture. So these are the different varieties. I think study material also this type of question might be there, but anyway, this will give a good idea as far as the classification is concerned. Yes, separate entity is there. Separate entity is a guideline factor. It is not a conclusive factor. The conclusive factor is it is a separate entity in the legal terms, but in the form, are they really separate? Just starting a new company for the sake of it, then using it for your own manufacturing production, in substance they are part of our company only, and therefore they will not be treated as a separate company, even though in legal terms they are, but in actual output terms, manufacturing, they don't have control. So we look at the independence part there. Since they don't have independence, we don't treat them separate. Okay, so this is types classification of joint ventures or joint operation classification. Okay. Now regarding Ind AS 28, the only thing you have to understand is the concept of equity methods. This one small concept you understand, this entire standard is done and dusted. That's all. Nothing else required. Equity method. But equity method, though use the word equity, we are going to connect many points like dividends, control, investments. Many points are connected. So let me discuss. Then we'll read this problem. Equity method. For that, one basic question. If somebody asks you, what is dividends? Don't give them Companies Act definition. Dividend includes interim dividend. No, that is Companies Act definition for you. So what is dividend? Somebody asks you, what is your answer? Dividend is share of profits distributed. Now, can I say like this? Drawings in case of partnership firm and in companies related to dividends, they are same. Of course, drawings, I'm talking about profits only, not the capital. So drawings of profit by partner, is it similar to the dividends received by shareholder? No. I mean, yes or no. D for drawings, D for dividends, are they similar? They are not. Why not? No, I'm talking about profit. I'm talking about profit, not about capital. Profit you are withdrawing and your share of profit. So the only point distinction is control. But the effect is same. In the sense, inflow, outflow, portion of profit from the business. Conceptually they are same. Control wise they are different because partner can withdraw profits maybe in consultation with other partners, but in case of companies you cannot withdraw whenever you want. You have to wait for the board of directors to propose, approve, all those kind of things. As far as accounting is concerned, they are same. Again back to the question, can partner, if you prepare partnership, if you prepare partner books, I don't know whether you prepared any income tax returns as a partner, not as a partnership firm, will you recognize the income on accrual basis or will you recognize the income on cash basis? In the sense, when will you recognize the share of income from partnership? Do you wait for the money to be received, or in that year partnership made the profit, so I'll take my share, accounting purpose at least, share of profit? We will record it in the year in which profit is made. We don't wait for actual withdrawals, but that cannot be done in case of companies because investor don't have again the control. When the right to receive is established, the shareholder can recognize dividend income. Just imagine, had you recognized it on accrual basis itself, what would be the journal entry in the books of investor? In the books of partner, for share of income from partnership, not yet received, to be received, income accrued, what journal entry we pass? Investment account debits to share of profits. So investment is receivable, income receivable, and income transferred to P&L account. That is what is equity method. Equity method means recognizing the income on accrual basis. But where does this associate accounting and consolidation accounting differ? In consolidation accounting, we don't have investments. Investments are replaced by assets and liabilities representing net assets of subsidiary. But here you don't have the control over it. You don't have significant influence, which we say normally more than 20%. So investment, I cannot replace it by assets and liabilities because we don't have control. We'll show investments, but the income is recognized on accrual basis. So journal entry will be investment in associates to share of profit from associates, and that share of profit will be transferred to P&L. And which P&L? Consolidated P&L. not your regular P&L. Even if you have associate, you have to maintain two ledgers. I mean, separate financial statements and consolidate financial statements. Interesting thing will happen when you receive dividends. What will you do? Where will you take dividends? Normally, we take dividends to P&L account. But here, what do? Receive dividends? You don't take it to P&L because you already taken to P&L account. You are going to take it to investments account. Whether pre-acquisition, post-acquisition does not matter. The money received towards dividend will be subtracted from investments. You don't take it to P&L. If you do, it's duplication. It is like when you get the stipend to your bank account, you are happy. Again, you withdraw money from ATM, you can't be happy again. That is same happiness. No, you can't be happy two times. First of all, by looking at the stipend, you don't know what to feel like. But still, if you take it as a salary kind of thing, income accrual, you can take it to P&L. Again, income received, you can't take it to P&L account. Same thing with respect to dividend received, which is what exactly is equity method of accounting, applicable for joint venture, applicable for associates. Investments will be continued, income is added, dividend is subtracted. On the date of acquisition, you might have some goodwill element, but goodwill amount is an implicit amount in investment because we don't show assets and liabilities. I cannot show goodwill as well. The investment only, I'll show the breakup if available, the amount of proportionate goodwill towards acquisition, but it is not shown separately. Let's read this problem. Sumeru Limited holds 35% share of his share in Meru Limited, associate company. Value of investments on March 2001 is 3 crores in CFS. Sumeru Limited sold goods worth 3 lakh 50 to Meru Limited. The cost of goods sold is 3 lakh. Out of these goods costing 1 lakh to Meru Limited were in the closing stock. During the year ended, the profit loss account showed a loss of 1 crore. What is the value of investment in Meru Limited in the consolidated financial statements? If equity method is adopted for valuing investment associates, will your answer be different? If it had earned profit of 1.5 crores and declared dividend of 75 lakhs to equity shareholders of the company. So value of investment, cost of investment is whatever you have purchased, 3 crore. Even if you do goodwill calculation, this will be within this, inside this, nothing recognition outside. Value of investment, net assets so much, goodwill so much, but we don't show it anywhere. 3 crores cost of investments. Share of post acquisition loss, I will subtract from investments. You get unrealized gain because of this stock, unrealized stock. Who sold to whom does not matter. You simply subtract proportionately. How much it is? You sold 3 lakh, costing 3 lakh 50,000, means unrealized profit is 50,000, and 1 lakh is still in stock. So 3 lakh, 1 lakh means 1/3. 1/3 in still in stock, 1/3 of that 50,000, whatever the profits. Proportionately, 1/3 of 50,000, 16,000 something, I think you get. Then your share, the investor share, 35%. Proportionately, you subtract. Had we followed consolidation, full amount would have subtracted. But here, associates, we are not doing full consolidation. Only proportionate amount you subtract. That's what carrying amount comes. If they have declared dividend and there is a profit means I would have added 1.5 crore and 35%. Unrealized gain, I still subtract. If they declare dividend, and don't talk to me like in law terms, I know you attended the law class. So dividend declared, where they have paid. You have to understand from the spirit that here dividend declared means what is the impact of dividend. They want to understand that. You don't argue dividend proposed is different from dividend declared, is different from dividend paid, will be different from marks you think and marks you get. So you have to go with the context. The context here is dividends received. If you receive, what would be the impact? We will subtract. Does not matter whether out of current year profits, interim dividend, out of previous year profits, pre-acquisition, post-acquisition, no matter whatsoever, simply subtract dividend. It is part of investment value. That's the impact of equity method of accounting in associates. This was exam question, no MTP problem. But okay, this is a problem which can be asked. Previously was loss, so I have subtracted loss, and now profit added. In both cases, unrealized profit is subtracted and proportionate to the investor share. Dividend, whatever they declared, 35% of dividend you are going to subtract. Even if you calculate any goodwill, that will be internal calculation, not recognized separately. Okay, in this context, maybe I can discuss one more point related to holding consolidation. When you have a profit, you add it to NCI. The subsidiary company keeps making profit, you distribute to ConPL and NCI. If you have a loss, you will subtract. You will have a loss, and so much loss that can NCI become negative. That means it's an asset recoverable from NCI. Correct? No, NCI negative means recoverable. Actually, this problem is there in AS 21, where if there is negative minority interest, that will be absorbed by holding company. That concept is not there in Ind AS. So negative means negative will show it, because we are showing under shareholders funds. NCI is not shown as a separate line item. As regard AS 21, we show separately as NCI. They will come under below non-current, below shareholders funds, above non-current liabilities. They are separate line item. Whereas in AS, they are shown within shareholders funds. We have one share capital, other equity, and NCI. They are all shareholders, and therefore even negative means negative. There is no separate adjustment required. It's like asking this: if I have profit, I share. If I have profit, I pay tax to government. If I have profit, I pay tax to government. If I have a loss, government should pay tax to me. Logically, we will recognize. Yes, that's what is deferred tax asset. Why should not? We should. Only thing is, we cannot claim directly from government. We'll set off in the next payable amount. But effectively, we are collecting the money. They are not minor partners sharing only profits. They have to be responsible for losses also. Okay, and now that some news is going on, they are going to increase the capital gain tax rates, telling that this is a passive income, so 10%, 15% is too less. We should collect more tax. Yeah. So we don't know what else the government will pay again. Before those things again come and trouble you, you pass the examination. That's the best way to escape from all those points. In future, we really don't know what and all can come. You are having something like electives paper. We had only 2 electives, either May or November. Apart from that, there was no other electives. Now electives mean open book, it seems, and then there is 4-hour papers. And we are chartered accountants, we have to read company law, we have to read income tax law, we have to read GST law, we have to read contract law, we have to read information technology, financial management. In future, what? They'll ask you medicals, engineering. They also may be electives, no? Who knows? We don't know. Specialization of CA in engineering, specialization of CA in agriculture, and what else new things can come? Only God only knows. We are already coming up with new standards applicable for particular industries. Our life is enough suffering because of general standards. Now if industry specific comes, pharmaceutical accounting standards, consumer goods accounting standards, God knows what else is there in the stores. So when you imagine the future, your present becomes much more better, rather than you compare yourself with your past. Okay, this is the equity method. One more variety we have to understand. This is an exam question. Yes. but what asked in May 2019, and these kind of questions have the history of being repeated again. There is one simple method to estimate or predict the question paper in CA exam, especially CA final. Very simple technique, I'll share it with you. When you look at a problem or a concept or a section or a case law, will you feel like, I'll go to next problem? If you get that feeling, that is important for examination. As simple as that. This problem, I think, practically will not come. This problem, okay, this problem I'll leave it. Rest everything I'll cover it. Whichever you feel like you go to next problem, everybody would have felt the same way. So institute will like those kind of questions. So whenever you see in the study material, previous question paper, RTPs, okay, this has some complications involved that has high probability of being asked. Maybe this is also one of the variety. Let's see, Deepak Limited, an automobile group, acquires 25% voting ordinary shares of Sean Limited, another automobile business, by paying 4320 crores on 1/4/2017. Deepak Limited accounts receivable investments in Sean Limited using equity method prescribed under Ind AS 28. Deepak Limited recognized the share of net assets changes of Sean Limited using equity accounting as follows: share of profit and loss, share of exchange difference in OCI, share of revaluation reserve. Basically, whatever the associates have, you have a share in that. And in whichever manner they report, you should also report in the same way. If associates say P&L, it will get to your P&L. If associates say OCI, it will be added to the investor's OCI, matching concept. The carrying amount of investments on 31st March 18 is therefore 4.4779 crores, that is 4320. You paid investments 378 share of profit, 54 share of OCI, 27 share of PPE in OCI. On 1/4/2018, Deepak Limited acquired remaining 75% of the Sean Limited for a cash of 13,500 crore. Fair value 25% interest already owned 4860, and the fair value of Sean Limited's identifiable net assets of 16,200. How should such business combination be accounted in accordance with applicable Ind AS? They are also confused with standard. They said applicable Ind AS. So basically, in this situation, it is an associate becoming subsidiary or subsidiary becoming associate. The treatment is same. How it can be same? Associate becomes subsidiary or subsidiary become associate. In both cases, investment account will be closed. Investment account should be de-recognized. When you sell an investment account will go out and cash account will come in. When you do consolidation, the investments will go and assets and liability of subsidiary will come in. So in either cases, investment is de-recognized. Now investment is comprising of share of profit and loss, share of OCI, share of PPE. So when you de-recognize investment, what will happen to these items? You treat like asset sold. For example, let's talk about this PPE OCI. When you have a revaluation in PPE and later you sell it off, what will happen to that OCI, that revaluation reserve? The revaluation reserve will be transferred to general reserve. It becomes free reserves basically. Same thing you do as an associate now. You no longer an associate, so you are a subsidiary. Now that we don't worry. You are no longer an associate now. Therefore, the amount of whatever we are having in the ConPL, in the OCI, in the PP, all those accounts, we are going to close it. Where do we close it? We are all going to transfer that to the we de-recognize. For example, what we do with respect to this profit and loss, it's already in profit and loss, so I don't have to do any treatment. What about this share of exchange OCI 54? What I would have done if it was my own exchange difference in OCI? Remember, we discussed two things, with recycling, without recycling. Long time back in morning we discussed. Do you remember by any chance the list regarding the exchange difference? We will take it as with recycling means it will go to P&L. Now also we take it to P&L account. Then as far as PPE OCI is concerned, when you sell the asset, we will transfer it to general reserve without recycling. And now also this OCI, we will transfer it to retained earnings without recycling. The journal entries will look like this. The initial entries on the date of acquisition, you paid a 4320. So investment to bank 4320. Then you have a share of 378, investment to 378, investment to ConPL. Then exchange difference 54, again share of exchange difference. So investment to FCTR, exchange difference share. Then revaluation reserve share, investment to revaluation reserve. All debited investments, corresponding profits, OCI, revaluation reserve, credit. And when you acquire, what you're going to do, existing investments will first be revalued, reassessment. The previously held equity should be reassessed. What's the previously held equity value? The fair value of 25% already owned is 4860, and our book value as of now is 4779. So there's a difference of profit that will be transferred to P&L account, ConPL, profit on reassessment, revaluation. Then we are going to acquire the company. The net worth is 16,200. Net assets, asset account debit. To all the make the payments, you are making a payment to cash 13,500, to investments, the previously held investments 4860, and balancing figure you can transfer it to the goodwill. NCI is 0. One more thing I could have asked previously also. Format is this: amount paid, then previously held fair value, NCI, nothing was there. If what was there, I would have added some amount, minus net asset, goodwill. Which method of goodwill is this? Is this proportionate method or fair value methods? Fair value method. Proportionate method. NCI itself is not there. No, why will you worry about the two different methods? The question of fair value proportionate apply only when you have NCI. You are 100%, 75 now, 25 earlier. So valuation of NCI itself is not there. So proportionate question do not arise. Anyway, if MCQ question was there, I would have asked this question in exam, but in FR MCQ is not yet there. Maybe in future it can come, no one knows. Just imagine if MCQ was there and you have consolidation, how it would be. Okay. Future is future. Okay, now as of now, whether it's associate becoming subsidiary, subsidiary become associate, the investment account should be closed. That's why corresponding account on this FCTR and all should be closed. See, de-recognition of OCI, we are transferring it to ConPL because it is on foreign exchange difference, which is with recycling. Revaluation reserve is without recycling, so we are transferring it to retained earnings. So I have passed for each transaction separate entries. That is for reassessment of investment, one entry, acquiring, one entry, then transfer it to ConPL, one more entry, and transfer it to retained earnings, one more entry. Each component is separated, and institute give the one journal entry like this. If you are able to understand, God bless you. I am not here to interfere, but I would recommend to do it individually. Things becomes more comfortable. Once it's fine, you can pass one entry. Suddenly like 81 plus 54. Where is that 54 coming? Where is that 84 coming? Okay, or 81 coming. Calculation becomes more confusing. And whichever is comfortable, you follow it. This is regarding that Ind AS 28, where associate is de-recognized. Whether they become subsidiary or you sold the associates does not matter. But associates investments is de-recognized. Corresponding elements should also be closed. So take a look at this entry, see if you have any doubts. If there is, we have to recognize NCI. uh, Consolidated balance sheets we should prepare. Now also I'll prepare. Going forward, I have acquired in this case, it became 100%. So I will prepare a consolidated balance sheet from this date onwards. Basically, investment account is closed and the investment account is replaced by assets and liabilities. So these assets and liabilities I'm going to consolidate. I've written NCI also here so that you, for your reference. If some other problem, you might have some percentage, 10% on fair value basis, proportionate basis, this entry will be there. Investment ultimately de-recognized, replaced by assets and goodwill. If it was sold for cash, you would have replaced by cash account to investments had you sold the investment to somebody else. It can value Ind AS 109 that company, whichever it has. This will continue. No, there are two things. No, so this you are doing consolidation. That you continue Ind AS 109. A company can have multiple associates. For some associates, I can do cost method. For some assets, I can do fair value method. The choice is available. So the associate which I'm still continuing, as I can do fair value method. If I do fair value method, equity method will not apply. The cost plus share of profits, that will not apply. If I follow this cost method, then I will not going to revalue, I mean, do it under fair value method. But other associates, I have a choice. As long as you define the categories. For certain categories, we should have accounting policy of following either cost or fair value. We can follow different things. Any other question related to subsidiary becoming associate becoming joint venture, and those kind of elements? It's basically like girlfriend becoming wife or wife becoming girlfriend and so on. Uh, that is a de-recognition of subsidiary. Whether they become associate or they become joint venture or you sell subsidiary completely, impact is same. Entry will be reverse. In this case, what happens? For example, let's say your case of it's opposite, right? You're telling in this case associate becoming subsidiary, you're telling subsidiary becoming associate. The entry will be exact opposite. Goodwill will be de-recognized to goodwill. Net assets will be de-recognized. Full amounts. Full net good, exact opposite entry. The moment they are not subsidiary, no goodwill, no NCI, no net investments, no net identifiable assets. 100% they are de-recognized. Only one thing what you continue is investments, and investments might contain element of goodwill, that is inside investments, but goodwill is not shown separately. The investment will include a value of goodwill. See, for example, when you buy Infosys shares, it will include a value of goodwill. We don't know that, but it is implicit. That's how we treat in the books of associates, I mean for associates. Goodwill is not recognized separately. And consolidation is one such area which will not leave you so easily. It will come as this chapter. You go to business combination, consolidation follows. You do deferred tax, consolidation comes. You do any standard, consolidation will have its impacts. You can't run away from its concept. It will come in exchange difference also. It will come in foreign exchange deferred tax also. The fair value of investments. at the time of derecognition. On the date of conversion, it will be 109 fair value. And how do you calculate that investment? You can say a proportion of these two, no? Like if I have to calculate, I mean, just imagine situation why. Goodwill and net identifiable assets is the value of the company. As a percentage, will go to investments. 22% of this amount, goodwill and net identifiable assets. As a percentage, including goodwill, you will take it to the investments. And then going forward, you'll keep following the equity method. In income accrued, you keep adding. Dividend received, you subtract. Unrealized profit also we eliminate. Stock and unrealized profit we'll adjust against investments, proportionate to the extent of ownership. So consolidation may put challenge, but the more you solve, I think you will enjoy it more than any other standard, than any other concept. Especially Ind AS, more than AS, because everything is done pure logic and concept wise. So without the knowledge of accounting standard, you can still come to same answers. For the reason they are constructed so mathematic and logic. And again, financial instruments, we don't have to talk about it. It has lots of complications connected with consolidation. So consolidation is the foundation. And even share-based payments also, consolidation will come. What if parent company gives ESOP to subsidiary companies? So you can't escape this standard from other topics. Okay, so if no specific questions are there, I'll move forward. I don't remember, but not asked, but I've seen so many places that area being touched. RTP, MTP, I think. Maybe because it's too simple. Well, again, it's connected with, in a way, financial instruments as well. The financial instruments, this consolidation, and all, like no Bermuda Triangle. You will revolving around this and you'll get lost somewhere in between. Share-based payments also will add. Foreign exchange is also one more of that variety. Deferred tax, somehow it's not under people's radar. Business combination. One more point in Bermuda Triangle is that. Okay. Let's move further. Okay, so business combination, popularly we call it as amalgamation. This is one chapter again, follows wherever you go, whichever subject it is, accounting, advanced accounting, mergers, I mean SFM. Somehow maybe institute is so bored of asking this problem. These days business combination full-fledged problems are limited ones. Some specific varieties are there. We'll try to understand. To be specific, there has been a change recently, and that is not yet asked. Recently means 1 year is over, but still that area is not tested much. In which situation the business combination applies? It applies to transactions or event that meets the definition of business combination, which means you acquire business. You acquire a business. The business need not be amalgamation. It be demerger, merger, by whatsoever name you call it. It should be a business. If you acquire a group of assets, this standard don't apply. If you acquire a business, this standard applies. So acquisition of an asset, this is not a business. So again, the business definition is actually not so simple. What is business? Elements of business. They say it has to be input, process, output. It's easy to explain, but very difficult to apply. Inputs, see, economic resource should be there. It has to be a process protocol. Some hi-fi English we use, it's done. Process output. But in reality, if you say what is business, uh, we are having benches and projector. Is this a business? So that the question of business is very, very subjective. There has been amendment in Ind AS 103 which gives some more clarity, confusion, I don't know, but they have given something called as concentration test regarding the business. Let me read that once. A business consists of inputs, substantive process. The word was process, now they added a word. Substantive process applied to those inputs have ability to contribute to the ability to create output. Output means the result of input process applied to those inputs. Okay. Output means the result of inputs process applied to those inputs that have ability to provide goods, services for income from ordinary activities. I have a better charts. Where is that? Yes, this is a better chart. So what we have to do is apply some concentration test. Basically asking, are you buying too much of assets? If you're buying too much of assets, then don't call it as a business acquisition, you just call it as asset acquisition. If the concentration test is not passed, if it is failed, then you follow this process. And what process this? Check, is there any output? Is the business producing some output, goods, service in whatsoever manner? If there are no outputs, this you have to understand from the context, you will understand better. You think of a startup. They don't, for example, Cred. Hope you have seen the app advertisement Cred. Have you paid any money to them? Have they earned even 1 rupee revenue? I don't know. I don't think they've earned any revenue so far as well. They are just burning the cash. Especially startup companies, if you have interacted with some cousins or software engineers, you understand, they start the company not with the intention of acquiring customers. They start the company with the intention of being acquired. They want to sell this to some company and close it, wash your hands, that's all. So you don't search for customers, you search for who can acquire my company. No, there are so many things exist. You have to be interactive with them to understand it. So they build some database development process. I don't understand, but they use the terminology, something like this, some artificial intelligence, robotic process automation, some basic thing you develop with the objective of selling it to somebody else. So when in those situations, you don't have a customer, you don't have a business, all you have is losses, can you still say it's an acquisition? That's why this point is introduced, to say yes. The customer existence, the sales existence, the output existence is not the requirement. If there are no outputs, is there any critical process, including the skilled workforce? Critical process, that's what I was explaining. Some database management system, some kind of designing, some architecture in network equipment, something. If it is there, then even those things we will take it as business purchase. If it is not, as output also not there, critical process also not there, then it is an asset acquisition only. At least one of them should be there. That's what they say. If output exists, then you can say that. Then if output exists, then you can simply go for business purchase. Critical process and skilled workforce is what they call it. Workforce, a nice name, because unless you force, they don't work. So it is called as workforce. Anyway, so don't worry too much about it. What you remember is this apply concentration test regarding, basically they tell is 90% consists of assets only. Too much of assets, it is asset acquisition, not a process acquisition, not a business acquisition. Okay, if the asset criteria failed or you don't want to choose, the concentration test is optional. You don't want to apply that. Is the output there or critical process there? One of them at least is there, you call it as business. Both are not there, you straight away say it is a acquisition. Some more points you can go through it. Okay, on the date of getting a control is what we say. It's On the date of getting the control, you have to record like what we do in consolidation. So there are two methods of recognizing, either NCI at fair value method, NCI at proportionate method. That's what is applicable here as well. Actually, this is what tells, though we have discussed in Ind AS 110. Steps involved in business combination. You identify the acquirer, determine the acquisition date, the date on which actually control is obtained. Control is a defining factor. Recognizing and measuring the identifiable assets and liabilities, and balancing figure is goodwill or gain from bargain purchase. So the two things we compare. One is purchase consideration, the amount that is paid in the form of shares, cash, and net assets, net identifiable assets taken over. When purchase consideration is more, we call it as goodwill. When purchase consideration is less, we used to call as capital reserve. Still, some people use it. It is gain on bargain purchase. Please be careful when I say purchase consideration. It means if there are any NCI, that also I need to add, which is what you've done in consolidation. If you have any previously held investments like associate becoming subsidiary, then the amount paid plus the fair value of previously held equity plus NCI minus net assets acquired is goodwill, and fair value can be either proportionate method, a percentage of net assets taken over, or on fair value basis, the two methods of goodwill, the two methods of NCI recognition. What are the special points to be considered? Okay, some special points. Purchase consideration as per negotiation, even NCI is also to be considered. Assets and liabilities taken over will be on fair value except share-based payments. Share-based payment, the separate guideline. In accordance with the framework, assets and liabilities may not have accounted earlier. That does not matter. If it meets the criteria of assets, as on this date it is recognized. This is special point. Contingent liability is recognized. Ind AS 37 contingent liability is only disclosed as notes to accounts, not recognized. But contingent liability in the course of business acquisition is recognized for the simple reason. Imagine about purchase consideration. One company has contingent liability, other company does not have contingent liability. Will you pay same amount to both the companies? When somebody has contingent liability, we know something could be there. We want to bargain in our purchase consideration. So purchase consideration indirectly will include an impact of contingent liability. So when you record also, that should be reflected. So contingent liability, normal course of business only reported, notes to accounts. In course of business acquisition, it will be recorded as a part of net assets taken over. Intangibles other than goodwill is to be recognized separately, and intangible we mean even internal research. Research expense would be charged off to P&L, but internally developed some research process, if it meets the criteria at the time of acquisition, we still take it as an asset. We don't care whether previously it was taken to P&L account. That's what I mean by it may not have been accounted earlier as an asset. On the date of acquisition, if it meets the criteria of asset, we will recognize. Okay, so other points to be considered in course of business combination. Direct cost, basically like liquidation expenses paid by amalgamating company on behalf of vendor company and all. Any expenses in connection with amalgamation, legal charges, liquidation expenses will be charged to P&L account. If it is issued by way of land, fair value is considered. And there is something called as the measurement period, which is very similar to Ind AS 10, which says as on balance sheet date there is a condition existing and subsequently that uncertainty is resolved. A similar situation exists as on the date of acquisition. There are some assets or liabilities, value of which is unknown. Can happen, no? You want to acquire a company and you want to value, let's say, a franchisee, and the valuer is on holiday now. Now, will you say, let him come back on holiday, then only we'll finalize this acquisition terms? No, we'll do it on estimation basis. And when he comes, we'll do the final calculations. That's what is measurement period. If the required information is not available on the acquisition date means the date on which the control is obtained. The purchase price allocation is done on provision basis, estimation basis. As soon as the acquirer receives, meaning as soon as the person comes back from his holiday, the measurement period ends. Means your uncertainty is resolved. And during that measurement period, you should apply retrospectively, which means if amount is paid or less, asset increase, asset decrease, adjust that in goodwill. A step acquisition is what multiple acquisition. The previously held equity will be revalued and taken to P&L accounts. If there is any separate relationship, in the sense there will be mutual, there might be some mutual payable, receivable, vendor, purchaser relationship, or there might be like you have given the franchisee to that company and you're acquiring that company only. So their separate relationship exists. You set off after amalgamation. It will not have any impact on goodwill or gain on bargain purchase. Okay, there's one more thing regarding the share-based payments. There are two varieties. When a new company acquires, you can replace with your share-based payment plan, or you say, okay, whatever existing, let it continue. If acquirer replace the share-based payment award, in that case, what we are going to do, we should calculate something, this proportionate amount. This is like a cumulative expense. It is original award multiplied by the vesting period completed, denominator vesting period completed or new vesting, whichever is higher. In the sense, suppose vesting period completed is 8 years and still 3 years pending, and as per new plan only 5 years pending. So what is going to be the total period? 8 by 8 plus 3 or 8 plus 5. So basically we select total period whichever is higher. In this case we'll select 8 by 13, 8 plus 5. So this will be the cumulative expense. So that will go to the pre-combination period, meaning you take it as a liability at the time of acquisition. And the fair value of the new award minus liability, the differential amount, we take it as post-combination expense. If acquirer does not replace, if it continues, to the extent vested means the condition satisfied, you take it as part of shareholders, part of NCI. Not vested, you take it as balance, whatever to the extent to be completed, you are going to take it as post combination expense. It will come in the subsequent period after acquisition. Okay, there is one more thing regarding contingent consideration, meaning it's not payable now, it's payable after some years or after fulfilling some conditions. If it is payable in connection with employment, then it is a post combination expense. If it is not connection with employment, we treat them like shareholders. Like what do we do? If it is within the adjustment period, we adjust in goodwill. Adjustment period we discussed from the date of acquisition date till the date on which the uncertainty is resolved. After measurement period, then you have to check whether it is in the nature of equity or debt. Again, this is in connection more with financial instruments. If it was classified as equity, no remeasurement. That is a principle in equity we follow. We don't usually change it. And if not classified as equity, then the remeasurement difference should be transferred to P&L account. Okay, one last point, that is called as common control business combinations. So common control means the entity under which you are at present and the entity under whom you are there after business combination. If the controller is same, then it is common control under business combination. It's a carve out. It is not there in IFRS. It's made especially for Indians, for our supernatural abilities. Basically means that when you move from one company to other company without changing the control, the value also should not change it because control has not changed. So back to basics. If you remember again your previous life, amalgamation in the nature of merger, we apply pooling of interest method, a very similar approach. In fact, same approach is what we are using here. We don't use the word pooling of interest, impact is same. Assets and liabilities at book values, no adjustments to reflect fair values. So balance sheet, balance of retained earnings also will continue as it is. Basically, pooling of interest method, you are not allowed to change any values. Book value only you can acquire. One special case quickly we'll discuss, that is reverse merger. Okay, so reverse acquisition, reverse merger. Example, for your company has a 40% shares, 40 shares, and you issue 60 shares. So company A issue company B 60 shares. So you think A is acquiring B? Yes, legally it is so. But after acquisition, B becomes the controller, and that is why B is the controller after acquisition. So A is called as the legal acquirer, but B is called as the accounting acquirer. So the accounting, what should happen is record as if B has acquired A, and record B has acquired A means all the values of A can be fair values, and B, which is being taken over, should be at book values. And difference you will see, all other things fine, the difference you will see in share capital, because even though B acquires A, we are accounting, but we have to show A share capital only. Share capital we can't show it as B because share capital should be legal, it cannot be any accounting purpose. So their share capital difference will come, only that point you adjust it in reserves. The share capital of A, the share capital of B, what was supposed to be issued, that difference in share capital you adjust it in reserves. Okay, regarding again this reverse merger, the one problem which institute has done, according to me it's not completely right, there are some limitations, but anyway, again I have already recorded a video available in the YouTube channel, please watch it. It's I've discussed both my solution and institute solution, and I've told you why I've followed this, and I'll also tell you how, I also told you how institute has followed. So please watch that video. Still, if you're in doubt, you can message me over there. But basic concept is this: you have to record as if other companies being acquired, meaning in the sense the accounting acquirer will be at book values, the acquiree will be at fair values. The only difference you will come across regarding the share capital, because share capital we have to go with legal acquirer. The difference in share capital, I'm going to adjust it in the reserves and surplus. That's the summary of the reverse acquisition. So I've shared a video, please watch it in detail. After that, you find any issues, you please send me a message. Okay, any doubts conceptually in the business combination Ind AS 103? I don't have much questions, so we will take some to understand. But conceptually, if you have any doubts, get it clarified. Yes, please. Yes. Uh, Net asset method, the working note cannot be used. But where will you come across that situation of asset minus liabilities? It can happen in business combination. It cannot happen in consolidation, where they will give you two balance sheet and ask you to do consolidation. That is where that method will apply. When they give you assets and liabilities, and we have to arrive at net assets and then compare with purchase consideration and say balancing figure goodwill, that method, that table method, we cannot use it. It has to be net asset method. And net asset method means you should do separate calculation. So as on the date of business combination, you have to calculate using asset minus liabilities. The share capital plus reserves, because there it is too simplistic. Capital plus reserve is net assets. That is basically designed for full-fledged problem. So the net assets comprise only of capital plus reserves. Where here we go asset minus liability method. I mean, if you start using that table, we can, but that is becoming that will not serve the purpose. We do separately asset minus liabilities. We compare with purchase consideration. Difference is goodwill or capitals. The table is not required because we got the goodwill, we got the net assets, we prepare the balance sheet directly. So the consolidation is there to take care of the adjustments which will come many things after acquisition. They give you the information on consolidation date, but we have to prepare from the beginning. So that is where the table will help you. Ind AS 103, what we do is we prepare as on the date of acquisition. The table will not be applied. So we will do with respect to what institute method is, which is working note purchase consideration, working note net assets, difference goodwill. We follow that method. Okay. Okay, so let us take this problem. Please make sure that you take a deep breath and breathe out all those things. I should say this is not for weak-hearted people, maybe injurious to health, all kind of disclaimer I can put. Let us start the problem. This is there, or this was there in the new study material which is added, as well as in RTP. I really don't think the same question can come in the exam, but quite a few points here might be useful in our understanding. So let us take this problem. Company X is engaged. So your X is now engaged. In the business of exploration and development of oil and gas blocks, maybe imagine like a Reliance. Company X currently holds participating interest in the below mentioned product block as follows. Company X 30%, Y 60%, Z 10%, total 100%. Meaning there is some cartel or some group, and in that group company X is also one of the beneficiary, and you are having 30% stake, participating interest in the producing block. For the above block, XYZ entered into unincorporated joint venture, meaning there is no separate entity being formed. Company Y is the operator of block AWM01. You imagine like a driver. So 3 persons are there and you appointed that company as driver. Company X and Y, what? They sit and enjoy. Y is the one who works. So company X and Z are joint operators. Company Y incurs all the expenditure on behalf of joint venture and raise cash all to company X and company Z at each month and in respect of their share of expenditure incurred in joint venture. All the manpower and requisite facilities or machineries are owned by joint venture and thereby owned by all joint operators. For the past few months, due to liquidity issues, maybe corona effect, companies that defaulted in payment of cash calls to operators, and therefore company Y operator has issued notice to company Z for withdrawal of their participating right from 1/4/2001. So they tell company Z, please go away, but company Z has filed appeal with arbitrator on 30th of April. I don't know what and all they're telling. I hope they don't tell their personal problem and personal issues. Financial performance of company Z has not been improved in subsequent months, and therefore Z has decided to withdraw participating interest rights from the block. So basically, Z filed appeal, now they are withdrawing and entered into sale agreement with company X and Y. As per the terms of the agreement dated 31st May, the company X will receive 33.33 share and company Y will receive 66.67 share of PI rights owned by company Z. So basically it's like taking over company Z. Indirectly, X will take over company Z to the extent of 1/3 of share and Y will take over to the extent of remaining 2/3. Company X is required to pay rupees 1 lakh share against 33.33% share. Of course, you don't get free of cost. You have to pay for it. You have to pay 1 lakh for the rights owned by company Z. After signing of the sale agreement, operator company Y approach the government of India for modification in PSC product sharing agreement, that is removal of Z from the PSC, and government has approved this transaction on 30th of June. Government approval for the modification is essential given the industry in which joint operators operate. The balance sheet on 31st May is given, 30th June is given on company Z, 31st of May, 30th of June. Additional information. Okay, now the information is not sufficient. Additional information. Fair value of PPE and development of CWIP. CWIP is capital work in progress. Owned by company Z as per market participant approach, means market value is 5 lakh and 2 lakh respectively, will give lot of respect. Fair value of all other assets and liabilities acquired are assumed at their carrying amount except cash and cash equivalent. Cash and cash equivalent of Z are not to be acquired by companies as per terms of agreement. Tax rate to be 30%. As per Ind AS 28. So far we did not know it is Ind AS 28. All the joint operators are joint ventures whereby each parties that have joint control of the arrangement have rights to the net assets of the arrangement, and therefore every operator records their share of assets and liabilities in their books, meaning you follow joint operation approach. You need to determine the following. Should you solve this problem or go to next problem? Whether the above acquisition falls under the business or asset acquisition as defined under business combination Ind AS 103, determine the acquisition date, prepare journal entries, draft the balance sheet on your analysis in part 1 above as at acquisition date. So where to start here? Basic point is this. Company X is now taking over company Z. Not fully, only to the extent of company X will receive 33.33, basically 1/3 of the shares we can say. And 1/3 of the share you are acquiring, so 1/3 of the assets also you are going to show it. That's what is joint operation. You show it on proportionate basis. The first question is this: will this come under Ind AS 103? For applying Ind AS 103, the definition should constitute business. Are you getting the business, or does it satisfy the definition of business? Business basically should be a integrated set of inputs which can generate outputs. the block AMW is already providing income. No, that share is there. It is unincorporated joint venture. The agreements and all is in place. So it has defined process, defined set of activities capable of generating revenues and income. So it is satisfying definition of asset. Basically means Ind AS 103 applies. And if you say Ind AS 103 don't apply, then we stop the problem. So we can't say that the problem is over. So that is not respectful. And you don't write the answer like that, but you have to write it as its constitute business. It is defined as the integrated set of inputs capable of generating outputs, or the significant process, critical process. All those points are there. So that first point is there. Yes, the above acquisition falls under business acquisition. Determine the acquisition date in accordance with the above transaction. Acquisition date is 31st of May or 30th of June. It's not whichever is later, whichever is higher, whichever is lower. It is depending on the government approval. And because they have a point for appeal, and they then go to government, and they also said, I think somewhere later, or where is that? There somewhere I read it. No, that is essential. Yeah, the government approval for modification is essential. So unless the government is approved, you will not be able to start operating the whatever block it is. So you don't get the business benefits. So the acquisition date is the date on which control is obtained, 30th June. Unless the government approves, you can't get the control, you can't get the benefits. So second point is that the acquisition date is 30th of June, date on which control is obtained. Pass or prepare journal entries. Now regarding journal entries, first of all we should know any goodwill or gain on bargain purchase. To the extent you have acquired, you are going to calculate for that. And they also given something like a tax rate, meaning there will be an impact of deferred tax. So those things is given as a working notes. Let's try to understand the statements. Okay, first note 1, note 2, what they have given. Let's read it. Note 1, fair value of PP. Have they given this in the notes? Fair value of PP is 5 lakh, and CWAP is 2 lakh, and you are acquiring 1/3. So 1/3 of 5 lakh and 1/3 of 2 lakh. I think that's what it comes to. Just check it. Okay, 33.33% of 5 lakh, 1,66,650, and 2 lakh 33 1/3. I think is 66,666. So that's what is these two numbers. 1,65,000, yes, and 66,660. Yes, these two amounts are fair value given. We have taken. Then we are having other items from the balance sheet. Don't look at the 31st column at all. That is now no longer valid. It's redundant. Take a look at only the asset side. Asset side first. Property, plant, equipment. That's the fair value given. Rate of use of the asset amount is 20,000, and of the 20,000 you take 1/3. That is 6,666. Similarly, then you have other assets. I think that's what they have repeated here. Book value 50,000, and 1/3 means 33.33%, 16,665. Then 30,000, the 30%, 1 lakh 30%, 2 lakh 30%, 50,000 30%. Liability side, provisions 33.33, other liability 33.33, current liabilities, trade payables, total current liabilities, everything liabilities they have taken 1/3 1/3 33.33 into acquisition, into consideration. Then we have to calculate the deferred tax asset or liability, for which they have given this book values. For that purpose only this column is maintained. But before we go further, see whether you are able to understand. I mean, don't worry about the numbers, just understand the context, and see if you are able to understand. If you have any questions on calculations, get clarified, then we'll move further. Again, just understand principally, don't go to the individual calculation, because in the exam point of view I really don't think they can ask you such a big problem, but its concept can still be asked, reducing it to a smaller problem. So apply it in its principle regarding calculation of 1/3 of the values, or any other doubts until here. So in these cases, any consolidation format will not work. We have to go with the regular working note format only, that is net assets calculation and purchase consideration calculation. Okay, so this is what is regarding the assets and liabilities taken over as compared with the book values. Book values we have taken 1/3, and only these two amounts are different, PP and development of CWIP, because they have given the fair values. All other amounts are taken from the balance sheet, and since 1/3 is taken over, only 1/3 is what applied for the purpose of comparison. Okay, regarding goodwill, before goodwill, let's discuss about deferred tax liability or deferred tax assets. Again, we will discuss in a separate standard, but to the extent we can here, ideally what we should do is we should take a book value of each element separately. We should do it, but they have used the shortcuts. Let's try to understand it. They have taken all the net assets at fair value and all the book value at fair value, so they're doing it on a net basis instead of doing it on one-to-one basis. Let's try our level best to understand. You see this column, what is the total book value of non-current assets? 1,56,651. This is the book value, and fair value is 2,56,000. Current assets, actually should take out the cash and cash equivalent. You should have subtracted it. That is not taken over. So remaining amount we take it, that is current assets minus non-current liabilities and minus current liabilities. Basically we are doing asset minus liabilities, net assets. Net assets of book value is here, net assets of fair value is here. That's what they are subtracting. Non-current assets, book taken over value, current assets except cash and bank, current liabilities you subtract, non-current liabilities you subtract, you get net assets acquired at fair value. Book value of the assets, they have not shown, but you can calculate here. But will you get it? Just check it out. 1,56,651 plus 1,26,654 minus 99,930 minus 66,660. How much you get? Let me calculate. 1,56,551, 1,26,654, 99,990, 66,660. So if add current assets, current liabilities, and current assets and non-current assets, you get 1,16,555, and if I take out that cash, 66,660. I think I get that number, 49,995. Okay, some 895, maybe some typing mistake. Okay, so 49,995. Hope you get it. That asset minus liabilities. I'll just tell you once more. I've taken 1,56,651. Then I've added current assets. I subtracted cash. Cash should not be part of it. Subtracted liabilities. Subtracted current liabilities. That is the net assets, book value. Fair value, this column, same thing. Instead of book carrying value column, if I take these amounts, that will give me the fair value of net assets acquired. That is the net assets and book value of assets, 99,990. When the asset value is high, net assets is high, book value is less, we arrive at deferred tax liability. Indirectly, it is like gain not yet taxed. It is a profit because asset value is high. It's a gain not yet taxed, and therefore it's called as deferred tax liability. We will discuss more in the concept of AS 12, Ind AS 12. Okay, so this is the deferred tax liability calculation. Then using this deferred tax liability, we calculated the goodwill, that is basically you can say balancing figure kind of thing. Total current assets, that is 2 lakh 56,641 here. Then 59,994 except cash and bank balance. So from 1 lakh 26,654 you take out the cash equivalents. Non-current liabilities, this number 99,990. Current liabilities 66,660. Deferred tax liability, what we just calculated, 30% of the difference. Net assets is 1 lakh 19. 1 lakh is consideration paid. So balancing figure, gain on bargain purchase, that is excess amount. That you don't worry about any deferred tax liability on that. On goodwill and on gain or bargain purchase, we don't apply deferred tax liability. Otherwise, you will be keep on applying in a loop on deferred tax on that. You keep on getting it. Okay, then you pass a journal entry based on this. This working note only will become journal entry. That is, you debit all the property, plant, equipment, all the fair values, including this deferred tax liability, gain on bargain purchase, and amount paid 1 lakh, and that's what difference we got, gain on bargain purchase. So take a look at this calculation of goodwill or bargain purchase and the deferred tax liability, and see if you have any doubt. And after this is just a formal process. Once you know the journal entry, these amounts are added and balance sheet is prepared. But the key element is understanding this deferred tax liability calculation and this goodwill calculation. See if you have any doubt in the principal terms. Correct. And even here, actually, we should not have taken cash at all. But anyway, they're showing separately. But cash is not taken over. That's why. So even here, actually, we should not have taken. This line also should not have come because cash is not taken over. But then they added it and then they subtracted it. No, they have said cash is not taken over for that reason. Then this will come in all the places. It will come in book value also. It will come in taken over value also. Effectively, no impact, but it should have a part of assets taken over. That will influence this number, no, bargain and bargain purchase when you take over cash. But the cash, there is a logic behind it because cash you cannot say 1/3 I'm taking. Cash, actual cash should be given. Ownership I can have 1/3, but the cash I can't have 1/3 ownership. That's why they have not given. But anyway, even if they're given nothing given, we'll assume 1/3 is taken over. Everything proportionate. And no deferred tax impact because the amount will be same. Since consideration paid is less, it became gain. If it consideration was more than 1 lakh 19, it would have been goodwill. Which against? No, you mean if cash is taken over? If cash is taken over, then the net asset account would have been higher. even more higher, so you would have got even more gain. So if 66 was there here, this would have been 1,80,000 or something. So this would have been some 80,000. So it would have added to the gain in this case. And regarding liability portion, just remember this: when the fair value is more, it just means it's an income yet to be taxed. So you create a liability. And you can expect a question only on this. Some previous questions I have seen, they'll ask you just to compute deferred tax liability, or just compute this journal entry, or compute goodwill, which has more impact on deferred tax liability. So that may also be a separate independent question. You can do it individually there. That's what most problem we do. But here it is done on net basis. So for example, if fair value is higher, it means again for tax purpose we don't show it. So income untaxed, deferred tax liability. If liability is increased, there we would have told deferred tax asset. Anyway, asset liability will get a better clarity when we do Ind AS 12. Okay, then balance sheet is just a formality, because we know these are the amounts to be added on the 30th of June. Just add these numbers. That's how the balance sheet will come. So all these adjustments represents the journal entry what we passed. So gain on bargain purchase, they have added to the capital reserve, or they're taken to OCI. And 1 lakh cash paid, so subtracted from cash. All other items, whatever acquired, is added, including the deferred tax liability, 29,997. So once you are done with that entry, journal entry part, preparing balance sheet is again just a formality. The key elements here are a computation of goodwill, computation of deferred tax, and then passing journal entry. Okay, so that is with respect to this problem. Any other questions? Okay, any other concept in a business combination? Okay. RTP May 2022 question. Entity A acquires Entity B. Entity A acquires the former shareholder of Entity B to pay rupees 900 with an additional payment of 500 if subsequent earnings of the Entity B reaches a specific target in 3 years. The former shareholder also become employees. On the acquisition date, the fair value of the net assets of Entity B amounts to 850, and the fair value of additional payment is estimated to be at 200. On the acquisition date, outflow of additional payment is not probable. Over the next 3 years, cumulative earnings of Entity B before considering the effects of additional payments amounts to 1050. At the end of the year, 3 entity A pays 500 as the conditions were met. State the impact on financial position and the result, classifying the payments as remuneration and contingent consideration. Okay, so what is the consideration amount? Payable is 900. Entity A agrees to pay 900 with additional payment of 500 if some consequences, if some earnings were met. It's depending on some situation, therefore it's called as contingent consideration. For example, your parents also might tell, if you pass the exam in first attempt, we'll get you four-wheeler. If you pass the exam with second attempt, we'll get you two-wheeler. If you don't pass the exam, we'll get you three-wheeler, so that you can survive somehow. Contingent depending on the results. That's what happens. So, and in those cases, it should be valued on fair value basis. That is, fair value is estimated to be 200. So at the time of acquisition, you will value at rupees 200 as part of consideration. Okay, so that's what this table shows. Let me show it to you. Consideration, remuneration was 900. Okay, contingent consideration, there's additional amount which is 200. Fair value at the time of acquisition, you should value it on fair value basis, so it is 200, comes to 1100. And what is the book value or the fair value of net assets? Identifiable assets, fair value of net identifiable assets 850. So if you subtract, that is what you are going to get as goodwill. And total goodwill is 250. And if you don't consider that, of course, yes, it is 200. And what was supposed to be the target? It was supposed to apply on the acquisition date the fair value of the net assets. No, you're supposed to, target is not given, just a specified target. Okay, how much is not given? After 3 years, the entity pays 500 as conditions were met. 500 only they were supposed to pay. Yes, 500 they pay. And when you pay 500, what you're going to do is, earlier you recognize it as 200s. Now when you pay 500, that means extra 300 will come. The 200 is already recognized as liability. You have to pay 500. So extra liability will come, and that additional amounts will be transferred in the nature of liability, is transferred to P&L account. They're not mentioned, but yeah, that's what they mentioned. The additional payment will be transferred to the payment account. So your earnings was 1050. If you subtract this 300, your net impact becomes 750. Anyway, that is not a important point. Basically 300 comes because 500 was the agreed amount, 200 fair value you have already recognized, and therefore 300 is the additional payment, additional expense need to be recognized. But if you consider it as a remuneration, that means you don't consider 200 as part of fair value and all. So entire 500 becomes additional payment. Ultimately, the impact would be more or less same. And impact here difference you see, that is because here we have adjusted in goodwill, and here we are adjusted in the expenses. The impact would be that in the situation where you recognize fair value, your goodwill gets adjusted. Where you don't take it as fair value, you will take it as expenses. But of course, in the examination, they asked you the impact, so they have shown under 2 columns. But if they're not shown any impact, we would have followed only 1 column, considering it as contingent consideration. That would be the impact. Okay, that is RTP May 2022 question. Which one? Then the fair value amount would be transferred back to general reserve. Goodwill will still remain. That will not be adjusted. That whatever amount of liability reserves you created, that will be back to general reserve. So effectively, journal entry is the goodwill account to general reserve account. But that's the series of events have taken place, so we have to show it. No, we don't show it. This is like impact after 3 years. They have written the word across 3 years. Because we can't take it over a period of 3 years. That we will know only after the payment have been met. So this is just the impact. We will not amortize. This is when the event occurs, you re-estimate, or at the end of the every year we re-estimate, depending on the fair value given. Like 200 becomes 300, we recognize 100 more fair value given. But otherwise, we don't do any amortization. In the event in which you actually make the payment, it is accounted as changes in estimate. This will be treated as liability in the nature of debt. Therefore, I take it to P&L account. If it is not debt, I will not remeasure it. But either case, I will not take it to OCI. Either I'll adjust in reserves or take it to P&L account. So no question of transferring it to OCI. Remeasured. You have to remeasure fair value at the end of every year. So the changes in fair value go to P&L account in the nature of liability. If it is nature of equity, then no remeasurement. And difference also will not go to P&L. The difference will adjust in other reserves directly in the balance sheet. We don't take it to the P&L account. For the transfer to P&L, the changes in fair value of contingent consideration. We use that, changes in fair value of contingent consideration. That is impairment. We don't amortize. We test for impairment as per Ind AS 36. We test for impairment. In impairment, yes, that requires to be transferred, we will do it. Goodwill will be in case of, yeah, in case of impairment, goodwill will be the first one to write off as part of CGU, as part of a group, as part of a unit. Goodwill cannot be impaired independently. It has to be part of the unit, or enterprise itself is considered as unit. So in examination, you can still expect a question on contingent consideration, share-based payments, or there was one problem considering all these points in one place. That is also a possibility. But my expectation is, I think they'll ask you application, whether Ind AS 103 applies, that asset acquisition versus business acquisition. Maybe that one area they can ask. There is also one more variety of problem where they'll tell you patents acquired has fair value so much, and then internally developed intangible asset is so much, and then we have to calculate goodwill. So what we should do in business combination is, to the extent possible, we should recognize separately patents, market value, everything market value. None of these things is cost. All acquisition as a course of business combination should be on fair value basis. Exceptions only are the share-based payments and some other things we discussed, like contingent consideration and all, which is our additional items. But every liabilities, assets should be taken out fair values. In case of common control business, book values. Okay, good. Standard name Ind AS 8, accounting policies. Again, this is one standard, very easy to explain, most complicated to apply in practical life. Examination also more or less easy, but in practical life application is very challenging. So this standard covers broadly 4 areas: selection of accounting policies, changes in accounting policies, changes in estimates, and prior period errors. So what is the accounting policy? As per this standard, the definition is broad. It is principles, basis, conventions, rules, practices. So many things As a practice you might follow, as accounting principle you might follow. Accounting policy is much broader term. It's not just accounting principles. In life also we'll have so many policies, many things comes out of conventions, some sort of principles. We may not have logic behind it, so people will follow it mostly, so we'll also follow it. Sometimes we have to do it. So if you ask question, why should we go on left side and why not I'll go on right sides on the roads? That's how we Indians, we go everywhere. No, you see, we don't have any rules. We are freedom country, we can go everywhere. But we need to follow some conventions, we need to have some rules as far as at least accounting is concerned. That is part of accounting policy, be it with respect to method of valuation, method of artwork, and you have to choose accounting policies which are not covered in Ind AS more carefully. For example, government grant, we have a standard. Grant given by government, we have various things for fixed assets, trade like this, for sales like this. What if you receive some grant from private company? You received some grant from Infosys Foundation for your company. Accounting standard will not cover it specifically. It's not government grant. But what we should do? The similar aspect is covered, therefore we give preference to that. That's what we say criteria. So we should use hierarchy. That's the first preference we go with similar items. Government grant is not there, but the grant received from organization is very similar to government grant. We apply in the same principles. That's why name all conventions, principle, rules, practices are accounting policies. FIFO, FIFO, weighted average cost method, or cost model, revaluation model, they are covered under Ind AS. There are something which are not covered in Ind AS as well. We have, let's say, AS2 does not consider, it excludes valuation of livestock. AS2 does not consider valuation of livestock minerals. Minerals are almost excluded from all the standards. Why we should be excluded from AS2 livestock? Does it mean we should not do valuation? It is outside the scope of AS2 for reasons. Just example, there were 100 cows at the beginning. You purchased 2 cows. You sell 2 cows. Year end there is 101 cow. How do you calculate? FIFO method? Average cost method? What average cost method you apply there to get the number? So you cannot apply Ind AS 2 principles. You can't apply any of those standard cost method. Okay, the cost of manufacturing 1 cow is standard cost is this much. No, I cannot do it. And therefore it is outside the scope of Ind AS 2 does not mean outside the scope of valuation. We have to do some reasonable valuation, maybe fair value basis. But fair value is not accepted in Ind AS 2, that's why it's outside the scope. Accounting policy is applicable in those areas where the standard does not specify. We have to apply our judgment and come to conclusion for similar transactions. Okay, there is a hierarchy involved. Let's focus. Changes in accounting policies allowed when there is required by Ind AS, or it results in true and fair view or more faithful presentation, or the balance sheet, financial statements becomes more relevant. And what are not changes in accounting policies? Transactions that did not occur previously, which means introduction of accounting policy is not a change in policy. Typical example we give about, let's say, valuation of gratuity. Earlier we were not at all providing gratuity for employees. Now we started providing, and we go for actuarial valuation approach. Previously we are not providing. Now it's something fresh is coming. Accounting policy change cannot be applied. It is introduction, not a change in accounting policies. Early application of Ind AS is not change in policy, and you have to distinguish from accounting estimate. When just an amount is measured, we make a provision. For example, depreciation, straight line method, WDV method, they are not called as accounting policy, they are change in accounting estimates. We have to provide retrospective effects. Retrospective effect means as if it is changed from the earliest date on which it is possible. Earliest date means how much? 50 years back, before independence. Actually, yes. If you want to do retrospective, you have to change all those numbers and you have to give the cumulative effect on opening balance sheet. We prepare 3 years balance sheet for that purpose. But of course, practically it is not possible. So we use the practical expedient, and because of the cost and time resource constraint, and to the extent possible, we'll try to provide it. Voluntary change, yes, retrospective, but as new Ind AS, we can just go for. Usually, new Ind AS, when it comes, the Ind AS itself will tell you what should be the new process, but you can go for the prospective approach. Okay. Regarding accounting estimates or errors, okay, accounting policies covers all the points. Change in accounting policy is allowed, but early adoption is not a change in accounting policy. Voluntary change like cost model to evaluation model, retrospective effect, changes in accounting estimate like provision for doubtful debts, provision for warranties, you have to provide prospective effect. One more example of accounting, I mean policy I'll give. It is connected to Ind AS 115 also, but I'll discuss. These Amazon, Flipkart, and all, let's say online retail store sells goods, and you have the right to return in case you're not satisfied. When should you recognize the sales? At the time of sales, or you have to wait till the return period is over? There is no rules. Again, we apply policies. As per the policy, maybe it's more convenient, more proper to wait till the return period is over, or you say I will recognize the sales and accordingly I recognize the proportionate estimated expenses returns. Amazon used to do it actually when they were in US and all. They'll say the moment we sell the goods, we'll recognize the sales, and based on my historical estimates, historical experience, I'll make an estimate of how much things likely to come back. I'll make a provision. But when they came to India, that policy was not applied, because with for 30 days you use the product, then you return it. The rejection level like 50, 60, 70%. You can't estimate it, especially other products is okay. These slippers, footwears, that they use it for 1 month and they give it back. It is not usable also later. Like computers and all, at least is manageable. Slippers, what do you do? And therefore they had to change the policy to suit the Indian requirement. They said no question of recognition of revenue, let's wait till the time period is over. If things did not come back, then we'll recognize the revenue. So you have to suit the accounting policy requirements in different context. Prior period errors, the word is errors, not estimates. Errors means they are omissions, misstatements, in the sense they were intentional, or it was not that it is beyond our control. Estimates means we'll think, okay, for example, useful life, we estimate 5 years, but actual maybe only 2 years. It's not a mistake, it's just that estimation was not right. It's not an error. But if you knew calculation like 320, you write as 230, that you write the invoice again 2-3 times. So those kind of things, errors, misstatements, omissions are errors, and they are to be retrospectively restated if there are material items. Again, what is material? That is judgmental. If it is not material, we can just go with prospective effect. That is also fine. So this is basic summary of Ind AS 8. As I told you, from exam point of view, it is very easy. Practically distinguishing policy and estimates is also not so easy. Easy to explain, difficult to apply. Okay, any doubts in Ind AS 8? Accounting, policies, estimates. One typical type of question you can expect, for example, there has been a mistake of valuation of inventory. So you have to restate. So 2 columns, sales, cost of goods sold, profit, and its impact in the balance sheet, that is share capital, reserves and surplus. So when they say like inventory has been overstated or that something has been missed, so you change the previous year closing stock and change the current year opening stock as well. So both of years profit will change. I mean, the profit changes, tax also will change. So we write the P&L account column format, and we write the 3-year balance sheet, retained earnings. What is opening balance given, and what is the new profit, and again what is the new profit, the changes in the inventories. That's one kind of thing. And theory questions, is it change in accounting policy, is it change in accounting estimate, or is it change in prior period items, things like that. More of a case study questions. Now it's estimates. Reason is earlier we did not have a cost model and a revaluation model. We just had a cost model. So the depreciation method was accounting policy, a major element. Now the depreciation method is no longer a constraint because our objective is to follow cost approach or revaluation model approach. Classification of assets based on, so that, or that became our most priority. Estimation became lesser. Second reason, logically if you think, it's an estimate. What is depreciation? We will discuss in Ind AS 16, but still, what is depreciation ultimately? It is decrease in the value of the asset, due to which we get the benefit, but decrease in the value of the asset, and we call that as depreciable amount. From cost, original cost, to the scrap value, that decrease is called as the depreciation, depreciable amount. If I ask you, which is more logical, straight line method or WDV methods? Straight line method is not logical, it is convenient in examination because it's easy to calculate. But we can't say that, okay, for conceptual purpose, easy, everybody, for easy to calculate, easy to apply, in exam you apply. But logical method is WDV. Because ultimately, again, if you compare depreciation, depreciation should reflect the benefit we receive. It's a matching concept. When the value of the asset increases, we are getting some benefits. So when we are making sales, there are purchases, there are expenses. Depreciation is also an expense. Initially, when the machine is new, depreciation also will be high. As the time progress, the machine value will come down. So depreciation also will come down, because when the asset value itself is less, what you can lose also will be less only. It's like typical question they'll ask you in your relatives' house or functions. No, you are a CA, how to reduce income tax? It's a common question which everybody come across. I also used to say something, now I got a standard answer. You want to reduce your income tax, reduce your income. Okay, from that moment they'll say, okay, I will not ask you any question, you go to hell, you go anywhere. So if you have less income, you have less tax. So you have less assets, you will have automatically less depreciation. So ultimately, depreciation is an estimate of consumption of an asset. Now, can I apply same depreciation for a cab service company or for a regular company has assets as car? You can't use same thing, because cab service company use the assets so much. That means they consume so much. So it's not the question of policy, it's the question of estimation, which is more appropriate, used in that period. And therefore it is more logically, even earlier it should have been. And one more small point is, how do you calculate depreciation? Let's say straight line method. What are the determinants of depreciation? Cost, that is scrap value, residual amount, and useful life. Residual value is estimate, useful life is estimate, cost you know, so determinant of that also should be an estimate on a logical sequence. So that's the reason they have changed it correctly, and that's why I like that Ind AS thinks more, because they are more concept, more logical. But AS is more suitable for Indian mindset because it is rule oriented. We say this much, we follow that. Why, how, when, we don't want to ask such much questions. So Indian mindset, rule based system is more appropriate. Okay, let us take some. Let us go further. RTP May 2021 question, 22 question. CG Limited, a listed company, prepares its first Ind AS for the year ending March 2003. The date of transition is 1st of April 2001. Okay, they're starting about first Ind AS. I think Ind AS 101. The functional and presentation currency is rupee. I think it is Ind AS 21 then. The financial statements as at and for the year ended March 2003 contain explicit unreserved statement compliance with Ind AS, and previously it was using Indian GAAP as the base. So basically they're applying Ind AS. It had already published the first interim results of quarter 1, quarter 2 and quarter 3 in accordance with Ind AS 34 and Ind AS 101. The interim financial report included the reconciliation of both total comprehensive income and of equity that are required by Ind AS 101. So you are following the rules, obedient student. Since issuing the interim financial report, its management has concluded that one of the accounting policy choices applied at the interim should be changed for the full year. How should GG Limited deal with the change in accounting policy in Ind AS framework? Basic question is this: they are not prepared the full Ind AS still, because the quarter is still going on. But you know that Ind AS applicable from 1st of April only every time. Therefore, they started applying in interim financial statements. But before the year end happened, they wanted to change accounting policies. Because first financial statement they are preparing are is it allowed? It is allowed. I'll do one thing. I'll quickly read what institute has given a solution. You'll get clarity, and that's how these different things are connected for this standard. I'll quickly read it. Let's see if you're able to follow. The first annual Ind AS are prepared in accordance with Ind AS 101. Okay, we don't know that. Subject to certain specified exemption and exception, Ind AS requires use the same accounting policy in opening Ind AS and throughout the period. This override Ind AS 8 requirements for disclosure about change in accounting policy do not apply in an entity's first Ind AS financial statements. Changes in accounting policy do not apply in first Ind AS financial statements. It is again very logical. What is change in policy? I had a policy, I am changing it now. You are preparing first Ind AS. Where is the change in policy first of all? You are applying for the first time. Anyway, they specifically tell it that okay, first Ind AS, you do not talk about change in policy, but interim financial statements already prepared for following the first policy. So as far as the full year is concerned, it's not a change in policy. But interim financial statements, let's see what they say. GG Limited should include an explanation in the change policy that it has made since interim financial report in the notes to accounts in accordance with whatever paragraph. The disclosure note is likely to include information similar to what Ind AS 8 would otherwise require to help users. The entity should ensure that the reconciliation of total comprehensive income presented in first Ind AS in accordance with paragraph are updated from those included interim reports to reflect embedded accounting policy. I'm not sure whether you understood. They are telling only two simple points. First point, Ind AS 101, first Ind AS does not apply, but they are following interim financial statement, so it applies in the context. When you prepare the first Ind AS, you have to provide reconciliation from the quarterly statements till the year-end values. That is Q1, Q2, Q3 or Q3, whatever is the amount, till the balance sheet. The reconciliation, because of change in policy, you disclose in notes to accounts. That's what they are telling in this problem. Okay, next. During the year ended March 2002, this is MTP May 2020 question. During the year ended March 2002, Blue Ocean Group changed its accounting policy for depreciating property, plant equipment so as to apply component approach fully, while the same was adopting revaluation model. In years before 2001 to Blue Ocean's Group's assets records were not sufficiently detailed to supply component approach fully. So you understand this standard, I cannot talk only about the standards. Ind AS is such nature that you need connection with other standards. At the end of 2001, management commissioned an engineering survey which provided information on components held and their fair values, useful life, residual values, depreciable amount from 2001 to. Results are shown under property, plant equipment 2001. cost, depreciation, net book value, depreciation expense for 1 2 on old basis, that is on cost basis. Some results of engineering survey: valuation 17,000, estimated value 3,000, remaining life 7 years. However, the survey did not provide sufficient basis for reliable estimating the cost of those components that had not previously been accounted for separately and existing before the survey did not permit this information to be reconstructed. So basically, now we want to follow component wise approach. So previously what the component values we don't know now. We are going forward, we will apply component wise depreciation, but those components when we acquired, what was their individual values, we don't know that. It's like you have a car now, you want to provide depreciation for engine separately, seats separately, tires separately. You paid for car earlier, so individual component now somehow you, if you purchase, you can value it, but at the time of acquisition you don't know. So that's what they are not able to survey as well. The board of directors considered how to account for each of these two aspects of accounting change. They determined that it was not practicable to account for the change to a full component approach retrospectively, or to account for that change prospectively from earlier date than the start of 2001. Basically not possible. Also, the change from cost model to revaluation model is required to be accounted for prospectively. Therefore, management concluded it should apply Blue Ocean Group's new policy from the start of 1-2. Group's tax rate 30%. Compute the impact of change in policy related to change in amount of property, plant, equipment under revaluation method. Impact of taxes. Show the impacts. Each item affected on financial statements by analysis of stated issue. So basically what we are telling, as per the engineering survey, valuation of PP is given to be 17,000, estimated useful life is 3,000, remaining life is 7 years, and whatever we have done earlier we can't retrospectively apply. So going forward we'll apply we apply prospectively, which means 17,000 is the cost of the asset as on date, 3,000 is the residual value, 17 minus 3 divided by 7, straight line method, we get depreciation from year 1-2 onwards, 2,000. Okay, and what is the value earlier? Old value we have 11,000. 25 minus 14, we had 11,000, but now we are revaluing it at 17,000. So we have to show, okay, I'll just show it to you. Depreciation anyway, as I told you, cost minus scrap value by useful life. So how calculations will happen is like this. Okay, the impact will be shown like this. Increase in the carrying amount, book value was 11 but revalued at 17. So increase in the value as on the date of change of policy, 6,000. And when this carrying amount increases, like basically fair value increase, it's a profit, but you're not paying tax, so there has to be a deferred tax liability, 30%. So if you subtract 30% net impact on your reserves or P&L or balance sheet, 4,200. And depreciation, you are providing earlier 1,500, now you providing 2,000, I think. That is, this was 1,500 earlier what you have shown, and now 17 minus 3 by 7, that will be 2,000. So increase in depreciation 500, and on that tax impact 30%, 150. So you show the statement like this. What is the impact of increase in reserves and tax impact on that, and what is the expense, depreciation incremental and tax impact on that. If they tell ignore tax, then this line will not come, but here revaluation reserve will come because of increase in assets, and depreciation in current year is increasing and corresponding tax impact. So that's how you can report when they ask you for impact. And of course, you should write that fact in the notes to accounts, stating the fact that as per Ind AS 8, it was supposed to be on retrospective basis, but due to the constraint of time resource involved, or it was practically what is it? The word, technical words. They have also said no in the question only. It was not practicable. Okay, it was not practicable to account for the change on full component approach, and therefore it is provided on prospective basis. That information must be passed on to the users, and you should prepare this table. So this is how in AS 8 questions will be asked, and usually independent questions difficult to estimate. It will be in connection with the other standards. Not practicable, that's the word we have to use. Component approach, very interesting concepts, very realistic also. So anyway, we discuss later, but if you imagine your body also like a depreciable asset. Cost of acquisition when you are born, then you kept on capitalizing it. From the date you are ready for use, maybe you started working, started depreciating, and after useful life, it will have a residual value. And the depreciation, you cannot provide the body as a whole, you provide for individual components. Maybe hair separately, eyes separately, kidney separately, legs separately. Suddenly, if you meet with an accident, impairment happens. So you know that concepts are similar, and ultimately when your useful life is over, you become scrap value. And there is a difference between physical life and useful life. At the age of 60, 65, once you retire, you will be physically alive, but you may not be useful. So the moment you are classified as held for sale, you will go to discontinued operations. You need not be actually sold, but people at your home, they disgrade you. Okay, no more useful life from this person. The moment they give up on you, you're not a fixed asset, you are a asset held for sale. That is under discontinued operations, meaning you are waiting to go out. That period, discontinued operations. Anyway, so life is not different, accounting is not different. Okay, so anything else on Ind AS 8? Okay. Okay, so Ind AS 10, the name is events occurring after balance sheet dates. It's after balance sheet dates, but there has to be some outer limits. The outer limit we say is the date on which the board of directors approve. So after balance sheet date, but before approval of accounts, normally by board of directors, this period is called as event occurring after balance sheet date, and those events sometimes to be reflected in current year, and that's called as adjusting event. If it is not to be adjusted, it's called as non-adjusting events. The condition is the condition that existed on reporting period. For example, as on 31st of March, there were a lot of lockdown happened, so you are not sure whether you collect the money from your customer, you're doubtful. And on 30th of April next year, your customer actually told you, I'm not going to make the payment, you do whatever you want. Meaning you have to now write off, but on 31st of March only you knew that this was coming in, so you can make that adjustment in the previous year itself without waiting for the current year. The condition should be existed on balance sheet date. If condition arose after balance sheet date, they are called as non-adjusting events. For example, on 30th of March, there was some repair done to the machine, but the invoice was received on 2nd of April. This is an example of condition existed because repair work was done, invoice was pending. So condition was there and uncertainty was there, and which got resolved by a future event. This is adjusting event. But if the work was done on 1st of April, Invoice received on 2nd of April, this cannot be taken to previous year because as on 31st of March, the repair work condition was not existing. On 2nd of April, there is a fire and stock is damaged. On 31st of March, while estimating net residual value, should you consider the impact of fire? It is non-adjusting because as on 31st of March, you cannot expect that, oh, it is likely to be, there is a fire and the value will come down. Unless you are the one who are planning to do it, you cannot expect the fire on 31st of March. Therefore, it is non-adjusting event. One more typical situation which can arise because 31st of March, there's a lockdown. You have various values, maybe a real estate company or a car manufacturing company. You have lot of inventory. 31st of March, lockdown happened, and you don't know at what value you are going to sell. You might sell below cost as well. Should it affect NRV? Can I treat the event, the goods are actually sold on 15th of April at below cost. So that value at which you have sold, can it influence my NRV on 31st of March? Yes, because on 31st of March, the lockdown, the corona effect is present. The condition existed. So any event occurring after that, it will be considered. Proposed dividend which is proposed by board of directors after the balance sheet date, and therefore it is a non-adjusting event. But as on 31st of March or within 31st of March, if there is anything like interim dividend, the board of directors can themselves propose and pay. So proposed dividend which are proposed before 31st of March is adjusting event. Actually, that's not adjusting event, it's an event. After 31st of March for the year ended, if you do any proposed dividend, that is non-adjusting event. If any material non-adjusting event occurred, for example, I told you fire after 31st of March, it is non-adjusting, but it should be disclosed. Because of the fact, you can report it to the shareholders, you should do it. You will show it in the board of directors, sorry, you will show it in the notes to accounts. In accounting standards, you will show it in board report. But in Ind AS, we show it in the notes to accounts. Material event took place after the balance sheet date, but non-adjusting. One exception is there. You can read the exception everywhere. That is going concern assumption, which means the event is so severe or the fire is so severe that the company is not likely to come back and resume its activities. Therefore, in those cases, we are going to apply going concern exception and restate all the assets and liabilities. Going concern means we don't apply cost or NRV, whichever is less, nothing of that. Assets are valued at realizable values. Liabilities are valued at settlement values. Today if I pay and today if I receive. That is, as a going concern exception, we are going to apply. So if you pay liabilities earlier than original, you pay more or you pay less. If you pay the liability immediately than the original date, it may be more, it may be less. Less, I understand, you pay creditors, you get cash discount. If you have a bank loan, you pay the bank loan, bank might levy penalty. First of all, so many people are not repaying loans, and if you repay in advance, they put penalty. Yes, there are pre-closure charges. In fact, in SFM, there is one concept of replacement of bonds, and if you redeem the bond earlier than the due date, you have to pay premium. It's called as call premium on bonds. For early redemption, you have to pay extra money. So those kind of things should be considered if you are closing immediately. And one new things comes, that is long-term loan under Ind AS. If you remember Ind AS 1, we discussed that breach of covenant, non-current becoming a current portion. And what you do is, again, I told you, you go and make that rights before the approval are there. You get a statement from the lender that they will not agree to demand immediately. You get a statement from them, and then you will treat as adjusting event, and you will continue to show it as non-current. You will not show it as current, because in India, breaching the things and all is very common. That's our birthright, not to follow rules. So if somebody follow rules, we look at him something different. What this fellow is following rules. So basically, I've experienced, if I stop a traffic signal, people look at me like I'm elbowed. According to us, only elbowed people follow rules. Once you learn, you don't follow rules. Anyway, so here also, this is a, carve out. It is not there in IFRS. It's there only in Ind AS. It's our unique thing. So this has been modified to suit our more nativity changes here. Okay, so this is Ind AS 10. I don't expect much question in the exam. Ind AS 10, Ind AS 8s are more or less connected. But adjusting, non-adjusting just depends on condition existing on balance sheet date or condition arose after balance sheet date. Going concern is an exception. Okay, that's it about this standard. Okay, Ind AS 113, fair value measurements. This also is the standard, easy to explain, difficult to apply in practical life. The reason being, this standard will not tell you when to apply this standard. Whenever you apply fair value, then use this standard as a guideline. So that's why it is slightly different. It's not compulsory to use the standard. So wherever you use the fair value, these applications are considered. So it's more of a financial management than this other things. Let's still quickly go through it. If, for example, if I ask you what is the value of calculator? Calculator, what value? 50 rupees, 100 rupees, 125 rupees. In examination, imagine your calculator is not working. What is the value of calculator there? Especially in, let's say, costing exam, SFM exam, FR exam, you have one calculator but not working. If some people say 1,000 rupees also, will be ready to pay because it's a question of 6 months. No, 1,000 rupees you definitely ready to pay. So value is a very subjective term. It differs from person to person, situation to situation, and that is why I always say, please carry 2 calculator to exam hall. We don't know in which case that can be useful. If you don't know the question, you don't pass the exam, that's absolutely fine. But the calculator is not functioning, hence you lose the marks. That is a crime. So carry 2 calculators, one regular calculator, once maybe pocket calculator. So in case of emergency, you might use it. And as per probability theory, you know, if 100 people are there, at least 1% of the persons will suffer that if you carefully observe in exam. So maybe you can help others. Social service also you can do. Or you can make that as a business opportunity and say, you want calculator, 10,000 rupees. Definitely people will pay. Making use of opportunity all comes from being prepared. Don't create business opportunity. Don't throw his calculator down and do something and say, do you want calculator? That is unfair. As far as utilization is concerned, it's fine. So fair value is subjective in nature. Then how do we apply this standard? What is the definition of this standard? Fair value is the price that would be received to sell an asset, so it's exit price, or to pay to settle a liability in an orderly transaction between market participant at a measurement date. Orderly transaction without any force in a normal course of business. Between market participants, not between related parties. On a measurement date as on a particular date. In general, fair value means it should be fair to everybody. We don't want to have a one-off exceptional situation and say that is the value of the asset. What is the value to public at large? That is the value we would like to apply. So, for example, if it's a vegetable, for a patient it might be different. For CA students, it might be different. The value will change in different course of time. So we don't want to have different extreme circumstances. In general, what most people view, that is what we want to take it. So keep that spirit in mind. Let's apply what this standard says, the chart quickly. Ind AS 113 talks about exit price in an orderly transaction And restriction, instrument wise restriction is considered, entity wise restriction is not considered. Same example what institute mostly gives, I'll give the same thing. Companies have a memorandum clause which says you should use the business or your company for a particular purpose. So if you have a land, you purchase the land, you cannot develop and sell it. But if you are a real estate businessman, you can develop and sell it. So if, and because your business may be software business, so when I'm valuing that land, let's say I'm Infosys, my business is software, I'm valuing that land, should I think I am not a real estate developer, how do I value my land? No, in general how the people would value it. So entity, there is a restriction, we don't consider it. But instrument, there is restriction. For example, let's say there is a vehicle which is a yellow board vehicle, it's mainly for taxis, and there's a restriction that they have to pay more taxes or their cost is considered so much. Those restriction is considered because anybody owns it, it is still a yellow board vehicle only. The owner does not matter, the instrument is what is important. So instrument wise specifications are considered, owner wise, entity wise restrictions are not to be considered. This is one more important area where examination question can be asked, where we follow two preferences, either principal market or most advantageous market. So if a material is available in two markets, simple example is shares. It is traded in NSE also, it is traded in BSE also. In which share price I should consider it? First preference is principal market, means where the volume is highest. Logic, you understand, as I just told you, fair means what is accepted by most people. So volume is the important criteria. Actually, you can also say like, anyway, I'll go to stock market, let me not think about it. Volume is highest, and that is where we call it as principal market, because trading transaction takes place most often in that market. If principal market could not be determined, for example, you sell your goods in Europe also, you sell your goods in UK also, US also, Africa also, it's spread across the world, you don't know specific where exactly you are selling, in that case you go for most advantageous market, means your NRV, net realizable value, is the highest. And this is also important point in this context, that is some cost to be considered and some cost not to be considered. One is transportation cost, the other is transaction cost. Transportation cost means if you are selling in two markets, you have to travel, conveyance, carriage, whatever you call it. Transaction cost means, for example, sales commission. That is expenses incurred to sell the product, whereas transport means to move the goods from one place to another place. Transport cost is considered for fair valuation purpose, meaning when you compute the fair value of the product in market A, 60 rupees, if you want to take it to market B, 10 rupee transportation cost will be there, then it is 50 rupees. You have to subtract the transportation cost to arrive at the fair value. Whereas transaction cost you consider not for fair value purpose, but only to consider the most advantageous market. And when will most advantageous market will come into picture? When you are coming to the preference 2. You are not able to identify the highest volume, so you're looking at most advantageous. There you will subtract transport cost also, transaction cost also, just to determine which market is most advantageous market to get the profit. Otherwise, this is not considered for determining fair value. This is the primary thing required in Ind AS 113. You have other things like one more thing we should discuss, level 1, level 2, level 3, that we should discuss. There is market approach, cost approach, income approach. Again, that is all about valuation. How do you consider it? Market approach means if I sell the product today, cost means replacement cost maybe. Income approach means, in your financial management, we discuss present value of future cash flows. So, three kinds of approaches. Hierarchy we should discuss. But before that, any doubts in this section? For both fair value determination as well as for identifying the most advantageous market. Transport cost is cost, whereas transaction cost is only for most advantageous market. So just imagine, if you subtract that also from selling price, then we can't differentiate a fair value and net realizable value. Selling price is fair value. When you subtract the selling cost, then you get net realizable value. So here the objective to get NRV, we subtract cost, but selling price, to get the fair value, we don't subtract it. So if you have a principal market, the transaction cost will not come into picture at all. We don't need a most advantageous market. Only when we don't have it, we take the help of transaction cost. Okay, let's just look at that hierarchy thing. Fair value inputs hierarchy. First one is level 1 input. We use the market price. That is, we go with market price. There's one statement on stock market that Bhav Bhagavan Che, which is market price is God. And I always say that uh, stock market is my religion and market price is my God. So I do trading full time. So price is everything. So whatever you call it, ultimately it will be reflected in price. How much ever you hide, how much ever you play, ultimately price will reflect its true worth. If you believe, that's what most people believe, that is our first preference. Level 1 input, quoted price, market price. If market is not available for that particular product, then we go for some adjustments. That is level 2 input. For example, if we take off a furniture, which is customized furniture, which does not have a market, then what do? We take the market furniture, market price, then we do adjustments. That is called as level 2 inputs. Or, maybe in financial management, you would have discussed SFM. You will get the quote for foreign exchange rates for 3 months. The swap points is this much. For 2 months, the swap points is this much. But we need the contract for 2 months, 15 days. We try to interpolate and estimate that is what is level 2 input. We take the market input and we try to arrive at, we try to do some adjustments. The level 3, that's called as unobserved inputs, least preferred because it has a lot of management assumptions, impairment testing, valuation of private company shares. We follow present value future cash flows, which assumes cash flows also, which assumes the rate of interest also. Maybe you would have done this valuation for FCGPR. I don't know how many have done it, where we prepare the estimates and we only put all the sales figure, we only put all the purchase, all the costs. Anyway, nobody is going to ask us. You make any assumption and value will come. So management assumptions are least dependable and market is supreme. Okay, so that is what is unobservable inputs. We should give a less preference, more preference towards level 1. We go in that hierarchy. Okay, any other doubts in Ind AS 113? I know I told the class timings, but will it be okay if we extend by some time? Even at least for assumption also you're not telling yes. Okay. Okay. Some people are at least telling yes. Some people are telling no. And some people or most people like you do whatever you want. It does not matter. Indifference approach. Or some people, at least some people are innocent look. It's okay, sir. You do it, no problem. And some are warning look. You come outside, we'll see what happens. Okay, we'll just continue. We'll just Entity A owns 250 ordinary shares, and this is a new study material question, RTP number 2021 question. Entity A owns 250 ordinary shares in company XYZ, an unquoted company XYZ has total share capital of 5,000 shares with a nominal value of 10. Entity XYZ after tax maintainable profits are estimated at 70,000 per year. Appropriate price earning ratio determined from published industry data as 15 before lack of marketability adjustment. Entity A's management estimate that the discount for the lack of marketability of the company's XYZ share and restriction on their transfer is 20%. Entity A values the holding company shares based on earnings. Determine the fair value of Entity A's investment in XYZ shares based on the facts given in the aforesaid mentioned part 1. Assume that Entity A estimates the fair value of the share it owns the company using net asset valuation technique. The fair value of net assets, including those recognized in balance sheet and are not recognized, is 8,50,000. Determine the fair value of Entity A investment in XYZ shares. Okay. I thought the valuation is part of SFM syllabus. Now it's part of FR syllabus. And many things, I believe, FR SFM is getting converged. So many points are common. So these days I'm like accounting for SFM is called as FR. It is becoming like that more and more, looking at the new standards, especially in days 116. So 250 ordinary shares, they are having the share capital. Other company has 5,000. The maintainable profit is 70,000. I'm not sure you are aware of this. The profitability or the profit multiplied by P ratio will give you the value of the company, or market cap is what we call in SFM world. So when P ratio is very high, we also say that it is overvalued. When P ratio is very less, we also say it is undervalued. So at present, many companies are falling because of this reason, is what we use it. That is, share value, P ratio is too high, costlier, so it has to correct itself. But the best part is the P ratio is applicable if you have earnings. I know so many companies where earning itself is not there. What P ratio you apply? Anyway, different ratios are there, like sales to earnings, EV to EBITDA, many other parameters. Okay, fine. Let's apply here. P ratio is 15, but they said because of lack of marketability, you have to apply discount of 20%. So on 15, if you apply discount of 20% means 0.8. Actually, it will become 15 into 0.8 means 12. The applicable P ratio is 12. Or you just multiply 70,000 into 15 into 0.8, that is 8,40,000. And number of shares of the company is 5,000. So 8,40,000 by 5,000 is 168. And your company, you are investing 250 shares, 250 into 168, that is 42,000 on present value basis, P ratio basis, P multiple. Level 2 input, I can say. Then second method, on net asset basis, they said net asset is 8,50,000, 8,50,000 divided by 5,000 shares, 170 per share, multiplied by number of shares held, 250, you get 42,500. So we're very close. Practically it may not happen, but still. One on fair value basis, on net asset basis. One is income oriented approach, the other is asset approach. Asset minus liabilities, net assets approach. Simple problem, but I know sometimes simple question only can trouble in examination. So make sure that you don't lose marks on these areas. Okay, any other doubts on Ind AS 113? You're looking at me like, how dare you ask any doubts? And you're looking left, right also. If anybody is asking doubts, be careful. Okay, I think that's it with this standard.